Good morning, everyone. So many queries are there. So let's answer that and then proceed to place of supply. Transport of agricultural produce through airplane is taxable. Yes, because airplane we don't have any notified goods exempted, so therefore it will be taxable. But transport of wheat through GTA is exempted. Kindly explain this, sir. Of course. So because GTA only we have that notified goods. That notified goods is not there for airways. That notified goods is only in case of vessel between places in India, then in case of GTA and in case of railways, because of that. Then any activity related to agriculture is exempt, so I think transportation, no, not because of that. Then okay, so there was a debate. Okay, fine. Can you please explain regarding the amendment in GTA once more? This one FCM, RCM 5%. It's simple here. GTA has two options. Either they can pay GST under FCM or they can pay GST under RCM. And they need to decide that option before 15th March of the previous year, and whichever option they are choosing, so that option they will be paying. Suppose if it is RCM, they will not pay, their recipient will pay at 5%. Suppose if it is FCM that they have chose, again they have two rates. Either they can take 12% if they want ITC. Suppose if they want ITC with respect to the lorries etc. purchase, so definitely they will go for FCM option, and that too 12%. Suppose if they don't want any ITC, so but still they want to pay GST under FCM, so then they can go for 5%. So that is that, nothing else. Then export of goods and zero rated are different. No, export of goods is one of the zero rated. So zero rated has export of goods and services, supply of goods and services to SEZ. So that is zero rated. Then next, charges to RTI by an unregistered individual is exempted. So any person, RTA charges is not collected by individuals, RTA charges are paid by the individuals to government. So that money which is collected by the government will be exempted. So let the person be registered or unregistered, all these things irrelevant. Okay, fine. Yes. So I have 9th edition book. How should I incorporate the changes of the 10th edition and amendments? So you can check my website. In downloads I have provided the addendum. You can see that. Okay. So place of supply. So in our last class we have completed introduction to GST and thereafter taxable event, and then even invoice and time of supply exemptions. So in today's session we are going to complete place of supply, input tax credit, value of supply. So these major areas is our focus today. And place of supply, we have total 4 sections. Section 10 deals with place of supply in case of goods, and that too domestic transactions, and section 11 deals with place of supply in case of goods import and export, and section 12 will be in case of services where both supplier and recipient are located in India. Any one in India and the other outside India, then the place of supply will be determined under section 13. Now if both supplier and recipient are located outside India, can we determine the place of supply? No, because if both are in India, section 12, if one in India, outside India, then section 13. If both are outside India, place of supply cannot be determined. In that case, all the services will be exempted except one service, that is transportation of goods by vessel from outside India to India will be taxable, and in that case who will be GST? So GST is payable by importer of such goods. Now we are discussing section 10 and 11. Section 10 is domestic transactions related to goods. Section 10(1)(a) is supply involves movement of goods. In case when supply involves movement of goods, so then ending point will be taken as a place of supply. That is, supply involving movement of goods means under the contract of supply, goods are taken from one place to another place. So ending point should be taken as the place of supply. Then what if supply does not involve movement of goods? 10(1)(c). Then in that case, location of goods at the time of delivery will be taken as a place of supply. That is, for example, if there is a ship which is located in Mumbai and the seller of the ship is located in Tamil Nadu, buyer of the ship is located in Karnataka, So now the seller is transferring the document of title to the buyer, but the ship is located in that place only. So therefore in that case, supply does not involve movement of goods. So therefore location of goods at the time of delivery will be taken. So therefore Mumbai will be taken as the place of supply, location of goods at the time of delivery. Suppose if supply involves movement of goods, then ending point will be taken. If it is bill to ship to transaction, bill to ship to transaction means we will be raising invoice to one person but sending the goods to the other person. Now what should be taken as the place of supply? Billing address should be taken as the place of supply. Say for example, A Limited and B Limited is there. A Limited places the order to me to deliver the goods to B Limited. Now for me, billing address is A Limited, so A Limited's location only will be taken as the place of supply. And again between A Limited and B Limited there will be another supply. So in that case it will be 10(1)A, supply involving movement of goods, ending point will be taken. So in bill to ship to transaction, we need to observe that there will be two supplies possible. Not necessary that always there will be two supplies, but two supplies will be possible. One between the original supplier and the billing address, and the second between billing address and the shipping address. Then 10(1)D, goods assembled or installed at site. In case when goods are assembled or installed at site, so we need to take location of such assembly or installation as the place of supply, and 10(1)D will overwrite 10(1)A or 10(1)B or 10(1)C as the case may be, because whenever the goods are coming into existence only upon installation, we should not see ending point of the goods or location of goods at the time of delivery, etc., because this is a specific provision. So we need to take as per 10(1)D only, that is location of installation or location of assembly only will be taken as the place of supply. Then supply of goods on board a conveyance, that is during the journey, whenever the supply of goods takes place during the journey. So then in that case we will not see, so where the sale has taken place, we will see the starting point of the goods, which means location where the goods are taken on board. So therefore in the first case it is ending point of the goods, in the last case it is starting point of the goods. So that will be taken. And in this aspect here, one point we need to understand that supply of food on board a conveyance, so that food, whether it is cooked in the pantry car in the train or is it cooked outside and loaded into the train, we need to check. If it is cooked inside the pantry car, then it will become supply of services, then we should not apply 10(1)E. So because 10(1)E is only in case of goods, okay. And then if the food is already cooked outside and it is packed into packets and then it is taken into the train or etc. vehicle, so then what will be taken as the situation? Yes, it is goods. So even though supply of food is services, but only cooked food will be coming under services, whereas packed food which are sold inside the conveyance will be coming under supply of goods. So we need to apply 10(1)E, supply of goods on board a conveyance, starting point of the goods. Then in case of section 11, import of goods, we will take location of importer as the place of supply, not the place where it is imported. For example, I am located in Andhra Pradesh and I am importing the goods in Chennai, Tamil Nadu. So now what will be taken as the place of supply? Location of importer, Andhra Pradesh will be taken, but not location where the goods are imported. What is the purpose of determining place of supply in case of import of goods? Anyhow it is interstate supply, then why we need to determine place of supply? In order to give 50% of the IGST to the consuming state. So for that reason only we need the place of supply. Then in case of export of goods, what will be taken as place of supply? Location outside India will be taken as place of supply, and both import and export are always deemed as interstate. And in case of conflict between 10(1)A, B, C versus 10(1)D or E, so which will prevail? 10(1)D or E will prevail, because these two are specific provisions and that will prevail over the general provisions. Then whenever place of supply is determined under section 13, and if the place of supply is in India, it will be always deemed interstate supply, which already we have discussed. So that is the point which you need to always keep in mind, that is place of supply, it is in India, supplier also in India, same state, let it be, but the place of supply is determined under section 13, then it will be deemed interstate supply. Then we are moving on to place of supply in case of services. In case of services, so 12 and 13 parallelly we need to remember. So when 12 will be applicable? If both are in India. If one in India, other outside India, section 13 will be applicable. First we need to see the general provisions. So as per general provisions, in case of section 12, B2B location of recipient, B2C location of recipient in the records of the supplier, in the absence of that information, location of supplier. Whereas in case of section 13, it is location of recipient in the records of supplier, otherwise location of supplier. So this is the general provision. provisions, and in the absence of specific provisions, so then general provisions will be applicable. Then next one, service in relation to immobile property or accommodation services, etc. So what should be taken? So if property is in India, then location of property. If property is outside India, then location of recipient should be taken. But in case of section 13, always it is location of property only. Let the property be in India or outside India. Then performance based service in relation to individuals. So here performance, like the previous point, immobile property services, we have renting, accommodation service, construction service, real estate agent service, works contract service, all those will come there. Whereas in here performance based service in relation to individual, there is a individual, to that individual you are providing some services. So then in that case, for the purpose of section 12, so we have three divisions. Number one, food and beverages, beauty treatment, etc. So related to food and related to beauty. So we will take location where services are actually performed. Whereas in case of second one, training and performance appraisal. So in case of training and performance appraisal, we have B2B versus B2C. So B2B location of recipient, B2C location where services are actually performed. Performance appraisal refers to evaluating the performance of the participants in reality show, like a judge acting as a judge, etc. Training refers to workshops, conducting any training, seminars, all this will come under training. And all other services we will take general provisions only. Then in case of section 13, we need to see whether physical presence of the individual is required, physical presence of the individual is not required. If physical presence of the recipient is required, location where services are actually performed. If physical presence of the recipient is not required, then we will take general provisions. Then next, performance based service in relation to goods. For the purpose of section 12, we don't have any specific provision, so we need to apply general provisions only. Whereas in case of section 13, we need to check whether physical presence of the goods required or not required. If physical presence of the goods is required, we will take location where services are actually performed. If physical presence of the goods not required, location of goods. But in this case, when physical presence of the goods required, location where services are actually performed, we have 4 exceptions. In these 4 exceptional cases, we will not take location where services are actually performed, but we will take location of recipient as the place of supply. What are those 4 cases? Goods temporarily imported for carrying out repairs or any other process and exported after repairs without being put to use. It can be for repairs or it can be for any process. If some raw diamonds are being imported for the purpose of cutting and polishing, and after cutting and polishing, if it is exported without being put to use, so whether it will qualify for this exception 1? Yes, it will qualify, because it's not just for repairs, any purpose. So goods are temporarily imported for carrying out any repairs or process, and once the process is completed or repairs is completed, these goods are being taken outside India without being put to use in India. Just for testing purposes it can be used. Then it will not be location where services are actually performed, but we will take location of recipient. And second thing is with respect to pharmaceutical industry, if any drugs are being imported for the purpose of testing in a laboratory in India, so after testing, these goods cannot be exported back, because these drug samples which are imported gets destroyed during the testing process. So due to that reason, second exception says that, so then also location of recipient will be taken. The difference between the first point and the second point is that in the first point, after it is imported, after doing process, it should be exported back. But in the second point, no need to export it back, but second point is applicable only in case of drug samples of a pharmaceutical industry. And then number 3 and 4 is connected, repairs and maintenance in relation to aircrafts. But in case of 4, it is repairs and maintenance in relation to vessel, ship. And that vessel or ship or aircraft should be used for what purpose? Business purpose. If it is used for personal purpose, then it will not be coming under location of recipient, but we will take location where services are actually performed. Say for example, one celebrity is coming from outside India in one flight, and one aircraft, one chartered flight, and that particular chartered flight has got some issue. So therefore one aeronautical engineer is providing services to the chartered flight. Now in that case, whether we will take location of recipient as the place of supply or location where service are actually performed. Location where service are actually performed, because that aircraft is not used for the business purpose. Suppose if that aircraft is say Lufthansa Airlines, which is bringing the passengers, and for that aircraft if this aeronautical engineer is providing the services, then what will be taken as a place of supply? Location of recipient will be taken as place of supply. So the point here is that if it is performance based service in relation to goods, location where service are actually performed, and if physical presence of the goods is required. However, 4 exceptional cases it is location of recipient. If it is not those 4 exceptional cases, then the regular provision only will be applicable, that is location where service are actually performed. Whereas in case where physical presence of the goods is not required, means through remote means we are inspecting the goods. So we are taking the IP address of the goods, and through remote means we are able to see, or laptops, computers and all, any desk we will take and we will do the repair services, etc. So then in that case, what will be taken as a place of supply? Location of goods. Location of goods, it's not location where service are actually performed, and we don't have any exceptions with respect to this. Then we have event related services. Event related services, so if it is admission to an event, always section 12 or 13, location where the event is held or the place is situated. For all entry tickets, it is a location where the event is held or the place is situated. For 12 or 13 it is common. For organizing an event, in case of 12 we have some little bit different provision. That is, in case of organizing an event, B2B we will take location of recipient, B2C location of event. If the event is held outside India, then again location of recipient. But in case of section 13, always it is location of event. We don't have any different provision. So therefore, for the purpose of section 13, let it be admission or organizing, always event location will be taken as place of supply. Whereas here our admission, it will be event location, and for organizing, B2B location of recipient, B2C event location. If the event is outside India, then location of recipient. Then transportation of goods. For transportation of goods, section 12, we have one point. First we need to see, is it from India to outside India? If it is India to outside India, it will be ending point, let it be B2B or B2C. So there is no change, let it be B2B or B2C, because generally we see that B2B means location of recipient, B2C means location, like different provision. But in case if the goods are transported from India to outside India, always it will be ending point that will be taken as the place of supply. However, in other cases means what? Outside India to India or within India, etc. Then we will apply B2B versus B2C. B2B location of recipient, B2C starting point of the goods. Whereas in case of section 13, it is other than mail or courier or mail or courier. Other than mail or courier, ending point of the goods, and mail or courier it will be general provisions. So this is in case of transportation of goods. Then transportation of passengers. So in case of 12, simple, B2B location of recipient, B2C starting point of passenger, 13 also starting point of the passenger. And anyhow in case of 13 we don't have B2B, B2C classification. So starting point, literally both are same. So starting point of the passenger, here also starting point of the passenger. But when it comes to goods, starting point of the goods, ending point of the goods. Correct? Section 12 is starting point of the goods, section 13 it is ending point of the goods. And here in one place it is ending point of the goods. What is that? If the goods are transported from India to outside India, then it will be ending point of the goods. Then next, services on board a conveyance. We don't have any difference in the provision. It is same between 12 and 13. It is starting point of the conveyance, not starting point of the passenger. So any service provided during the transit in a conveyance, we should not see. So what is the starting point of the passenger? Starting point of passenger should be seen only for the transportation services. But for the purpose of this, conveyance, services provided on board a conveyance, we need to see starting point of the conveyance. Then OIDR services. In case of OIDR service, section 12, we don't have any specific provision. So general provision. In case of section 13, it is location of recipient. Banking and other financial services. For the purpose of section 12, it will be general provisions. We don't have any specific provisions. But 13, remember, if the service are provided to account holders, then it will be taken as location of supplier. If the service are not provided to account holders, then we will take general provisions only. So that is important. If the services are provided to account holders of the bank, then only location of supplier, otherwise general provisions. Then intermediary services, again in section 12 we don't have any specific provisions, so general provisions will be applicable, whereas section 13 location of supplier will be taken. What is the meaning of a intermediary services? So there is one supplier and one recipient who is providing services or supplying goods. I am facilitating or arranging that particular transaction, means I am not doing any transaction, I am just connecting these two people. So mine is not a recurring activity, mine is only one time activity. So connecting the supplier and the recipient, so my job is done. Suppose if you are required to do some work and if you outsource that work to me, and if I do that outsourced work, I am not called as intermediary, I am called as a regular supplier to you. You understood or not? For example, BPOs, will they come under intermediaries? No. BPOs, KPOs, etc. will not come under intermediaries, because they are doing the outsourced activities and they are not just connecting one supplier and one recipient. For example, you have got one service contract to provide, to do the development of one software. So now you got this contract through me, I just identified a client for you. For that you have given me commission, intermediary services. Now you got one client who is doing the software, like who is asking you to develop the software. Now that software development you have outsourced it to me. Now in that case I am an intermediary? No, I am not an intermediary. So remember, outsourced activities will never be treated as intermediary services. So that intermediary services will be taken. An intermediary is someone who arranges or facilitates the supply of goods or service or securities between two or more persons, wherein two of them transact in the supply of goods or service or securities. So means there is a main supply. So that main supply is between two people, and the one who is arranging or facilitating the main supply. So the one who arranges or facilitates the transaction, therefore outsourced activities will fall under intermediary service or not? No, it will not fall under intermediary services. Example of intermediary services will be, we have commission agent services, consignment agent services, or any brokerage or tour operator services, travel agent services. So these are all examples of intermediary services. Then hiring of a means of transport, next one. So in case of intermediary we completed section 12, we don't have any specific provisions, so general provisions. In case of section 13, location of supplier. Then hiring of a means of transport means renting of motor vehicles. In case of section 12 we don't have any specific provisions, so again general provisions, whereas in case of section 13, divide that into two. Is it aircraft or vessel or others? So if it is aircraft or vessel, then it will be general provisions. If it is others, then is the rent for 1 month or beyond 1 month, that is up to 30 days or beyond 30 days. If it is up to 30 days, then location of supplier. Beyond 30 days it will be general provisions. Then finally telecommunication service including broadband, DTH, etc. So in case of section 13 we don't have any specific provisions, so therefore we need to check section 12. So section 13 it will be no specific provision, so general provisions will be applicable. In case of section 12, so it is divided into two, fixed line or mobile. If it is fixed line, location where it is installed. If it is mobile, we need to again check whether it is postpaid or prepaid. If it is postpaid, billing address. If it is prepaid, we need to see how the prepaid will be done. Online recharges. Online recharges means location of recipient in the records of supplier. Here, or if it is through a dealer or any distributor, etc. So then location of such dealer or distributor will be taken. See this. So if it is fixed line, equipment location, mobile postpaid, billing address, and mobile prepaid, dealer address. Online recharge, general provision, that is location of recipient in the records of supplier. So these are the various place of supply provisions in case of section 12 and 13. Now if you see, this B2B versus B2C classification is applicable only in section 12, that too in three places. What are they? TOT, correct? Training and performance appraisal services, organizing an event, transportation of goods or passengers, correct? So only in these three places we have B2B versus B2C classification: training and performance appraisal, organizing an event, transportation of goods or passengers. So therefore don't get confused, like you have to remember only section 12, that B2C provisions only, because you know where B2B, B2C will come. So therefore wherever B2B comes, there it will be location of recipient. So when you are trying to remember, don't remember the B2B provision, B2C like that. Just remember B2C. So because B2B is applicable in which places? Three places. Training and performance appraisal, organizing an event, transportation of goods or passengers. There only we need to check B2B or B2C, and B2B means location of recipient. B2C means whatever provision you remember that you apply. Okay. Then next, location of supplier is taken as place of supply in case of section 13 only in 3 places. What are they? In case of intermediary services, location of supplier is place of supply. In case of banking and other financial services to account holders, then also location of supplier will be taken as place of supply. And number 3, in case of hiring of a means of transport other than aircraft or vessel up to a period of 1 month, that is 30 days, in that case also we will take location of supplier as the place of supply, correct? Then between 12 and 13, the provisions are same in 2 places, ditto same. That is, in case of admission to an event, location of event will be taken as place of supply, common between 12 and 13. And even in case of services on board a conveyance, it will be starting point of the conveyance. And in case of transportation of passengers, correct? Transportation of passengers, except B2B, B2C, so it will be starting point of the passengers. Okay. So like that you try to summarize things and remember, but this you have to keep in mind. Okay, somehow you have to keep in mind, and directly the questions will be there. So directly by the moment you see that question, you will be able to answer with respect to that. Okay, so just for the purpose of confidence sake, so we are discussing one question now. So that is related to Jan 21. So one 9-mark question is given. So just because as we completed this, and you might be thinking that it will be difficult, etc. and all, that's why. So to the point only they will be asking. So this question number 2A they have asked in Jan 21 exam. So Mr. X, an architect, Kolkata, provides interior decorator service to Mr. Y of New York, USA in relation to his immobile property located in New Delhi. So in this case, whenever you see this, first you need to check whether it is 12 or 13. It is section 13. So in case of section 13, service second, first you need to see 12 or 13. Second, you need to see what is the service it is. Service is service in relation to immobile property. And what is the place of supply? Location of immobile property. What is the location of immobile property? New Delhi. So New Delhi will be taken as place of supply. That's it. Then Mr. A, a chartered accountant registered in Kolkata, supplies service to his client in Bhubaneswar, registered in Bhubaneswar. Both are in India. So section 12. In case of section 12, and we don't have any specific provision with respect to CA services. So general provisions. As per general provisions, B2B. So location of recipient will be taken as the place of supply. Then number 3, ABC. What is the location of recipient here? Bhubaneswar, Orissa will be taken. Then ABC Limited of Patna imported certain goods from XYZ Incorporation of USA. The goods were imported through vessel and delivery of goods was taken at Kolkata, whereafter the movement terminates and the goods are stored. So import of goods, section 11. Section 11, import of goods, we will take location of importer. So what is the location of importer? Patna. Even though goods are unloaded in Kolkata, but Patna will be taken as the place of supply. Then number 4, Mr. X registered in Guwahati has availed landline service from BSNL. The telephone is installed in residential premise in Kolkata and the billing address is office of X in Guwahati. So in case of, this is section 12, telecommunication services, and it is fixed line location where it is installed. So where it is installed, Kolkata it is installed, so that will be taken as the place of supply. Then number 5, Mr. X residing in Chennai is traveling with Indian Airline aircraft and is provided with movie on demand service for 100 as onboard entertainment during Delhi Chennai leg of Bangkok Delhi Chennai flight. So now in this case, first it is 12 or 13, 12. So in case of 12, services on board a conveyance, we need to take starting point of the conveyance. Even for 13 also the provision is same. Starting point of the conveyance is Bangkok. So even though he is starting, that person is starting in Delhi, but the starting point of the conveyance is Bangkok. So Bangkok will be taken as the place of supply. Then Mr. X of Kolkata purchased online tickets for Aquatica Water Park in Mumbai. So Aquatica Water Park location is Mumbai. So this is section 12, admission to an event or place. Location of that event or place will be taken as place of supply, that is Mumbai will be taken as place of supply. Then Mr. Z An unregistered person of Kolkata sends a courier from New Delhi to his friend in Chennai, Tamil Nadu while he was on a trip to New Delhi. So section 12. Section 12, transportation of goods. Is it India to outside India? No. Other cases, B2B or B2C? B2C. So B2C, starting point of the goods will be taken. What is the starting point of the goods? So from where to where? New Delhi. So New Delhi will be taken as place of supply. Then point number 8. Mr. X, a registered person in Ranchi, Jharkhand, buys shares from a broker in Patna on NSE Mumbai. Determine the place of supply of brokerage service. Section 12. Section 12, intermediary services. We don't have any specific provisions, so general provisions. So we will take location of recipient. What is the location of recipient? Ranchi, Jharkhand will be taken. Then 9. XYZ Limited, New Delhi, entered into contract with Indian Airline for supply of biscuit packets for further supply by airline to the passengers in Kolkata Guwahati route. The biscuits were loaded on board in Lucknow. So section 10, 1E. So supply of goods on board a conveyance, loading point of the goods. What is the loading point of the goods? Lucknow will be taken as the place of supply. Okay. And suppose if they are asking what is the place of supply in case if the goods are sold to the airlines, selling it to passengers, location where the goods are loaded. Suppose if it is goods sold to airlines, what is the place of supply? In that case, 10-1A ending point, then also Lucknow, because we are ending, goods are ending in Lucknow. So Lucknow will be taken as the place of supply. So that is with respect to this. And so it's not difficult. Only thing, it requires little bit of revision, and a number of times you need to revise this, easily you will be able to remember. But I don't think so. Now questions will be that much asked on place of supply directly on these provisions, because already it is tested. But rules are not yet tested. So on rules there are chances. So rules are basically requiring apportionment, because in rules what we basically determine is that, so whenever there is some value and which is common between two or three states, we need to apportion that value between these 2 or 3 states, because the place of supply is more than one state. So for that purpose, and first we will start with rule 3. So when rule 3 will be applicable? Rule 3 is applicable in case of advertisement services provided to government. In case of advertisement service provided to government, so in case of section 13 we don't have any specific provisions, so general provisions. In case of section 12 it says each state where the advertisement is provided will be taken as place of supply. And what if the advertisement is provided in more than one state via a single contract? So then in that case the contract amount needs to be apportioned between the states. Suppose if the advertisement is in railways, so train, then we need to take it on the length of the track in each state. So then suppose if it is on the tickets, railway tickets, then we need to see number of stations in each state and we need to apportion that. And suppose if it is on TV channel, we need to make two apportionment. First we need to apportion it between the channels. And after apportioning between the channels, how we will apportion between the channels? Based on BARC viewership data, and that data of the previous quarter last week should be taken for the purpose of apportionment. And thereafter, so if the particular channel is being telecasted in more than one state, how will you apportion? Based on population census. So therefore first apportionment is between the channels based on BARC data. Second apportionment is between the states based on population. Okay. And then suppose if the advertisement is on internet, so and there is no separate, see all this rule 3 will be applicable only when we don't have separate information in the contract as to how much amount is for which state. Suppose if we have clearly the amount 4 lakhs for this state, 10 lakhs for this state, like that, we will not apply rule 3. So for that amount mentioned in the contract, that particular state will be taken as a place of supply. Only when we don't have state specific information in the contract, then we will apply this rule 3. Advertisement over internet, so deemed to be across the country, and we need to apportion across all states and union territories on what basis? Internet subscribers databases. And then we have through SMS. In case of SMS, so how the apportionment will be? Based on telecom subscribers data. Who will be giving telecom subscribers data? TRAI will be giving telecom subscribers data. Based on that we need to do the apportionment. So that is this 5. Apart from this, any other mode of advertisement, that is advertisement in cinema theatre or advertisement in FM channel or advertisement in hoardings, advertisement in newspapers or any other mode of advertisement, we need to take the expenditure ratio. Suppose I am getting money from the government, contract revenue. So now my revenue I need to recognize based on my expenses. For example, so for the purpose of keeping some hoardings, I am receiving money from the government. Now, what is the cost of each hoarding? To keep each hoarding or to place advertisement in that hoarding, what is the cost? So, in my cost ratio, I will apportion my revenue. So, therefore, on what basis we need to apportion? In any other case, it is amount payable ratio, that is expenditure ratio. Then rule 4 and rule 8 is applicable in case of service in relation to immobile property, and that immobile property is in more than one state. Suppose if it is accommodation services, we need to take number of nights stayed in each state. That should be taken as a ratio for apportionment. And suppose if it is accommodation in a houseboat or vessel, time spent in each state. So that is, you are boarding a houseboat in one state and you are getting down in another state. So time spent in each state, standard time will be taken for apportionment. Suppose if it is any other service in relation to immobile property, for example, now say you are providing some repairs and maintenance services. That repairs and maintenance service in relation to some chain of hotels, and they have hotel in different states. So now what we need to do, we need to see the carpet area. We need to take the carpet area for apportionment and we need to divide that. And suppose if it is one hotel which is located in such a highway wherein partly it will come in one state and partly it will come in another state. So again we need to apportion based on the floor area. So that is this. Next, in case of rule 5 and rule 9, so that is organizing an event. Organizing an event, we need to take expenditure ratio. That is, for example, wide a single contract if I am organizing event in more than one location. Now say I am organizing event in 4 locations: Karnataka, Tamil Nadu, Andhra Pradesh and Kerala. So now what I need to do, I need to take my expenditure ratio. For conducting one event in Karnataka, how much expenditure? For conducting one event in AP, how much? Tamil Nadu, how much? Kerala, how much? So therefore my revenue I will apportion based on my expenditure. So that is generally accepted accounting principle, that is expenditure ratio. Then rule 6. Rule 6 will be applicable in case of this fixed line services, telecommunication fixed line services. So location where the equipment is installed. What if wide a single service? So if it is a lease line service and the equipment is installed in multiple locations, so then we need to take number of circuit points in each state and we need to apportion, because lease line connects multiple branches of a particular company. So then in that case, in each state, how many circuit points are there? So based on that circuit points, we need to apportion. Then in case of rule 7, rule 7 is performance based service in relation to goods and individual. So in relation to goods, section 13, what will be taken as a place of supply? Location where service are actually performed. What if it is performed in more than one state? So then in that case, check whether the goods are same goods or different goods. For example, I have provided one AMC services to one company, to one foreign company in relation to their computers in different offices in India. So then in that case, all offices I am doing AMC with respect to what? Same product, that is computers. So therefore my AMC revenue I will equally divide between all the states. Is it clear? For example, they have offices in 3 states. Now I have got 9 lakh rupees as AMC charges. So 9 lakhs divided by 3, that is 3 lakhs will be taken as each state. You understood? Then suppose if it is different goods, which means that in one branch I need to do AMC with respect to computers. In another branch I need to do AMC with respect to ACs. And in yet another branch I need to do AMC with respect to data center. So now in that case what I need to do, invoice value of computers is to invoice value of air conditioners is to invoice value of data center. So based on that my AMC revenue 9 lakhs needs to be apportioned between these 3 states. So therefore if it is on different goods, invoice value ratio. Services, performance based service in relation to individuals. So what will be taken as the apportionment? So like generally in case of performance based service in relation to individual, location where service actually performed. But what if it is in more than one state? So then we need to apportion again GAAP ratio, that is expenditure ratio. Then so these are the rules related provisions that we have, and Definitely I am expecting at least in MCQ somewhere it should be tested, so that rules related, and if possible, if your time is good, so they can ask a question on practical question also, and it is like a jackpot only, like just like overhead apportionment or ABC kind of question only. Everything will be there in the question itself. You need to know what is the basis of apportionment. You need to just take the data, do the calculation and arrive at the answer. Okay. Then clarification through circulars. So we have some circulars related to place of supply. Say this, that is related to export of services. So generally what should be taken as the value of export of service? Concentrate. You are located outside India. I entered into contract with you to provide the services, and what is the contract price? $5,000 is the contract price. I entered into contract with you to provide the service. Where you are located? Outside India. Where I am located? In India. Okay. Now either I can do the services completely to you, or I can get it done through a third person also. Now I identified one third person who is outside India, and the third person has provided some services to you, and I provided some services to you. So therefore whatever the third person has provided services to you is to the extent of $2,000, and I provided services to you to the extent of $3,000. So total contract price is for what? $5,000. Now what you did is that you paid me $3,000 and you paid the third person $2,000. Okay. So for you it is 5,000 cash outflow and $5,000 you have paid. So but the problem came here with the GST department that, so I have raised invoice to you for how much? $5,000, but how much I received? Only $3,000. So GST department is asking me that you realized only $3,000, so the value of export of service is only $3,000. But my argument is, had I received 5,000 and then I have given $2,000 to the third person, so then also I will have $3,000 only now in my hand. You understood? So rather than doing it, I directly asked my recipient to pay the $2,000. So for that, CBIC gave a circular in favor to that person stating that yes, export of service is $5,000. However, the $2,000 which the third person has received will be like a import of service. How? First I am exporting service to you, and I am receiving service from the third person outside India, which means $5,000 is export of service, provided on $2,000 you treat it as import of service and pay IGST under RCM. Okay. So that is this circular. Then next, cargo handling services. In case of cargo handling services, whether we need to treat it like warehousing services or we need to apply the general provisions. If it is warehousing service, it will become service in relation to immovable property. Then location of immovable property will be taken as place of supply. But cargo handling services, even though custodian of the goods, after import of the goods will keep the goods in his place, but he is not providing any cargo handling like storage services, but he acts as a custodian of that goods. So therefore it should not be treated as service in relation to immovable property, but rather it should be general provisions. So therefore location of recipient will be taken as place of supply. That is this. And next, number 3, in case of testing on the sample prototype, say there is one product and that product has been imported into India, and that product works on a software. So now you are doing the testing on the software. So testing on the software, that software is used for working of this product. Okay. Now is it performance based service in relation to goods? No, actually we are not doing anything on the product, but we are testing the software. Testing the software means it will not come under performance based service in relation to goods. Therefore it should be again general provisions only, because we don't have any specific provision. Suppose if you are doing any work on the product that is imported, you are not doing any work on the product imported, you are doing work on what? On the software with which the product will work. So therefore product also imported, software also it came along with the product, but you are testing on the software only. So therefore it should be general provisions. Then this fourth point already we discussed. In case of cutting and polishing activity in relation to diamonds etc., which is imported and exported after cutting or polishing, so we will apply performance based service in relation to goods, exception number 1. Therefore location of recipient will be taken as the place of supply. Then Section 13 subsection 6 overrides other provisions of section 13. That is, there are total 4 cases you take. That is service in relation to immobile property, performance based service in relation to goods, and performance based service in relation to individuals and organizing an event. In all these 4 cases, place of supply, if it is in India, then India entirely it will be taken. Suppose if for entirely if it is provided outside India, place of supply will be outside India, because in case of service in relation to immobile property, location of immobile property is place of supply. In case of performance based service in relation to goods, location of performance will be taken. Even for individuals, location of performance. Organizing an event, location of event. Suppose if it is fully outside India, then outside India will be taken. What if it is partly in India, partly outside India? Void a single contract. Then for entire amount, the place of supply is deemed to be India. Okay. So these 4 services, partly in India, partly outside India, entirely it is deemed to be provided in India. So that is with respect to place of supply we completed, and section 14, like that one section is there. That section 14 is related to OIDR services, which already we have seen in exemptions. That is, in case of import of OIDR services, liability to pay GST is on supplier under FCM if it is imported by non-taxable online recipient, and who is taken as the supplier outside India for payment of GST. It is the original supplier or the intermediary through which the supply is being made. For example, Netflix. And Netflix, thereafter we have Play Store or App Store through which you have downloaded the Netflix app and you are streaming the videos. So now in that case, who is the intermediary outside India? Play Store or App Store. And who is the supplier outside India? Netflix. Who will be paying GST? So liability to pay GST is on, primary liability is on Play Store. Play Store or App Store, intermediary outside India. But if they are not collecting the money, money is directly collected by the original supplier, then the original supplier will be having liability to pay. Otherwise, who will have the liability to pay? Intermediary. Why they kept it that way? Because it is easy to identify and tax the intermediary rather than the original supplier. You are downloading a game. When you are downloading a game, there is a game developer outside India and Play Store or App Store also outside India. Now you make some payment of charges. So these charges are collected by App Store or Play Store, yes. So then who is liable to pay GST? That App Store or Play Store only liable to pay GST because they collected the money. So primary liability is on whom? Intermediary outside India. If intermediary outside India is not collecting money, but original supplier is only collecting, that original supplier only will pay GST. Because FCM only, both cases FCM only, but in FCM also, who is that supplier who will pay GST is what is given in section 14. Then the next area that we are moving on to is segment 5, value of supply. So value of supply is actually a small topic only, but in this, so definitely the questions are guaranteed. And long time due on this rule 32. So they have not asked questions for last 2 attempts. So last attempt it is not asked. So I think on rule 32 on rules there is a chance. And value of supply as such per se, they will not be asking a standalone question, but regular question involving computation of GST payable, net GST payable, there they will be connecting this value of supply. Okay, fine. Section 15 is the only section that we have here. So because up to section 14 we have seen in time of supply, invoice and time of supply. Section 7 is supply, section 8 is composite supply, mixed supply, section 9 is liability to pay GST, section 10 is composition scheme that we have not yet discussed, section 11 is exemptions that we have completed, then 12, 13, 14 is time of supply, and 15 is value of supply. So section 15 subsection 1 says that the value of supply will be taken as the transaction value. What is transaction value? Price involved in the transaction, that is price actually paid or payable, will be taken as the transaction value, provided 2 conditions are satisfied. What are those 2 conditions? Price must be the sole consideration, supplier and recipient are not related, and related already we know. And what is the meaning of price must be the sole consideration? Means apart from price we should not be getting any other consideration. For example, in case of exchange transaction, price is not the sole consideration. For example, we are giving one new product and in exchange we are getting a old product and some differential amount of say 25,000 rupees. So that 25,000 rupees is not the sole consideration because we are also getting one old product. So due to that reason, when price is not the sole consideration, transaction value not applicable. Then in that case, what we need to do, we need to determine the value as per CGST rules. And in 15 subsection 2, we have some inclusions. So supplier is making some supply of goods or service or both to the recipient, for which recipient will make payment for supply. So that payment is only called as transaction value under section 15. So to this transaction value, as per section 15 subsection 2 clause A, all taxes, duties and cess by whatever name called other than GST should be included. So therefore, while computing GST, we need to ensure that all other taxes are added and finally it will be GST. That is 15.2a. Then 15.2b says that any amount that the supplier is liable to pay but which is paid by the recipient on behalf of the supplier. So then it should be included in the value. Means recipient is incurring the expenditure on behalf of the supplier. So then it should be included. What if recipient is incurring the expenditure on his own account? That will not be included. For example, if the contract is ex-factory contract, ex-factory contract means I have to deliver the goods at my factory gate. Now you need to take care of transportation and you have paid some transportation charges. Will that be included in my value? No. So any expenditure incurred by the recipient on his own account will not be included in the value. Then 15.2c is that any expenditure incurred by the supplier and recovers it from the recipient. So this expenditure incurred by the supplier and recovered from the recipient when, if it is before delivery of goods or before supply of services, then it should be included in the value. And here the expenditures are basically divided into two. So if it is expenditure incurred as a pure agent or in the course of supply. What is the meaning of expenditure incurred as a pure agent? First of all, that expenditure liability is on the recipient, but which is incurred by the supplier on behalf of the recipient, acting as a pure agent. Three things: liability of recipient, incurred by supplier as a pure agent of recipient. Okay. So when supplier will become pure agent of the recipient, 4 conditions should be satisfied. As per rule 33, 4 conditions should be satisfied for becoming a pure agent. So what are those 4 conditions for pure agent? Supplier should enter into agreement with the recipient. So first there should be an agreement. For example, I am a chartered accountant and you are approaching me for filing the income tax return. I filed your income tax return. I only paid you an income tax also, and I raised a bill to you. So that bill is return filing charges 15,000 rupees, income tax 7,000 rupees. So now in that case, whether that 7,000 rupees will be included in the value? No, 7,000 will not be included in the value. First condition, you should have authorized me to pay that 7,000 rupees. So first a contractual agreement wherein recipient authorizes the supplier to act as a pure agent. Second, I should recover only the actual amount incurred. Means how much I paid as income tax? 7,000. Means how much I should have recovered from you? Only 7,000. Supplier should not hold the title to the goods or service so procured. For example, I am providing you cab services, and for which the fare is 150 rupees plus toll charges 50 rupees. Now this toll charges 50 rupees, will it come under pure agent or not? We are applying. First agreement, yes, you are authorizing me to pay the toll charges. The moment you book the cab, terms and conditions, all terms and conditions you are accepting. So therefore you authorize me to incur the toll charges, and whatever is the actual toll charges, that only I am recovering from you. But the third condition is failed. Why? Because supplier should not hold the title to the goods or services so procured, because this toll receipt is in my name, supplier name, not in the recipient name. In car name only na the toll charges will be. So due to that reason, so therefore toll charges will not be coming under expenditure incurred as a pure agent. So the title should not be in the name of the supplier, and supplier should not use the said goods or service so procured for his personal purpose. Say for example, I am doing like one outdoor catering services, and you have to purchase all the goods required for catering. So therefore I will just do the cooking service. So now I came to your premises and there are some product, like one product is missing. Cashew nut you forgot to purchase. So therefore I am purchasing the cashew nut. You are authorizing me to buy. So 5 kgs of cashew nut I have purchased for making a dish 4 kgs I have used, 1 kg I took to my home. Okay. Now in that case, so that 5 kgs cashew nut expenditure will not come as a pure agent, because out of that 1 kg I am eating. So therefore, supplier should not use the said goods or service so procured for his personal purpose. So these are the 4 conditions that should be satisfied to become a pure agent. Number 1, contractual agreement to act as a pure agent. Only the actual amount incurred should be recovered and should not hold any title with respect to the goods or service so procured, and should not be used for the personal purpose of the supplier. So then that expenditure incurred as a pure agent will not be included in the value. Now suppose if it is not expenditure incurred as a pure agent, the balancing figure is in the course of supply. So first you need to, the moment you see any expenditure, what is that you need to apply? Is it pure agent? Yes, then it will not be included. No, then it is in the course of supply. Now again that will be divided into 2. That is it incidental expenses or other expenses? If it is incidental expenses, which means without incurring that expenses the supply cannot be made, then it will be called as incidental expenses. Incidental expenses should definitely be included in the value whenever it may be incurred. It may be incurred before delivery or it may be incurred after delivery. For example, as per contract I should do the installation, and that installation as per the contract I should only do. So which means that it is incidental. So therefore, installation is done when? After delivery of the goods. Even then it should be included in the value. So any expenditure without incurring of which the supply cannot be made is known as incidental expenses. Is it clear? And that incidental expenses should be included in the value. Yes, always it should be included in the value whenever it may be incurred. Whereas other expenses means what? Even without incurring the expenses the supply can be made. That is other expenses. That other expenses again divided into 2. When is it incurred? Before or at the time of delivery or after delivery, or before at the time of supply of service or after supply of service. If it is before or at the time of delivery of goods or before at the time of supply of services, then it should be included in the value. If it is after delivery of goods or after supply of services, then it will not be included in the value. For example, packing charges, incidental, definitely include it in the value. Installation as per contract, incidental, so definitely include it in the value. Whereas we have transportation. Transportation is not incidental, it is others. And what is the type of contract? The type of contract is door delivery contract. A 4 contract means I need to deliver at your place. So then the transportation should be included or not? Yes, transportation should be included because it is before delivery. And what if it is ex-factory contract? And I incurred the transportation charges. Will it be included? No. Why it will not be included? Because it is after delivery of the goods. So then it will not be included. It will not be included means we are not required to pay GST at all on that. Not that means. So not included means not included in this product. If it is not included in this, then it will be treated as a separate transaction. Separate transaction. It does not mean we don't have to pay GST. Not included in this value of the product or value of supply. Then next, so that is about rule 15.2c. Then 15.2d, interest, late fee, penalty for delay in receipt of consideration should be included in the value. And so this 15.2e, subsidy, the next point is 15.2e, that is subsidy received by a supplier. Section 15 subsection 2 clause E, subsidy. Subsidy is divided into 2. Directly linked to the price, not directly linked to the price. Directly linked to the price means subsidy is based on outward supply. Means for every product sold, for every service rendered, like that when the subsidy is given directly into the price. And subsidy not directly into the price means irrespective of the outward supply, we will be getting that subsidy. Means this subsidy is no way connected to our outward supply. So for the purpose of some reason we will be getting, like to set up one a waste treatment plant or to set up a library, like that. So for one reason we will be getting this subsidy. And not directly into the price means it is no way connected to the price, so therefore it should be ignored and not considered in value. Then what is the treatment of this subsidy? So we need to treat it like donations, conditional donation or unconditional donation, depending upon that it will be treated. So conditional donation means treated as consideration, it will become supply under 7(1)(a). Unconditional donation means not a supply, ignore it fully. Okay. Then suppose if it is directly linked to the price means this subsidy is having an impact on the price. Now is it from central government or state government or others? If it is from central government or state government, it is to be excluded from the value. If it is from others, then it should be included in the value. Generally, subsidy has got two treatments, that is directly linked to the price, not directly linked to the price, that is okay, but whether it is directly linked to the price and whether you considered that subsidy while arriving at the price or not. So there are two views which are possible. So view 1 is price after considering subsidy, means the given price is after considering subsidy. When you consider the subsidy, what will happen? We will reduce the subsidy from the given price. Okay, so which means let x be the price, some price, let x be the price. From that x, whatever is subsidy given in the question, we have reduced and we got the given price. Is it clear? The given price in the question is after considering the subsidy, means let x be the price. From that x we reduce subsidy and we got the given price. That is view 1. Whereas view 2 is price without considering subsidy. Price without considering subsidy. Price without considering subsidy means that x itself is the given price. That x itself is the given price and we have not reduced any subsidy. Okay. Now, when we have these two views, like which view should be taken in the absence of information in the question? View 1 should be taken. View 1 only should be taken in the absence of information in the question, and so view 2, if it is clearly given in the question, price without considering the subsidy. Now say for example the given price is 15,000 rupees. The given price is 15,000 rupees. Now how it's going to differ, we are going to see. First one is subsidy from central government. Subsidy from central government, that is 6,000 rupees. So now while arriving at this 15,000, we reduce this 6,000 rupees. As per provision, this 6,000 rupees is to be included or to be excluded? To be excluded. In the given price, it is already excluded. So therefore, we will ignore it. We will not consider it. Whereas here, if you see, while arriving at the given price, this subsidy 6,000 is not reduced. Means this 15,000 rupees is without reducing the subsidy of 6,000. And then what is the treatment of this 6,000 rupees? Is to be included or to be excluded? To be excluded. In the given price, it is not excluded. So we need to deduct. So 6,000 we need to deduct. And then next one, subsidy from a NGO. Number 2, subsidy from NGO. This subsidy from NGO is say 4,000 rupees. Now, what is the treatment of this 4,000 rupees? So, this 4,000 rupees is to be included. And here, when you take this view, so means this 4,000 has been already reduced to arrive at 15,000 rupees. So, this 4,000 rupees is to be included. In the given price, it is not included. So, therefore, we need to add 4,000. Whereas here, this 4,000 rupees is to be included. In the given price, it is already included. So therefore, we will ignore. Then what will be taken as the value in this case? So first case, it will be 19,000, and the second case, it will be 15 minus 6, 9,000 will be taken. So why there will be difference in answer? Because of the difference in assumption that we have taken. So therefore, if the question is silent, consider the given prices after reducing the subsidy amount. Only for subsidy this kind of situation will arise, because subsidy is a income which we are going to get from a third person. All others are expenses which we incur and we collect it from the recipient. But subsidy is something which we will get from a third person. So that's the reason why we have a different treatment related to subsidy. Then this note is one circular related to passenger service fee and user development fee. So airports will be collecting passenger service fee and user development fee for providing the services to the passengers by way of accessing the airport. So because airport will be giving lot of facilities like internet facility, AC, then like stay, and even lounges will be there. So water facility will be provided. So for providing all these facilities, so they need some revenue, na? So that revenue is called as user development fee or passenger service fee, but directly they cannot collect it from the passenger. So they collect it from the airlines, and airlines will in turn collect it from the passenger and remit it to the airport. So now this airlines which is collecting PSF or UDF from the passenger and remitting it to the airport, will it come under expenditure incurred as a pure agent? Yes. So therefore that will not be included in the value. Passenger service fee and user development fee collected by airline operators from passengers are to be remitted to the airport operator and falls under expenditure incurred as a pure agent. Then next one, exclusions from value of supply, section 15 subsection 3. So only one exclusion is there, that is discount. Discount is divided into 3. Discount given before supply, discount given after supply and terms are agreed before at the time of supply, discount given after supply and terms are not agreed before at the time of supply. So pre-supply discount and post-supply discount. Pre-supply discount is always allowed as deduction. So while preparing the invoice itself, they will be giving the discount. So therefore, for example, 10,000 rupees is the price of the product and 1,000 rupees is given as a discount, which is the pre-supply discount. Then 10,000 minus 1,000, so 9,000 rupees. On 9,000 only GST will be payable. So pre-supply discount is allowed as deduction. Whereas post-supply discount again divided into 2. Is it agreed before or at the time of supply? If it is agreed before at the time of supply, then also it will be allowed as deduction. But how it works is that first invoice is already prepared. So then in that case, what they will do, they will be giving a credit note. So in that credit note, so they will reduce the discount what they wanted to offer. Because of credit note, what will happen to the supplier? Supplier's liability will come down. So that is the advantage of post-supply discount, but the terms are agreed before at the time of supply. Because of credit note, what will happen to the recipient's ITC? ITC gets reduced, means reversed. You understood or not? So because say for example, I raised an invoice to you for 10,000 plus 1,200 here, then for me liability will be 1,200, for you ITC will be 1,200. Now I am offering a discount of 5%, means 560 rupees, 500 rupees plus 60 rupees. To the extent of 60 rupees, my liability will come down, and the same way to the extent of 60 rupees, your ITC 1,200 also will come down. So therefore, this is only that point. So discount given after supply and the terms are agreed before at the time of supply, it is allowed as deduction. Credit note shall be issued and recipient should reverse the proportionate ITC. Then next, what if the discount is given after supply and terms are not agreed before at the time of supply? This discount is not allowed as deduction. Means credit note can be issued? No. Credit note cannot be issued. Then whether GST is payable on the full value? Yes. Even though the supplier receives only the reduced value, but GST is payable on the full value. For example, I am giving you a post-supply discount of 50% and terms are not agreed before at the time of supply. 1 lakh rupees. Even though you pay 50,000 rupees, but I have to pay GST on 1 lakh. Then whether GST is applicable on additional or penal interest on the overdue loan. Now we need to understand this interest. Already we know that interest is divided into 2. Interest on loans, advances, deposits, which is exempted. Interest on account of delay in receipt of consideration, that will be included in the value and chargeable to GST accordingly. Now here suppose if there is a interest which is exempted. So for non-payment of that interest, some interest is collected, penal interest. For example, housing loan installment is, housing loan installment, interest is exempted, correct? Why? Loans are advances. Now for non-payment of an installment on housing loan, some penal interest is levied. That penal interest is also exempted. If the main interest is exempted, penal interest also exempted. If the main interest is taxable, penal interest also taxable. Suppose credit card. Credit card you converted into EMI. In every EMI there will be a interest component. So now in that case, so that particular interest component is taxable na. So non-payment of that EMI, some penal interest is levied. Whether that penal interest also taxable? Yes. So what we need to understand is that if the main interest is exempted, penal interest also exempted. If the main interest is taxable, penal interest is also taxable. And here one more point, hire purchase transaction versus hire purchase financing is taken to explain the difference. Hire purchase transaction is that generally the hire vendor only will be collecting the money from the hire purchaser and in installments. Now this is called as consideration paid late. So therefore interest on account of delay in receipt of consideration, and this interest will be taxable. So non-payment of installment in hire purchase transaction leads to a penal interest. That penal interest is also taxable. Whereas if it is a hire purchase financing, there are three parties: hire vendor, hire purchaser and a financier. So you will not pay installments to me, but you will pay installments to the financier. So now if you repay the installment, in every installment there is interest component, that interest is exempted because he is giving you finance facility. So that is exempted. Now non-payment of installment, the financier will levy a penal charges. Whether that penal charges is also exempted? Yes. As the main interest is exempted, that penal interest is also exempted. Then treatment of inclusions or exclusions in the given price. So first you need to check as per provision it is to be included or to be excluded. Suppose as per provision it is to be included. For example, packing charges to be included. In the given price it is already included. So ignore. Then second, in the given as per provision it is to be excluded. For example, GST is to be excluded. Okay. And in the given price it is already excluded, excluding GST. Then also you will ignore that. Then an amount is to be included. For example, transportation charges or freight charges is to be included. In the given price it is not included. So we need to add. Then an amount is to be excluded. Say subsidy from central government or state government is to be excluded. In the given price it is not excluded. So therefore we will deduct. So these 4 points we will be applying to arrive at the answer. Then we need to give the explanations properly here whenever we are arriving at the answer using valuation. So 15(2)(a), 15(2)(b). So that also easily you can remember. So remember a keyword TRSIS. TRSIS. Okay. Section, you know, T Rajender, who is known for sister sentiment. Okay. TRSIS. Section 15(2)(a), 15(2)(b), 15(2)(c), 15(2)(d and 15(2)(e). Okay. What is T? Taxes, duties and cess, whatever name called other than GST. R, recipient incurring expenses on behalf of supplier. Yes, supplier incurring the expenses and charged it to recipient before delivery or supply of service. I, interest, late fee, penalty for delay in receipt of consideration. Yes, subsidy from other than CGRSG directly linked to the price. Okay. So properly with this clause subsection you have to write. Okay. 15(2)(a), 15(2)(b), 15(2)(c), 15(2)(d and 15(2)(e). Then we will see why he will not give marks. Okay. He has to give here because along with clause you try to write this valuation alone, because justification should be properly given. So how to give the justification? Simple. First you write the provision. As per that provision it is to be included. Then in the given price what they did, this table, no, this table you just convert into English. Okay. So you have to write it in theory descriptive. So that is as per provision, that as per section 15(2)(c), packing expenses are incidental and it is to be included in the value. In the given price such packing expenses is already included, therefore further inclusion shall not arise, like that. Okay. Then we have rules related to valuation. So when rules will be applicable? Transaction value is not applicable. When transaction value is not applicable, price is not sole consideration, supplier and recipient are not related. If price is not sole consideration, then rule 27. If supplier and recipient are related, then rule 28. But we have distinct persons also in rule 28. In case of distinct persons, won't the transaction value be applicable? Applicable, but even then we need to determine the value as per rule 28 only, because section 15 subsection 5 says that, so whenever there are some notified transactions for which valuation is specified, so we need to determine the value as per rules only as prescribed. So therefore, because 15 subsection 5 starts with notwithstanding anything contained in 15.1 and 15.4. So which means that 15.5 says, for example, distinct percent, we have a rule. Means distinct percent, that rule only will be applicable even though transaction value is applicable. Same way, rule 29, principal agent transaction. Even though transaction value is applicable for principal agent transaction, we need to apply rule 29 only. So 27 is price is not sole consideration. 28, related party transaction or transaction between distinct persons. 29, principal agent transactions. So in case of 27, when price is not sole consideration, so whether it is applicable for both goods and services, yes, both goods and services. First we need to take open market value. If open market value is not ascertainable, money received plus money value of non-monetary consideration. If that is also not ascertainable, then like, kind and quality. If that is also not ascertainable, then cost plus 10%. What is the difference between open market value and like, kind and quality? Open market value is between two unrelated buyers on the two unrelated persons on the same date. So you can see there comparable time. Comparable time should be open market value same day. Means for example, I am selling one product to you and in exchange of an old product and you are giving me some price differential. Okay. So now in that case, open market value today, same day. So today between two unrelated parties, this product is sold at a price. So that will be taken as the open market value. And suppose if the open market value is not ascertainable, then only we go for money received plus money value of non-monetary consideration. If that is also not ascertainable, then LKQ. LKQ, the comparable time can be any nearest date, not necessarily the same date in which the transaction happens. Comparable value, open market value should be transaction value, but like, kind and quality can be transaction value or value determined under rules. Last month also some transaction happened like this. At that time we determined the value as per rules. Can that be taken as value for this month? Yes, we can do. That is the meaning. And number 3, comparable supplier. In case of open market value, it is the same supplier or any other supplier, but LKQ it will be same supplier. Comparable goods, in case of open market value, same goods. In case of like and quality, same goods, but minor differences is also acceptable. For example, color differences or little bit of feature differences, etc. that is acceptable. Then, so we need to first take open market value, if not money received plus money value of non-monetary consideration. Why open market value not possible? Because on that particular date between two unrelated buyers, we are unable to identify the price. So that's why open market value not ascertainable. Okay. Money received plus money value of non-monetary consideration. Why this is not ascertainable? Because this money value of non-monetary consideration cannot be determined. If then we will go for like, kind and quality. Like, kind and quality also why not available? Such kind of goods are not sold at any nearest date. So then in that case, finally cost plus 10%. Cost plus 10% is given under rule 30. Rule 30. And what should be taken as cost? If you are a manufacturer, we need to take cost of production. If you are a trader, you need to take cost of acquisition. If you are a service provider, you need to take cost of providing the service. And in the second point will be missing. So second point will be missing, correct? So open market value, like, kind and quality, cost plus 10%. Okay. So what is that second one? Transaction between related parties and or distinct persons. So we don't have money received plus money value of non-monetary consideration, just 3. Open market value, like, kind and quality, cost plus 10%. Again in the third point will be missing. Okay. So that is open market value, cost plus 10%. Understood or not? So first 4 points, what are they? OMV, money received plus money value of non-monetary consideration, like, kind and quality, cost plus 10%. Second point is rule 28. In that rule 28, second point will be missing. Open market value, like, kind and quality, cost plus 10%. In third point, that is rule 29. So LKQ, third point also missing. So open market value, cost plus 10%. And then in case of 28, open market value, what should be taken as open market value? So if the recipient is eligible for full ITC, open market value is deemed to be the transaction value. So that is when recipient is eligible for full ITC. If you are the recipient, your outward supplies are exempted. Are you eligible for full ITC? No. Your outward supplies are partly taxable, partly exempted. Are you eligible for full ITC? No. Means your outward supply is fully taxable, then you are eligible for full ITC. So then in that case, whatever value that I declare, that will be taken as a transaction value. Even 1 rupee also can be declared as transaction value. That itself will be taken as the open market value. Is it clear? Suppose if recipient is not eligible for full ITC, then open market value needs to be ascertained. Then alternatively, that is without applying this, for rule 28, we have alternatively one point, that is 90% of the resale price. That is, I am selling to you, you are my related person, I am selling to you. You subsequently sell to an unrelated buyer. That subsequent sale to an unrelated buyer into 90% will be taken as my value. Means the logic is what? You will be adding 10% profit and you will be selling. So therefore, whatever is the resale price into 90% will be taken. But this resale price into 90% is applicable only in case of goods. Only in case of goods, and that too you are not selling it after processing. Means you are selling it as such. You are selling it as such. Recipient should not process those goods but should have been sold it as such. And this rule 28 is applicable in case of both goods and services. Next, principal agent transaction. Principal agent transactions is applicable under rule 29, and here it is OMV or 90% of resale price at the option of the supplier. And principal agent transaction is applicable only in case of goods, and OMV or 90% of resale price at the option of the supplier. If this is not possible, then only cost plus 10%. Suppose if this value is not possible, even cost plus 10% also not ascertainable, then value will be determined by GST officer, that is residual value, rule 31. And in rule 30, for cost we will be taking cost of production in case of manufacturer, cost of acquisition in case of trader, and cost of providing service in case of service provider. And this open market value is deemed to be the transaction value. I told you that even 1 rupee invoice also can be taken. In such case, invoice can be generated for any value, even 1 rupee invoice can be considered. Then in case of services, we can skip rule 30 and can proceed to rule 31, because cost of providing the service will be difficult to determine. Then this is the GST implications on debit note and credit note. Already we have seen that in time of supply. So it's a continuity point. So whenever debit note is issued, who will be giving debit note? Supplier to recipient. Whenever recipient has to pay an amount extra than the invoice value, and invoice value increases, so then debit note. So because of debit note, what is the consequence to the supplier? Increase in liability. So where supplier has to report this? GSTR 1 and GSTR 3B. And what is the consequence of debit note to the recipient? Increase in ITC. So where recipient has to report that? Only in 3B. Only in 3B he will take the ITC based on debit note. Then credit note. Credit note, who will be giving to whom? Supplier to recipient, when there is a reduction in the invoice value. And is there any time limit for issuance of credit note? Yes, 30th November of next financial year or date of filing annual return, whichever is earlier. What is the consequence of credit note to the supplier? Decrease in liability. And where the supplier has to report it? In GSTR 1 and GSTR 3B. And what is the consequence of this to the recipient? There will be reversal of ITC. If he has ITC balance, it will get reversed. If he is don't having ITC balance, it will be added to the liability, and it will be reported in 3B under reversal of ITC. Then we have rule 31A, that you see, rule 31A. So up to rule 31 we have seen. Rule 27, in case of price is not the sole consideration. 28, related party including transaction between distinct persons. 29, principal agent transactions. 30, cost plus 10%. 31, residual value. 31A, value of supply in case of lottery, betting and gambling transactions. So see page number 55. In case of lottery, betting and gambling, so we need to take face value of the ticket or price notified by the organizing state, whichever is higher, and this particular price should be assumed to be inclusive of GST. So into 100 divided by 128 is value, into 28 divided by 128 is GST. So price printed on the ticket or price notified by the organizing state, whichever is higher, should be taken. In case of betting and gambling transactions, the total bet value should be taken as the value, and on the GST will be payable on inclusive basis, not the commission earned by the totalizer. Say for example, if 1000 people are placing the bet, and so in that 600 people place the bet in favor and 400 people place the bet against, okay, odds in favor, odds against. Now in that case, so all 1000 people will pay the money, so on the total bet value GST will be payable, and thereafter commission will be deducted and remaining amount will be given to the people who win the particular bet, okay, understood. So therefore total bet value means whether you are winning or losing, you pay money on the GST will be payable, so government will be winning, you understood or not. So how much will be the GST on that? 28%, and that 28% will be computed on a inclusive basis, okay. So that is this 31A. Now 32, come back. So 32 is applicable in case of 5 notified transactions. So what are those 5 notified transactions? In case of money changing, foreign exchange transaction including money changing, rule 32 sub rule 2 will be applicable, and air travel agent, rule 32 sub rule 3, and in case of life insurance business, rule 32 sub rule 4, and second hand dealer in goods, rule 32 sub rule 5, and in case of vouchers or coupons, rule 32 sub rule 6. These are the five cases. Foreign exchange transaction including money changing, and then we have air travel agent, life insurance business, second hand dealer in goods, and vouchers or coupons. And these 5 cases we have a simplified valuation methodology, and this is optional, not necessary that we need to follow this only. This should be compared between transaction value, either transaction value or value under this rule at the option of supplier. For each supply, each invoice they can decide, you understood. And therefore in exam also be careful, whenever they are asking the question on rule 32, they may give the transaction value information also. Now you need to check the transaction value information and this rule 32, whichever is beneficial only we need to select as the value of supply for payment of GST, okay. First, in case of foreign exchange transaction, what will be taken as a transaction value? Transaction value is nothing but the currency conversion fee or the markup fee that will be taken as a transaction value. That is, whenever you are giving some $100 and getting into Indian rupees, they will be deducting some amount as currency conversion fee or currency markup fee. That currency conversion fee or currency markup fee will be taken as a transaction value. So what will be taken as transaction value? Please write there. Currency conversion fee, or currency markup fee. Currency conversion fee or currency markup fee, that will be taken, okay. Currency conversion fee or currency markup fee will be taken as the transaction value as per section 15. Whereas what will be taken as a value under rule 32? In rule 32, again we have rule 32 2A option 1 and rule 32 2B option 2. Rule 32 2A says that one of the currency exchange involves Indian rupee and RBI reference rate is available on that day. For example, rupee per dollar is 80 and 83, and so $100 exchanged for rupees, $100 exchange for rupees, and RBI reference rate is 82 per dollar. Now what will be taken as the value? So simple, value will be, this is as per rule 32 2A. As per rule 32 2A, value, what will be taken as a value? First you need to determine which is the exchange rate. So they are exchanging $100, means they are selling dollars. Then what bank is doing? Bank is buying dollars. So then bid rate will be relevant, 80. 80 and 82, the difference is what? 2. So ignore that negative, ignore that positive or negative. So exchange rate is 80 and RBI reference rate is 82. So that is 2 into how many units of currency? 100. So therefore it will be coming to 200 rupees will be taken as the value. And suppose if RBI reference rate is not available, then what will be taken as a value? Then gross amount exchanged in Indian rupees. So $100 into rupees 80 per dollar into 1%. So that will be taken as a value, that is 80 rupees will be taken as the value. This is when if RBI reference rate not available. Then If RBI reference rate not available, so we will be taking this. Then if both the currencies exchange involves foreign currency, then what we will do, convert both the currencies into Indian rupees using RBI reference rate, multiply with 1%, whichever is lower. What if RBI reference rate is not available here? We cannot determine the value as per rule 32(2)(a). Then in that case, what we need to do? We need to take transaction value. What is the transaction value? Currency conversion fee or currency markup fee. Then rule 32(2)(b) is following a slab rate model. So what is that slab rate model? First we need to see the first slab up to 1 lakh. So up to 1 lakh, it will be 1% of gross amount. 1% of gross amount or 250 rupees, whichever is higher. Okay. And say for example 80,000 rupees. 80,000 into 1%, 800. 800 or 250, whichever is higher, 800. If it is 20,000 rupees, 20,000 into 1%, 200. 200 or 250, whichever is higher, 250. And exactly 1 lakh. 1 lakh into 1%, 1000. So 1000 or 250, whichever is higher, 1000. So therefore, when you are into the second slab, what is the fixed amount? 1000 rupees. And the second slab is up to 10 lakhs. So 1000 rupees plus 0.5% of gross amount exceeding 1 lakh. Gross amount exceeding 1 lakh. Say for example 8 lakhs. First 1 lakh it is 1000 and remaining 7 lakhs. 7 lakhs into 0.5%, 3500. 3500 plus 1000, 4500. And suppose if it is exactly 10 lakhs. For first 1 lakh it is 1000. Remaining 9 lakhs. 9 lakhs into 0.5%, 4500. 4500 plus 5000, 5500. So when you are into the third slab, the fixed amount will be 5500. 5500 rupees plus 0.1% of gross amount exceeding 10 lakhs. Exceeding 10 lakhs. Say for example, if the amount is somewhere 400 lakhs. For 400 lakhs, 10 lakhs it will be 5500. Remaining 390 lakhs. So 390 lakhs into 0.1%, that will be 39,000. 39,000 plus 5,500, that is 44,500 will be taken. But this is subject to maximum of 60,000. Subject to maximum 60,000. Say for example 800 lakhs. For 10 lakhs it will be 5,500. For remaining 790 lakhs into 0.1%, 79,000 plus 5,500, 84,500, subject to maximum 60,000. 60,000 will be taken as the value. That is the answer for this. So that is about 32(2)(a) and 32(2)(b). This 32(2)(a) and 2b, option 1, option 2, to be decided in the beginning of the financial year. So transaction value versus this rule 32, each invoice. But once you go for rule 32, in this case 32(2)(a) or 32(2)(b) is to be decided in the beginning of the financial year, which shall be applicable throughout the financial year. Then next, air travel agent. In case of air travel agent, what will be taken as a transaction value? Transaction value is the commission. Whatever is the commission that the air travel agent gets, that will be taken as the transaction value. Commission earned. Commission earned will be taken as transaction value. But in case of rule 32, we need to take domestic bookings and international bookings. In domestic bookings, we need to see what is the base fare. So 5% of the base fare in case of domestic bookings and 10% of the base fare in case of international bookings. Then in case of life insurance business, what will be taken as a transaction value in case of life insurance business? It will be premium collected. Transaction value is nothing but premium collected. And this rule 32, we have policies. Life insurance business policies are divided into 4. Risk premium or risk cover policy. In case of risk cover policy, it is like a term insurance. So entire premium will be treated as income to the insurance company. So therefore that will be taken as a value. Whereas single premium annuity policy, only one premium will be paid. So therefore 10% of that single premium. And if it is reinvestment policy, where amount allocated for investment is communicated to the policy holder, then how much is the premium collected minus amount allocated for investment. For example, 85% allocated for investment, the remaining 15% will become the value of the insurance company. Then if it is other policies, 25% of the first year premium and 12.5% of the subsequent year premium. Means those who took the policy this year, their premium into 25%. Those who already took the policy previous years, they will pay premium this year. On that it will be 12.5%. That will be taken as value. Then in case of purchase and sale of second hand goods, so the person is not purchasing new goods and selling old goods. So they are purchasing second hand goods, they are selling also second hand goods. Then in that case, what will be taken as the value? So the value, transaction value, if you see, the transaction value is nothing but the sale value will be taken. Transaction value is nothing but sale value should be taken. Say for example, if there is a person, second hand dealer in car, so that second hand dealer in car will be purchasing one car, second hand car, and will be selling cars, purchasing second hand car for 1,50,000 and selling the car for 2,50,000. Now what will be taken as the transaction value? 2,50,000. On the 2,50,000 GST payable, but under rule 32 we have a margin scheme. So under that margin scheme we need to take price as what? Selling price minus purchase price. So value will be selling price minus purchase price. That is margin scheme. But for example, in this case, 2,50,000 is the price at which it is sold. And what is the price at which it is purchased? 1,50,000. So 2,50,000 minus 1,50,000. 1 lakh will be taken as a value for payment of GST. But important condition is that ITC should not be availed on purchase. What if the margin is negative? For example, they are purchasing for 1,50,000 and it is sold for like say 1 lakh. Then in that case, purchase for 1,50,000, sold for 1 lakh. Should they take any value addition there? No. So therefore negative value addition, and that will be taken as 0. And even this margin scheme is applicable in case of repossession. So that is a financier who gives finance for a particular asset and he repossesses that asset. If the installments are not paid, that asset he will sell it off. In that case also margin scheme will be applicable. So selling price will be taken as the price at which the repossessed asset is sold. But what will be taken as the purchase price? Purchase price is like he did not purchase it, so he did not buy it, he repossessed it. So we need to take the original purchase price of the defaulting borrower as reduced by 5% for every quarter or part thereof. Means we need to give depreciation 5% for every quarter or part thereof from the date of purchase till the date of disposal of the repossessed asset. Okay, original purchase price minus 5% for every quarter or part thereof from the date of purchase till the date of disposal of repossessed asset. Then next, in case of vouchers or coupons, what will be taken as the value? So transaction value in case of voucher or coupon, so we have value equals to, so redemption, that is actual amount paid, So transaction value will be actual amount paid. For example, now I am purchasing one voucher. I am purchasing one voucher by paying 500 rupees, and that voucher, if it is redeemed, will get goods worth rupees 1,000. I purchased that voucher for 500, and this voucher, if I am giving to you as gift and you go and redeem that voucher, you can redeem it for what value of goods or services? 1,000 rupees worth of goods or services. So therefore, what will be taken as the value under rule 32? Money value of the supplies redeemable against such voucher or coupon will be taken. Okay. So this transaction value, actual amount paid, or actual value of actual amount paid or payable for goods or services, supplied. For goods or services supplied against voucher. Here transaction value as well as rule 32 value more or less the same. So how much ever is the actual amount paid or payable for the goods or service supplied against the voucher, or the value, money value of supplies redeemable against such voucher will be same. So more or less transaction value or rule 32 value will be same in this case. And this actual amount paid is not known today. That will be known only at the time when you are coming and redeeming. So, but I have to pay GST today itself. That's the reason why they have given rule 32. In case of identifiable vouchers, the time of issuance of voucher will be taken as the time of supply. So means today itself I have to pay GST on that voucher, but you will come and redeem this voucher in future. But until a point of time, if I wait, unnecessarily there will be interest burden on me. Why there will be interest burden on me? Because the time of supply is at the time of issuance of voucher. So today I have to pay GST, but I don't know what is the value of this voucher. So what is the product or service mentioned in the voucher? So that money value of the product or service mentioned in the voucher will be taken as a value of voucher for payment of GST. That is this. Is it clear? Then, in case of rule 32 sub rule 7, actually rule 32 sub rule 7 is not applicable at present because services are not notified for this purpose. That is, in case of services between distinct persons without consideration, the value will be taken as nil, but we don't have this rule 32 sub rule 7 right now. So we have only these 5 cases. So that is about rule 32. So we have completed rule 32 also. 33 also we have seen. 33 is what? Pure agent, and 34 is exchange rate. In case of, so look into page number 56, in case of goods or services which are being denominated in foreign currency, so we need to convert it into Indian rupees. For the purpose of converting into Indian rupees, we need to take, in case of goods, CBIC rate, and in case of services, GAAP rate. What is the GAAP rate? Average of the buying rate and selling rate should be taken. And CBIC rate for goods and GAAP rate for services. On which date? On the date of time of supply. First we need to determine the time of supply for goods under 12 and time of supply for service under section 13, and in case of goods CBIC rate, in case of services GAAP rate. GAAP rate is average of buying rate and selling rate, and by recognizing this rate we pay the GST. But actually there may be exchange gain or loss. Again on that, whether we need to pay any GST or not, no need to. So we should ignore that actual exchange gain or loss. For example, we recorded the transaction at 80 rupees per dollar and paid GST, but actual realization is 83 rupees per dollar. On that 3 rupees again should we pay GST? Not required. Then rule 35 is, whenever the amount is collected without charging GST separately, the amount so collected shall be assumed to be inclusive of GST. That is rule 35. Up to rule 35 only we have. Then look into this circulars. 2 circulars are there. One is related to TCS. So TCS not to be included in the value. That is, TCS under Income Tax Act. Generally as per section 15 subsection 2 clause A, any taxes, duties and cess by whatever name called other than GST should be included in the value. But this TCS which is deducted by the recipient, collected by the recipient along with the price of the goods. For example, so say I am seller, you are my buyer. I am collecting some TCS from you, and that TCS should be included in my value? No, because this TCS is an interim levy, not having the character of tax. This TCS I will collect and pay it to the income tax department, which my recipient, you, will be able to take it as credit in your income tax, correct? That TCS is not a tax on income, that TCS is tax on expenditure. So due to that reason, this TCS should not be included in the value because it is an interim levy, not having the character of tax. What about TDS? Whether TDS deducted by the recipient should be included in the value? Of course yes, because TDS is nothing but my income tax, correct or not? So when you are deducting, that is also part of my income, and TDS deducted by the recipient should be included. Then in case of banking company, they will appoint business facilitators or business correspondents. These business facilitators and correspondents receive the service charges from the customer and remit them to the banking company. Now in that case, on that service charges, it should be included in whose value? Business facilitator correspondent value or the banking company value? Banking company value. Then what should be included in the value of supply of business correspondent or business facilitator? Only the commission. Only the commission that they are earning should be included. In that also, business facilitator, GST is payable under RCM by banking company. Business correspondent, it will be FCM. Okay. With this, we completed value of supply also. So we'll take a break. So and thereafter, we'll start with segment 6, input tax credit. So meanwhile, online students, whatever queries you have, you just post it. After break, I will answer. So there are some questions. GTA services to other than unregistered person will be covered under 9(3) RCM. Okay, GTA service to other than unregistered, yes. The supplier also has option to opt for FCM 5% without ITC or 12% with ITC. Is that correct? No, I didn't get your question here. If GTA pays 5% without ITC, can the recipient take ITC? See, GTA let him pay 5% or 12%. Recipient will always get ITC. The ITC problem is only for the supplier. So if GTA is paying at 12%, GTA cannot take ITC, the GTA can take ITC. If GTA is paying at 5%, GTA cannot take ITC. But 12% or 5% charge it to recipient, recipient can always take ITC with respect to that. So whether banking services, intermediary service covered under section 13, where place of supply is location of supplier, is it treated as deemed interstate supply or intrastate supply? Once we determine the place of supply under section 13, it will always be deemed interstate supply. Then reversal under rule 42 and 43, section 18 closing stock capital goods 5% reduction, is it reduced from ITC or added to output tax liability? See, wherever we come across reversal of ITC means if you have balance in ITC, you reduce it from the ITC. If you don't have balance in ITC, it will be added to the liability. In law, interchangeably these two words are used. In some places they use the word added to liability. In some places they use the word reversed. Both are actually same. If you have balance in ITC, you can reverse. And if you don't have balance in ITC, you can add it to the liability. Both treatment is same and you can follow both. So in exam when you are writing reversed ITC or added to liability accordingly, like that we need to write. Okay. Then next 1.5%, 7.5% GST rate for promoter. Can you explain that provision? That is not there for exam. So which cases 1.5%, 7.5%, we don't have to remember the rates, but try to understand that builders are chargeable to GST at 1.5%, 7.5% without ITC. So therefore they cannot take ITC on their inward supplies. If the builder's outward supply is taxable at 18%, in some cases it will be taxable at 18%, then they can take ITC on their inward supply. So that is that. Next, sir, will the money paid for the voucher and the redeemable value will be the same always? So that's what I said. Today we give the voucher. For example, one medium pizza voucher today we are giving, and this medium pizza voucher you redeem it in future. At that time the price may be different, but today we need to take whatever is the value of the voucher. That is what rule 32 says. So that is today what is the price of that medium pizza, say 325 rupees, then 325 rupees will be taken as the value of that voucher for payment of GST. Now you actually redeem it after 3 months. After 3 months, say I may increase the price of this pizza to somewhere 350 rupees. Then how much should be taken as a value? 325 only, even though the transaction value at the time when you actually get it may be more or less, but redeemable value, because today we need to pay the GST, that's why. Then suppose subsidy as per provision to be included, but in the question given without considering the subsidy. For this you said to ignore it, we should add it. Oh. So subsidy question. No, subsidy is to be included. Subsidy is to be included and to be excluded. That is as per provision. In the given price, price without considering subsidy means in the price we have not reduced the subsidy. And when we have not reduced the subsidy, if it is to be included, we have not reduced, it is already included, so ignore. If it is to be excluded, in the given price it is not considered means not excluded, so we need to deduct. Simple. So make it simple and don't confuse yourself and don't confuse me also, please. Okay. Then I have revised book. Is everything in that's it book there in revised book also, sir? Yes, almost. Almost, and extra information is only there in revised book. So that's it book is very small here. So don't compare this with revised book. Revised book has lots of information than this, like more problems and solutions. And don't you're asking me now, I don't know what you're going to do. Please explain ITZ with Q&A. I will try, definitely. But I don't know whether I will be able to explain with question and answers. Not possible, because this is a rocket revision batch. But I will try to give some examples for that, and little bit slow I will make, because that's the reason why I have went on a fast gear with respect to place of supply and value of supply, because input tax credit is something which is important and I want to spend more time on input tax credit. That's why definitely I will do that, try to do that. So does rule 28 attract the transactions between shareholder and the company whose shareholding is less than or equals to 50%? No, there is no control. When there is no control, there is no related. So no related means definitely rule 28 is not applicable. Okay, fine. These are the queries there. So we'll come back to input tax credit segment number 6. And without this chapter, in exam, question paper will not be there. So that much important it is, but I don't think so it is that much difficult chapter and all here. It's a very, very easy one. I don't know why students will be finding it difficult. No, actually it is easy. According to me, it is easy. Even otherwise also input tax credit is easy. Okay. See this. First of all, in input tax credit, up to section 16 there are few changes. Okay, so let's try to understand this. That is, how much ITZ I should avail in GSTR 3B. First, there is a supplier, and that particular supplier is reporting the outward supply details in GSTR 1. So supplier will enter their outward supply data in GSTR 1 or IFF. What is IFF? Invoice furnishing facility. That is, those who go for QRMP will be filing IFF on a monthly basis. So either in GSTR 1 or in IFF, the supplier will report the outward supply data. And if the supplier files the GSTR 1 or IFF by the due date, what is the due date? So GSTR 1 due date is in case of monthly 11th of the month following every month. In case of quarterly 13th of the month following every quarter. IFF is 13th of the month following every month. If they, not quarter, month, 13th of the month following every month for the first and second month. Okay, and for the third month, anyhow for all 3 months put together, one GSTR 1 will be filed on a quarterly basis by 13th of the month following every quarter. So by 13th. So if it is filed, then that data will be reflected in GSTR 2B of the recipient. Now, whatever that is there in GSTR 2B, to that we need to make some adjustments, and that will be called as ITZ availed in 3B. Now, this point has not been tested in the last attempt. So, definitely this will be tested this attempt. So, be careful. First, you need to see how much ITZ to be availed in 3B. Whatever ITZ that is reflected in 2B, whatever ITZ that is reflected in 2B minus ineligible ITZ, means these ITZs will be coming in 2B also, but you should not take. What are they? Blocked ITZ. Because the GST portal don't know the GST. Who will be giving this to the recipient from GSTR 1 to GSTR 2B? This data will be auto populated. Now this job who will be doing? GST portal. How portal will know whether a particular inward supply is blocked credit or not for you? So due to that reason, blocked credits may also be reflected in 2B, but we should not be able to take that. We should not take that. Then there are some inward supply which are used for non-business purpose. That also portal don't know. So you should be reducing that. And inward supply used for exempted supply. Again, portal don't know. So you should be reducing that. So these three you need to reduce from ITZ as per 2B, and GST under RCM. Whatever GST you have to pay under RCM, So that will not come in your 2B because it is your liability. You are making some purchase on which you need to pay GST and RCM, that is your inward supplies. So that will not be coming in GST or 2B. So this GST and RCM should be added to this list, and this is known as ITC availed in 3B. For example, ITC as per GST or 2B is say 1,20,000, and in this there is some blocked credit 20,000. So we need to take out 20,000, and used for non-business purpose 5,000. So take out 5,000, and used for exempted supplies some 10,000. So take out that 10,000. So then whatever GST you paid under RCM, that will not come in 2B. So that you need to add, say that is some 15,000. So that you need to add. Now this will be taken as the ITC availed in GSTR 3B, that is 1,20,000 minus 20. So 1 lakh will be ITC availed in GSTR 3B. Is it clear or not? So whenever they give matched ITC like that, so what is the other name for reflected in 2B? This is only called as matched ITC. But don't just take this matched ITC blindly. In this matched ITC, there could be some blocked credits or used for exempted supply, used for non-business purpose, that should be taken out, and we need to add some GST paid under RCM. So then only you will be getting this. Okay. So this adjustment we need to do. And here, what is GSTR1? GSTR1 is a return that contains the details of outward supply furnished by the supplier. GSTR 2A or GSTR 2B contains the details of inward supplies, which is auto-populated from the GSTR 1 filed by the supplier. And in that 2A is a dynamic document and 2B is a static document. We will avail ITC on the basis of 2A or 2B. Right now 2B. At present it is 2B. Up to last exam it was 2A or 2B, but now it is only 2B. 2A is only for reference. 2A is for reference only, not for availment of ITC. But 2B is only for availment of ITC. Okay. And what is the difference between 2A and 2B? I have given below. Type of the document, 2A is dynamic, means it keeps on changing. But 2B is static. Once it is generated, thereafter, so that will be the same. So when the 2B will be generated? By 13th of the month following every month. So whatever GSTR ones which are filed by the due date or IFF filed by 13th, only those details will be coming in 2B of this month. Say supplier, you are supplier, you have to file return for March by 11th of April, GSTR 1 by 11th of April. You filed it on 15th of April. Will it come in GSTR 2B of March month? No. It will come in GSTR 2B of April month. So means in March month it will not be reflected, which means I cannot take ITC. Yes, you cannot take ITC. But will the data be reflected in 2A? Yes, it will be reflected in 2A, but it is of no use now. So therefore we can take ITC only on those inward supplies which are reported by supplier in GSTR 1 and filed the GSTR 1 by the due date. So then only the data will be made available to the recipient to take ITC. Then TDS and TCS details will be reflected in 2A but not reflected in 2B. And details of invoices, if GSTR 1 filed after due date, will it be coming in 2A? Yes. But in 2B? No. However, it is reflected in subsequent month 2B. And what is the purpose of GSTR 2A? For reference. And what is the purpose of 2B? For availment of ITC. This availment of ITC, reversal of ITC and utilization of ITC. What is the meaning of this? Availment of ITC is taking credit. Reversal of ITC is reducing the credit. Utilization of ITC is set off with the liability. These three things we will do in which statement? GSTR 3B. GSTR 3B is a statement or return containing the consolidated details of outward supplies, inward supplies, GST payable and GST paid shall be reported by every registered person. So then this only matched ITC should be availed and unmatched ITC cannot be availed. So 5% extra, 10% extra and all we cannot add now. So only matched ITC can be availed. Previously this was given in rules and now they have given it in the section itself, that is section 41. So section 41 says that only matched ITC can be availed, that is an amended section as per Finance Act 2022. Then manner of utilization of credit, which is given in section 49 subsection 5. So total 4 principles are there. Principle number 1, there is no restriction with respect to IGST, which means IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. But between the other 3, that is CGST, SGST and UTGST, respective credits can be utilized for payment of respective liability, and cross utilization is not possible. Then principle number 2, as we can use IGST credit for payment of all liabilities, but IGST credit should be first utilized for payment of IGST, and then if there is any balance left, that can be utilized for payment of CGST, SGST or UTGST in any manner, any proportion. But when we are utilizing it, we need to keep in mind the tax planning here, that is, say for example, so we have CGST, SGST and IGST, 5,000 rupees as CGST liability, SGST liability 5,000, IGST liability 5,000, and this is gross liability, and ITC is 2,000 CGST, 2,000 SGST and 10,000 IGST. Now 10,000 rupees of IGST credit is utilized for payment of 5,000 rupees IGST liability first, and still we have 5,000. Can we use that entire 5,000 for payment of CGST? No. If you use entire 5,000 for payment of CGST, so then there will be cash outflow of 2,000 rupees. How? So this 2,000 rupees will be carried forward. So cash outflow of 3,000, sorry, unnecessary cash outflow of 2,000. Anyhow 1,000 rupees should be there as cash outflow. So what is the correct answer for this? The correct answer for this is 1,000. How correct answer for this is 1,000? 5 plus 5 plus 5, 15 minus 2 plus 2 plus 10, 14. So total you need to see. So the total is 15,000 minus ITC 14,000. So you should ensure that you are getting 1,000 rupees as the answer. Then only it will be called as optimum ITC utilization. Is it clear? So what is called as optimum ITC utilization? Total of gross liability minus total of ITC. So this should be our net GST payable. So what we need to do? First, IGST credit we need to utilize, and in that IGST credit you use 5,000 for payment of IGST, and don't use full 5,000 for payment of CGST, SGST. The easy way to do that is equal apportionment. So therefore 2,500 we use for payment of CGST, 2,500 for payment of SGST, and then CGST credit and SGST credit utilized. So CGST credit and SGST credit when it is utilized, so that will be 2,000 and 2,000. So then the net liability will be 500, 500 and 0. So the answer is 1,000. Or what we can do, we can use instead of 2,500, so 3,000 also we can use for payment of CGST and 2,000 for payment of SGST. So then the answer will be, so 0 and 1,000, okay. Or we can use 3,000 for payment of SGST and 2,000 for payment of CGST. Then the answer will be 1,000 and 0. So what they will ask is that sometimes minimum SGST payable, like that they will ask. Minimum SGST means what? SGST should become 0. So therefore ensure that you are making SGST as 0. Sometimes they will ask minimum CGST payable, minimum CGST payable. So then you have to use for CGST, and then you need to see the remaining. So that is for SGST. Is it clear? So depending upon question we need to follow. Sometimes they will give, so determine the minimum cash payable. Minimum cash payable. Minimum cash payable means anything, either 1,000 or 500, 500 or 0,000, anyway it can be. How to know whether our answer is correct or not? This is the checklist, or this is the cross verification. total of gross liability minus total of ITC should be equals to net liability. Ensure that you are getting this. Understood? Then principle number 3, that is before utilizing CGST and SGST credit, the credit of IGST should be utilized completely. So that's the reason why in this question, before utilizing CGST, SGST credit, first we are spending IGST. And then last principle, when we have IGST liability but all the credits, so first we need to exhaust which credit? IGST. Thereafter we need to use which credit for payment of IGST liability? CGST. And thereafter SGST or UTGST credit. Then say this, IGST credit after utilizing for payment of IGST liability can be used for payment of CGST, SGST in any proportion. So multiple answers are possible in exam. So my view is, depending upon CGST, SGST liability, you apportion. So here CGST, SGST liability is what? Equal na? So you apportion equally. Suppose if it is 10,000, 5,000, apportion in that ratio, so that you will get the minimum liability, minimum cash outflow. Then GST compensation cess. Can GST compensation cess be availed as ITC? Yes. But that GST compensation cess availed as ITC should be utilized only for payment of GST compensation cess, cannot be utilized even for payment of IGST also. So you can, even IGST also it cannot be. IGST credit can be utilized for payment of compensation cess liability? No, no. Compensation cess credit only for compensation cess liability. No other credit can be used for payment of compensation cess liability. Understood? Then we are moving on to section 16, conditions for availment of ITC. So we have section 16 to section 21. So up to section 15, value of supply. Section 16 to section 21 is in input tax credit. Section 16 talks about conditions for availment of ITC. So total, now we have 8 conditions. 8 conditions. Number 1, only a registered person can avail ITC. Normal. Definitely unregistered person cannot take ITC. Number 2, the inward supply should be used or intended to be used in the course or furtherance of business. Used means existing. That is used for in the course or furtherance of business. Course of business means for the existing business. Furtherance of business means for some business which we are going to start in future. Used means used today. Intended to be used, not used. We kept it in closing stock, even then we can enjoy the ITC. Then should be in possession of tax paid document. What are considered as tax paid document? Tax invoice, debit note. On the basis of tax invoice we can take ITC, debit note we can take ITC, ISD invoice or bill of entry. These are the 4 tax paid documents. Should have actually received the goods or services. For example, January month invoice is raised, but goods are received in February month. We can take ITC only in February month, but it will be reflected in GSTR 2B of January month. Means we cannot take ITC in January month? Yes. Then it will not come in February month. Then how can we take extra ITC in 3B? We can definitely take, because the portal follows a cumulative 2B verification. For example, say this, that is GSTR 2B, GSTR 2B and GSTR 3B. So GSTR 2B, April is say 2 lakhs, but you availed only 1,50,000. Why you availed only 1,50,000? Because say we have not received the goods in April month, and we received the goods only in May month. May month GSTR 2B is say 2,80,000, but you availed a ITC which is 3,30,000. 3,30,000. Now there is a mismatch between 2B and 3B, but genuine reason, correct? Genuine reason. Now 2B total is what? Cumulative 4,80,000 and 3B total. So we will not get a system triggered message. Even if we get the message, we can justify that this is pertaining to April, which is not availed in April but availed in May month, we can give a reply. Usually there is a validation tool in the portal. That validation tool will take care of this cumulative calculation. But suppose if we get a mail, then we have to give this as a reply. Is it clear or not? So therefore, can we avail the ITC in the month in which we have invoice or in the month in which we have actually received? We have actually received. So only when we have actually received the goods or services, we should be able to take. Then supplier should have furnished the details of invoices in GSTR 1, because if the supplier is not filing GSTR 1, that is not uploading the details of invoices in GSTR 1, recipient will not be able to take the ITC because it will not be coming in 2B. Then supplier should have paid the tax with respect to such supply. Okay. Then how recipient will come to know whether supplier has paid the tax or not? So in 2B, when you click on that particular invoice, you will be able to find whether GSTR 1 has been filed or not, whether GSTR 3B has been filed or not. So which means that if supplier has filed GSTR 1 but not filed 3B, then whatever ITC we avail needs to be reversed. Is it clear? How much time, sir? How much time? Means, is there any time limit that is specified, or this month itself we need to do? How that will work out? For that, they have not given any time limit for your exam. For November 23 exam, they gave a time limit because that amendment is not applicable for your exam. That amendment is applicable for later exam, but nothing wrong in knowing it. So they gave a time limit of September of the succeeding financial year. By September end of the succeeding financial year, your supplier should have filed 3B. If the 3B has not been filed by your supplier, by when? This year, say April month 3B, he should file by May, June, July, August, September, October, November, December, Jan, Feb, March, April, May, like that up to September. No issue. You can enjoy the ITC. By September, that idiot has not filed 3B. Then reverse the ITC along with interest. Okay, along with interest. At what rate? 18% per annum. 18% per annum. From the date of utilization, not availment. Over. Availment gone. Rest in peace. It is date of utilization. So, because of Finance Act 2022 amendment, interest on wrong availment and utilization only will be computed. So, therefore, you need to take the interest from the date of utilization till the date of reversal. Is it clear? So, what is that we need to understand? So, supplier, so this provision will not be tested, this interest computation, all these things, because this is something which is an amendment. But what you need to know right now is that supplier has filed GSTR 1. GSTR 1 filed. Okay. When supplier has filed GSTR 1, so then it will be given in the GSTR 2B. GSTR 2B. So it will come, correct? It is auto populated in GSTR 2B. Based on GSTR 2B, the recipient will avail the ITC in GSTR 3B. But supplier did not file 3B, it's okay. Sir, supplier filed GSTR 1. Based on that, it is auto populated in 2B of the recipient. Based on that, recipient will avail the ITC in 3B. Now, supplier has not filed 3B. GSTR 3B not filed. GSTR 3B not filed, okay, within the time limit prescribed. You have to remember that within the time limit prescribed. So, GSTR 3B is not filed. Now, in that case, what recipient has to do? So, if GSTR 3B is not filed by the recipient within the prescribed time, then so in 3B, the recipient has to reverse ITC. Reverse ITC along with interest. along with interest. Somewhere you please make note of this here. Avail ITC, auto populated. So there is a supplier, there is a recipient. Supplier will be filing GSTR1, and whenever GSTR1 is filed by the supplier, that is step number 1, it is auto populated in GSTR2B of the recipient, that is step number 2. Step number 3, so recipient will avail the ITC in GSTR3B, and then supplier has not filed GSTR3B, because of which the recipient has to reverse ITC in 3B along with interest. So there is one query, what is the difference between principle 2 and principle 3? Completely different. Principle 2 is telling that the priority, IGST credit first for payment of IGST liability, then for CGST, SGST, like their priority. But principle number 3 says that before utilizing CGST, SGST credit, first we need to set off IGST credit, then only we should touch CGST, SGST credit. Okay, done. Now, what is the time limit by which the 3B has to be filed? Not filed within prescribed period. Within prescribed period. Within prescribed period. So that is prescribed later in December month. So that provision is not applicable for your exam. Okay. So that is prescribed as September of the next year, but they can change it. They can change it anytime. They can change it to 3 months, they can change it to 6 months. It is as according to them. Okay. So this is the amendment. So therefore, supplier should have paid the tax with respect to such supply. What is the time limit within which he should have paid the tax with respect to such supply? Within prescribed period. Within prescribed period. Then, so there is one query, presently without filing 3B by supplier, can recipient take ITC? Yes, 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 we can take, but that is having a risk. What is that risk that is there? If he is not filing 3B, we need to reverse, because to avail the ITC in 2B, that is to avail the ITC in 3B, what is the criteria? It should come in 2B, and when it will come in 2B, the moment the idiot has filed GSTR1, it will come, even if he has not filed 3B, because logically you see the due date for filing 3B is 20th. You are also required to file on 20th. How he can file on 3B 20th, then you can take the credit? Not possible. So therefore, only when he files GSTR1, you can take the credit. That is logical, because you take the credit in 3B and he filed the return GSTR1. So 1 will be filed by 11th and by 20th you will be able to take the credit. That is only pakka. So not necessary that he need to file 3B, then only we need to take. But companies follow a policy. What is that policy? Let's defer the credit to the next month, and whenever he files 3B, then only we will be able to take, like we will take the credit. That is company's policy. If company is following some stupid policy, don't come and ask me why it is not there in law. Okay, it is not there in law. So let the company follow policy, any policy. Let them go and die in Bay of Bengal also. That is not my problem. So therefore, that is up to the company's policy. But generally, can we take ITC as per law? Yes, we can take the ITC as per law the moment it comes in 2B. When it will come in 2B? If the supplier filed GSTR1. Okay. Then, so recipient should have filed the returns. 3B returns, because without filing 3B, how we can take the credit? Definitely 3B has to be filed to take the credit. Then GST paid on inward supply should be reflected in 2B under ITC available and should not be restricted, which means in 2B again we have two columns, ITC available, ITC not available. So it should not be coming in ITC not available. Why? This is a consequential amendment because of section 38. So they have brought in one new section called as section 38. So which says that if the supplier GSTR1 liability is more than GSTR3B for one or more tax periods, if the supplier GSTR2B ITC is less than his 3B ITC, like that they have listed out some reasons. So if you are buying from such a kind of supplier, even though he reported it in GSTR1, but you will not be able to take that ITC in 2B, because in 2B it will be restricted. So therefore, for this, the connecting point we need to refer is section 38. Section 38 in page. So what's the page number point? Section 38 is in page number, 1 second. Returns chapter, you see. Page number, it's not there. It's there, page number 109. It's there in page number 109, you see. Just give a reference there, page number 109. In the following cases, even though supplier declared the details of outward supplies in GSTR1, ITC can be restricted in 2B as per section 38. Why? Supplier is a newly started business. So don't take credit, okay? Don't take credit. Then supplier has filed GSTR1 by not 3B. Is it my problem? No, not your problem. It is supplier problem. Why are you buying from that bad boy? You purchase from that bad boy, so you will not get credit, okay? Then supplier liability in GSTR1 greater than liability in 3B. What is that? What is that? He filed fund but not 3B. Okay. He filed both, but there is a difference in liability. Wow. Then he availed ITC in 3B, which is more than his 2B. So you are touching my 2B. You understood or not? So then supplier has received demand notices and defaulted in payment of taxes, and such default continues. Who received demand notices? Supplier. In all these cases, it is my supplier's mistake now. If you are buying from such a supplier, your ITC will be restricted in GSTR 2B. Even though it is genuine ITC, even though it is GSTR1 filed and it is made available in 2B, but you cannot enjoy this ITC. It will be disallowed, okay? So this is really one big power which is given to the department, and so once department start using that provision, we will get the heat. And stupidity are this is. So why they need to restrict? Because of the mistake of the supplier, God only knows. And no, Chechi only knows. So that is this. Understood connection between 38 and that point. So one of the condition for availment of ITC is what? All the conditions are satisfied, but in the 2B it should not be coming under ITC restricted. Why ITC will be restricted? Because of these reasons. Because of what reason? Under section 38, department is having power to restrict the ITC in 2B. When they have power to restrict the ITC in 2B, if the supplier is newly registered person, Supplier has filed GSTR 1 but not filed 3B. Supplier's liability in GSTR 1 is greater than 3B. Supplier availed ITC in 3B more than GSTR 2B, or supplier has received a demand notice and the default continues. Okay. And mainly, fake registrations and all were there. So for that reason only they brought this, but it is not at all like taxpayer friendly, because genuine taxpayers also gets affected, because recipient is not doing anything here. He purchased in a good faith. So then in that case also this credit may be disallowed. Fine. So coming back to this. So can you tell me what are the conditions for availment of ITC? Come on. So total 8 conditions you should tell. First, only registered person should avail ITC. Used or intended to be used in the course or furtherance of business. Possession of tax paid document, should have actually received the goods or services. Supplier should have paid the GST. He should have reported the details of invoices in GSTR 1. Then 2 more. Recipient should file GSTR 3B, and such ITC reflected in 2B should not be restricted. So these are the 8 conditions for availment of ITC. Okay. Then what is the meaning of input tax on which we take ITC? Input tax means CGST, SGST, UTGST or IGST, which is either paid under FCM or under RCM. It also includes IGST paid on import of goods, but it does not include any tax paid under composition scheme. First of all, tax paid under composition scheme, they should not be charging it to the recipient. So a person opting for composition scheme has to pay composition tax out of their pocket. So they should not charge GST. If they charge GST to the recipient cannot take ITC with respect to that. That is this point. Then, so how would we know that the supplier is in default? No, we will not know. This section 38 is GST department will be disallowing the ITC when we are making purchases from a supplier and that supplier has done the default. GST department will disallow this credit by keeping that credit under ITC 2B. That may not be pertaining to this month. That may be pertaining to some months, like 6 months before ITC, but today, this month, it is kept under GSTR 2B under ITC not available, which means this month we have to reduce it. This month we have to reduce it, okay, like that it will be. Then it will not be enough, you should be good, you should ensure that your supplier is also good one, correct, you are right. For 2B, ITC not available so as to prevent ourselves from buying from such suppliers. Okay, correct. So next time onwards I will not buy from such supplier, but already I purchased. Then what is the justification for that? So our friend is telling he is supporting government. So this provision has been given so that we will not be purchasing from such kind of bad boys. Okay, but I purchased already. Okay. What should I do? It is like I attended THARUN'S classes, indirect tax classes, waste faculty he is. Okay, you will go until to 100 people, 100 people will not join, okay. But you paid fees? No. What about that fees? Okay. So, who will return that fees? So, that is what my concern is, okay. I am talking about that, okay. Then, it's okay, supplier, thereafter supplier is rectifying everything, we will be able to take that credit back, it will again come under ITC available. But yeah, why I should get that shock? So this month I am getting all of a sudden ITC not available, why? That is what my concern is. So because there is unnecessary cash outflow, I will be prepared that I will have this much of ITC, means this much only I have to pay as liability like that. So that shock only. And again, why should I do business based on my supplier? My business is mine. So why should I do business based on my supplier? That's what I mean to say. Fine. Then okay, no debate on that. So we'll come back to this. Then next, see this. So contents of invoice for availing the ITC. That is, even though a person is not having a regular invoice containing all the details, but these minimum details that are present in the document, then he can take ITC with respect to that. What are those minimum details? Description of goods or services and total value along with tax and GST of the supplier and recipient and place of supply. These are the minimum details that should be present in a document to be called as a invoice for availment of ITC, even though it does not contain all the details like HSN details, address, name, etc. But these minimum details, if it is present enough, what are those minimum details? GST of supplier, GST of recipient, description of goods, value, tax and place of supply in case of interstate supply. What is the meaning of inward supplies? Inward supplies means inputs, input services or capital goods. Any goods which are purchased and capitalized in the books of the person who is purchasing it is known as capital goods. Any goods purchased and charged to P&L is known as inputs, and any service received by a person used for business is known as input services. And if the goods are not received by me but received by some other person on my behalf, then in that case can I take ITC? That is bill to ship to transactions. So here goods or services, I asked my supplier to supply it to you and he is raising invoice for me. I have invoice but I have not received the goods or services. Can I take ITC? Yes. The date on which the third person has received the goods or services, it is deemed that the billing address has received the goods or services and they can take ITC with respect to that. Then in case of goods received in lots, ITC is available only on receipt of last lot or installment with respect to a single invoice. Okay. So for example, with respect to a single invoice, goods are sent in lots like 100 products. So that is 100 numbers, and in that 30 numbers delivered in first month, 30 numbers delivered in second month and 40 numbers delivered in third month. So with respect to all these 100 numbers, we can take ITC only on third month. Then here reversal of ITC for non-payment of consideration to the supplier, second proviso to section 16(2). That is, recipient has to make payment to the supplier within 180 days from the date of invoice. If the recipient has not made payment, payment means value plus tax, to the supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient needs to be reversed along with interest at 18% per annum from the date of utilization of ITC till the date of reversal. So see this, that is the amendment here. If the recipient has not made payment to supplier within 180 days from the date of invoice, then so much of the ITC availed by the recipient shall be reversed along with interest. But interest previously 18% from the date of availment till the date of reversal, but it is from the date of utilization till the date of reversal. What will be considered as the date of utilization? Whichever month the balance in ITC falls below the availed ITC, wrongly availed ITC, so that is known as the month of utilization to that extent. For example, I have availed ITC for January month, wrongly availed ITC, okay. So availed ITC, say opening balance, January some opening balance is there, and that opening balance is 1 lakh, and availed ITC, that availed ITC is 2 lakhs. In that 2 lakhs, wrongly availed is 1,50,000. Wrongly availed 1,50,000, and thereafter we have utilized some ITC, utilized ITC for payment of liability. So 2,50,000 we have utilized, sorry, 50,000 we have utilized, 50,000 we have utilized. So what is the closing balance? What is the closing balance? 1 lakh plus 2 lakhs, 3 lakhs, 3 lakhs minus 50,000, 2 lakh 50,000. What is the wrongly availed ITC? Whether the balance in ITC falls below wrongly availed ITC? No. So we have not utilized. We have not utilized. Again in the month of February. In the month of February, 2,50,000 is the opening balance. And the availed ITC is 1 lakh. Correctly availed ITC only, 1 lakh. And we have utilized 2 lakhs. Now, what is the closing balance? 1,50,000. Whether we have utilized the ITC, wrongly availed ITC? No. Because the balance in ITC is not below the wrongly availed ITC. Again, March month. March month, so opening balance 1,50,000. We availed 1 lakh and we utilized 2 lakhs. So the closing balance is 50,000. Whether wrongly availed ITC we have utilized? Yes. In the month of March, we have utilized wrongly availed ITC to the extent of 1 lakh. So wrongly availed ITC utilized to the extent of 1 lakh. In which month? March month. So that's how we need to compute. Okay. So therefore, whichever month the balance in ITC falls below the wrongly availed ITC, in that month we have utilized the ITC to that extent. Okay. So interest needs to be computed on 1 lakh from March month GSTR 3B due date. What is March month GSTR 3B due date? 20th. So from 21st onwards, we need to compute the interest. So that is the meaning of date of utilization till the date of reversal. And these provisions are not applicable in case of supplies which are covered under RCM 9(3), that 180 days condition is not applicable. Then supply without consideration 7(1)(c), because there is no consideration at all, then this 180 days condition not applicable. Or payment made to third person on behalf of the supplier, that is any amount that the supplier is liable to pay but which is paid by the recipient on behalf of the supplier. In that case also this 180 days condition not applicable. And also availed ITC not utilized, so then also we just have to reverse, but interest is not applicable, correct? If availed ITC not utilized, interest not payable, am I right? Interest not payable, interest not payable. Then again when we can take this ITC back? So after 180 days, as and when the payment has been made to the supplier, we can again re-avail this as ITC without any time limit. Then section 16 subsection 3, ITC not available with respect to depreciation computed on GST component. That is, whenever while computing depreciation under Income Tax Act section 32, if GST component is also added, so then we will not get the ITC. For example, purchase price of the capital goods is 10 lakhs and GST on the same is 1,20,000. If depreciation is computed on 11,20,000, then ITC with respect to 1,20,000 is not available. Then section 16 subsection 4, time limit for availment of ITC. What is the time limit for availment of ITC? 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. So 5 cases the time limit is same, and this time limit is not applicable in case of re-availment of ITC reversed earlier. Okay. Then in case of debit note, should we see the invoice date for arriving at the time limit of ITC or debit note date? Debit note date. So in case of debit note date, debit note availment of ITC depends upon the debit note date but not on the date of invoice. So these are the provisions relating to section 16, and lot of amendments are there in section 16, small points which can be definitely tested in MCQs. Then section 17 deals with apportionment of credit and blocked credits. In that 17 subsection 1, 2, 3 is apportionment of credit. 17 subsection 4 special provisions relating to banking company, financial institution, NBFC. 17 subsection 5 is blocked credit. First 17 1, 2, 3, what does it says? If you have some inward supplies which are exclusively used for taxable outward supply or business purpose, can you take ITC? Yes. If you have some inward supply which are used for exempted or non-business purpose, can you take ITC? No. ITC not available. If you have some inward supply which are used for both taxable and exempted, Can we take ITC? Yes, but proportionate ITC available. Same way, so that is inward supply used for both taxable and exempted, proportionate ITC available. If inward supplies are used for both business and non-business purpose, so can we take ITC? Yes, but proportionate ITC will be available. And how zero rated supply should be treated as? Should it be treated as exempted? No, it should be treated as taxable, which means ITC is available. So zero rated supplies will be covered under taxable supply for the purpose of availment of ITC. Then what is the meaning of exempted supplies? So this meaning of exempted supplies is for the purpose of availment of ITC. The regular meaning of exempted supplies that we have is notified as exempted, nil rated, non-taxable. These three are exempted even for availment of ITC. Apart from these three, we have some more transactions also, that is supply covered under RCM. When our outward supply is covered under RCM, even though it is taxable in the hands of recipient, but for the supplier it will be treated as exempted for the purpose of availment of ITC. And then next we have sale of land, sale of building and sale of securities. These three transactions are actually not a supply, but for availment of ITC these three are treated as exempted supply. What should be taken as the sale of land? Stamp duty value. Sale of building, stamp duty value. Sale of securities, 1% of sale value of securities should be taken. Okay. Then next one is that interest on loans, advances, deposits is actually what? Exempted. But for the purpose of availment of ITC, it should be treated as taxable. Interest on loans, advances, deposits is actually exempted, but for the purpose of availment of ITC, it will be treated as taxable. For ITC computation, why ITC computation we are treating separately? That is, for ITC purpose, I told you when inward supplies are partly used for taxable, partly used for exempted, we get the proportionate ITC. How that proportionate ITC we will get? Say we have some common inward supplies and that common ITC is say 1,20,000, and this common inward supplies are used for taxable outward supply and exempted outward supply. Okay, taxable outward supply and exempted outward supply we are using, and the taxable outward supply value is 40 lakhs and the exempted outward supply value is 20 lakhs. Now in that case, so what is the proportionate credit that is available? So first ITC availed. Out of this common ITC, can we enjoy the full ITC? No. So we need to reverse the ITC related to exempted to total. So what is the ITC not available in this? ITC not available in this is 1,20,000 into 20 divided by 60. So 1,20,000 into 20 divided by 60 is the credit that is not available. How much is that? 40,000 is the credit not available. So what is the ITC that is available? Balance. ITC that is available is 80,000. So for computing this 1,20,000 into exempted by total, we need the exempted turnover divided by total turnover. For exempted turnover, what should be taken? So notified as exempted, nil rated, non-taxable, supply covered under RCM, then sale of land, stamp duty value, sale of building, stamp duty value, sale of securities, 1% of sale value of securities. But interest on loans, advances is actually exempted, but you don't put it under exempted, you put it under taxable while computing this ratio. You understood or not? But to whom this will be applicable? To a person other than bank, financial institution or NBFC. Means for a bank, financial institution, NBFC, interest on loans, advances, deposits will be treated as exempted both for payment of GST as well as for availment of ITC also. It will be treated as exempted only. That is this point. So these are the 8 points that we need to remember. So what is the meaning of exempted supply? 7. Notified as exempted, nil rated, non-taxable, supply under RCM, sale of land, sale of building, sale of securities. Then what is the 8th point, special point you need to remember? Even though interest on loans, advances, deposits is exempted for payment of GST, but it should be treated as taxable while ITC computation, and this is not applicable to bank, financial institution, NBFC. Previously one more point was there, but that is now omitted. Previously, transportation of goods by vessel from India to outside India was exempted for payment of GST, but for ITC it will be treated as taxable. But now it is not exempted, it is omitted. Up to 39/2022 we discussed now transportation of goods by vessel, both India to outside India to India, both are taxable. So it is taxable for payment of GST, means it will be taxable for availment of ITC. So apart from these points, any other case, if it is taxable for payment of GST, it will be taxable for availment of ITC. If it is exempted for payment of GST, it will be exempted for availment of ITC. If it is not a supply for payment of GST, even for ITC purpose, it will be treated as not a supply. Then, so rule 42 talks about manner of availment of ITC with respect to inputs and input services. What is the procedure to be followed for availment of ITC? And rule 43 is in case of capital goods, and rule 42 is simple here. First, we need to see total invoices. Okay, so we have to take what are all the total invoices that we have. In the total invoices, we need to segregate that invoices into 4. What are those 4 boxes? So non-business purpose, non-business, exempted supplies, blocked ITC, taxable and business purpose. Like that we need to segregate. That is, we have some invoices. That invoices we need to segregate into these 4. And after segregation into these 4, still if we have some invoices, so that invoices will be called as common ITC. Okay. For example, we have some invoices worth rupees 10 lakhs ITC. Okay, 10 lakhs of ITC worth invoices we have in this. Okay, GST paid invoices 10 lakhs. Now this 10 lakhs invoices, so what is the 10 lakhs? ITC component, that is GST component. Okay, so in that, how much is the ITC with respect to these invoices used for non-business purpose? Say 1,50,000 non-business purpose, exempted supplies 1 lakh, and blocked credit 50,000, and used for taxable and business purpose 4 lakhs. Still there is some balance left, correct? What is that balance that is left? 10 lakhs minus 1,50,000 minus 1 lakh minus 50 minus 4 lakh. The remaining is what? 3 lakhs. That 3 lakhs is known as common credit. Now this 3 lakhs we need to reverse proportionately. To what extent? To the extent of exempted. So we need to take the exempted turnover and taxable turnover, total turnover. Say exempted turnover is 400 lakhs and total turnover is 1000 lakhs. Okay. So now what we need to do? 3 lakhs into 400 divided by 1000. So we need to do the proportionate reversal. So 3 lakhs into 400 divided by 1000 means 40%. That is 1,20,000 we need to reverse with respect to exempted supply. Same way, in this common credit, there could be some invoices which are partly used for business and partly used for non-business purpose. Then how we need to segregate that? So it is difficult to apportion. That's the reason why total common credit into flat 5%. So 3 lakhs into 5%, that is 15,000 rupees will be taken out as non-business purpose, which means what is the ITC availed in 3B? What is the ITC availed in 3B? Listen. So ITC availed in 3B already I told you. You take the total ITC. Total ITC is 10 lakhs minus blocked credit. We should take out, correct? Blocked credit. 3 things we should take out. T1, T2, T3. T1 blocked credit. T1 non-business purpose. T2 exempted. And T3 blocked credit, that should be taken out. Okay. Then, so this once we are taking out, the remaining is known as ITC availed in 3B. So what is the ITC availed in 3B? 10 lakhs minus 1,50,000 minus 1 lakh minus 50. So therefore 7 lakhs. 7 lakhs we will be taking as ITC in 3B. In that 7 lakhs, 4 lakhs fully you can enjoy. Remaining 3 lakhs fully you cannot enjoy. Proportionately you can take ITC. So therefore, what is the ITC availed in 3B? ITC availed in 3B is 7 lakhs. How we got 7 lakhs? C1 T minus T1 minus T2 minus T3 will be called as C1. And then, so this credit we avail minus ITC reversal under rule 42. What is the ITC reversal under rule 42? 1,20,000 and 15,000, that is 1,35,000 we will reverse. So remaining is known as the ITC available for set off. Therefore 7 lakhs minus 1,35,000, that is 5,65,000 will be taken as the eligible ITC for set off. So therefore this format you need to remember. So T refers to total ITC on inward supplies and minus T1. Out of these inward supplies, how much is used for non-business purpose? T1. Same way, out of this inward supply, how much is used for exempted outward supply? T2. Then out of this inward supply, how much are blocked credits? That is T3. So once we take out this T1, T2, T3, the balance is known as C1. That is availed ITC. Where we will avail this ITC? Availed in GSTR 3B. Availed in GSTR 3B. So from this we need to reduce T4, means out of this total ITC, how much are used for taxable outward supply or for business purpose? That is T4. Now the remainder is known as C2. So C2 is common credit. So but this common credit is already availed, correct? Common credit is already availed. So now we need to do the reversal. So minus D1. So D1 is common credit attributable to exempted supply. So C2 into E by F. So E is exempted turnover, F is total turnover, minus D2, that is common credit attributable to non-business purpose, that is 5%. So these two will be called as reversed in 3B, reversed in GSTR 3B. So availed in GSTR 3B is C1 and reversed in GSTR 3B is D1 and D2. So that difference is what we can take as ITC for set off. Okay. So this template you need to remember, and in the question whenever you get, so follow that, and the logic is very, very simple here, because anyhow T1, T2, T3 you will not be taking the credit, because inward supply is for non-business, inward supply used for exempted, inward supply used for blocked credit, you should not take the credit. So you will not take the credit, and T4 fully you can take. But common credit you cannot take fully, so common credit proportionately you should be taking the credit. What is that proportionately means? You need to reverse with respect to exempted supply and non-business purpose. Please respond there, you are understanding this or not. So non-business purpose, how should we take? Total common credit, means even if that one inward supply is used for non-business purpose, but the entire common credit we need to reverse 5%. I don't want to do that, super, then segregate here itself. You could segregate here itself. For example, you have renting of immobile property. 1/3 of the immobile property used for non-business purpose. 2/3 is used for business purpose. You know now clearly how much is non-business purpose. Then 1/3 you put it under T1, so that it will not come in common credit. If it is not coming in common credit, this 5% reversal is not required. Suppose you are not able to segregate in T1, so then only it will be coming into common credit, and then only you need to multiply with 5%. Then this computation should we again do at the end of the financial year? Yes, again we need to do at the end of the financial year, and this computation when we do at the end of the financial year, we need to again compute D1 and D2. So D1 and D2 monthly D1 and D2 for all months versus D1 and D2 computed at the end of the financial year. If there is any differences, the differences may arise because of change in the ratio, change in the turnover or etc. Then in that case, suppose if the final D1 D2 is greater than monthly D1 D2 computed, means what we have reversed is 10 lakhs, what we need to reverse is 12 lakhs. Then an extra 2 lakhs needs to be reversed by 31st March, because by end of that financial year we need to do. Otherwise, from April 1st of the succeeding financial year, we need to pay interest at 18%. Say this. So the differential amount will be added to output tax liability, and interest will be payable at 18% from the 1st April of the succeeding financial year till the date of payment. Okay. Suppose what we have reversed is 12 lakhs, what we need to reverse is only 8 lakhs, means excess reversed 4 lakhs. That excess reversed 4 lakhs can be availed as ITC. What is the time limit within which this reversal or availment should have been done? By September end of the succeeding financial year. Not November end, September end only. There is no amendment here. By September end of the succeeding financial year, either availment of ITC or reversal of ITC should have been done. Okay. If this amount is less than the amount added to output tax liability, then the additional amount paid has to be claimed back as credit in the return of any month till the September of the succeeding financial year. Okay. Now, so yes, sir. No, you can make the payment of this even through DRC3 also. There is something called as DRC3 na. So through DRC3 also we can make the payment. Okay. So that the 20 days interest also we can avoid. Then rule 43, manner of reversal or availment of ITC with respect to capital goods. So in case of capital goods, rule 43 will be applicable. So what we need to check is that whether the capital goods are used for taxable or business purpose. Yes, then we can enjoy the ITC with respect to that capital goods. If the capital goods are used for exempted or non-business purpose, then you cannot take ITC on that capital goods. If the capital goods are partly used for taxable or business purpose and partly used for exempted or non-business purpose, then we can take the ITC, but this ITC will be called as common ITC. Over the next 60 months, we need to do the proportionate reversal. So what is the treatment in case of capital goods 2? Avail 100% ITC in the month in which we have purchased the capital goods. Say for example, capital goods is purchased in the month of April on 10 lakhs, GST paid is 1,80,000 rupees. So therefore entire 1,80,000 we will avail as ITC in the month of April itself in which it is purchased. And thereafter we need to compute the monthly ITC. How to compute the monthly ITC? Total ITC is how much? 1,80,000 divided by 60 months. So here life of the capital goods is considered as 60 months. Can there be a lower life also given in the question? Yes. They can give 48 months also, you take 48 months, you don't take 60 months because the words used in the law is up to 60 months. So therefore divided by 60 months. If nothing is given in the question, you take divided by 60. So 1,80,000 divided by 60. What is the monthly ITC? 3,000 rupees. That monthly ITC you need to reverse every month proportionate to exempted to total of that month. So 3,000 into, say exempted turnover of that month is 10 lakhs and total turnover of that month is 50 lakhs. So 10 divided by 50. Next month 20 divided by 80, like that. So every month we need to do the proportionate reversal, and that amount will be added to liability or reverse along with interest at 18%. But here still it is given as from the date of availment of ITC till the date of addition to liability. Okay. So they have not changed it to from the date of reversal, that is utilization of ITC till the date of addition to liability, that is not given. Okay. And therefore this provision only you remember. And when this capital goods E by F computation we need to stop, that is this we need to do for how many months? 60 months. 60 months we need to do. Up to the date when the capital goods is in your possession. Means suppose if you are selling the capital goods after 36 months, again are you required to do this E by F computation? No. So therefore the above procedure is not required from the month when capital goods are sold. Why? Why? Because whenever capital goods are sold, in that case there is one section 18 subsection 6 that will come into the picture due to that reason. What does section 18 subsection 6 says? If you purchase any capital goods, on that capital goods if ITC is availed, then we need to take GST payable as total ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST payable on sale value of that capital goods, whichever is higher. For example, we purchased capital goods on 5th April 2021 and sold it on 28th October 2023, okay, for for 8 lakhs, it is purchased for 10 lakhs excluding GST at 12%. Now, what is the ITC availed? 1,20,000. 1,20,000 minus 5% for every quarter or part thereof from 5th April 2021 to 28th October 2023. How many quarters? So, April, May, June, July, August, September, October, November, December. So, 2021, 3 quarters. 2022, 4 quarters. And 2023, so again 4 quarters, 28th October, part of the quarter. So, 4 plus 3. So, therefore, 11 quarters. 11 quarters into 5%, that is 55%. So, therefore, 1,20,000 minus 55%, that is 54,000. 54,000 or GST on sale value, 8 lakhs into 12%. 8 lakhs into 12%, 96,000, whichever is higher. So, therefore, 96,000 will be taken as the GST payable. Is it clear? So, as anyhow we are paying the GST on that, that's the reason why from that moment onwards we don't have to do the E/F computation. Then, whenever it is refractory bricks, molds and dies, jigs and fixtures are sold as scrap. In that case, what we need to do is that we don't have to take A or B, whichever is higher, just we will take B, that is GST on sale value. Means this section is not applicable in case of refractory bricks, molds and dies, jigs and fixtures supplied as scrap. Then in that case, what we need to do? GST payable on what? GST payable on transaction value. GST payable on transaction value. Now, there are two special situations in this case, that is initial purchase CG1. CG1 is what? Used for taxable, and at a later point of time it is used for both taxable and exempted. Say this. So, life of the capital goods is 5 years and 3 years we are using it for taxable. 3 years we are using it for taxable, and thereafter it has become common. Okay. Now, common means used for both taxable and exempted. So, at the time of purchase, say April 1st, 2021. So, what is the life of the capital goods? March 31st, 2026. Correct? So, life of the capital goods is 5 years. April 1, 2021 itself. So, whether we will avail the ITC? Yes. So, we will avail ITC in April 1, 2021 itself. You understood or not? So, because we are using it for taxable, so don't avail ITC now. Is it clear? Don't avail ITC now, but now treat it as common ITC. Now treat it as common ITC, and for the next 24 months, we need to do E/F reversal. Got it? Again, I am repeating, initial purchase we are using it for taxable. At that time itself we would have availed the ITC. In the month of conversion, we will recognize it as common ITC and we will do the proportionate reversal E/F for the next 24 months. And what will be taken as monthly ITC? Total ITC divided by 24 or total ITC divided by 60? Total ITC divided by 60 only. But we will do reversal for the next 24 months. That is this. Initial purchase CG1 means used for taxable. And at a later point of time CG2, that is used for both taxable and exempted. ITC already availed at the time of purchase, so no need to avail common credit. Monthly ITC will be original ITC by 60, proportionate reversal from the date of conversion for the balance life. Now, suppose if it is the same, initial purchase, it is used for exempted, and thereafter you are using it for common. Okay. Now, whether we would have availed ITC at the time of purchase? No. So, because it was used for exempted, we would not have availed ITC. So, when we need to avail the ITC? So, from the date of conversion, we will avail the ITC, and for the next 24 months, we need to do E/F reversal, plus for the past period also we need to do ITC reversal. Why? because for the past period we are using it for exempted. So full 3 years, see for example we purchased for 10 lakhs, 10 lakhs into 18%, 1 lakh 80. How much we avail as ITZ? How much we will avail as ITZ? Entire 1 lakh 80 we are availing. So even though it is used for 3 years for exempted, today you are availing ITZ how much? 1 lakh 80,000. But last 3 years it was used for exempted. So we need to reverse. How much we need to reverse? 1 lakh 80,000 into 5%. 3 years means how many quarters? 12 quarters. So 12 quarters you need to reverse. So 1 lakh 80,000 into 12 into 5%, that is 1 lakh 8,000 we will reverse. Is it clear? Now, so what is the E by F reversal? What is a monthly ITC? Monthly ITC is 1 lakh 80 minus 1 lakh 8 divided by 60 or 1 lakh 80 by 60. 1 lakh 80 by 60 only. 1 lakh 80 by 60 only. 1 lakh 80 by 60, 3,000, but you need to do reversal for next 24 months. So that is this. So therefore, ITC not availed at the time of purchase, so it should be availed now. How much should be availed now? Original GST paid, okay? And ineligible ITC to be reversed for the period it was used for exempted, past period. How much is that? GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And what is the monthly ITC? Original ITC divided by 60. And we need to do the proportionate reversal from the date of conversion for the balance useful life. So these are the two cases, CG1 to CG2 or CG3 to CG2. So we completed rule 42 and rule 43. So what we have seen so far is section 16. So first we have started with section 41, only matched ITC can be taken. Then section 49 subsection 5, manner of utilization of credit. And then we have seen section 16, conditions for availment of ITC. Then section 17, apportionment of credit we completed. But still we have blocked credits, NBFC related and other points that we will see after a break, okay. So we'll meet at 2 o'clock. Definitely you will not come, I know that. 2:10. We'll meet at 2:10 here. Meanwhile, online students, if you have any queries, you just post it. After break, I will reply. Okay, we'll start. Okay, listen here. So there are few queries, that is section 38 which we have discussed. How that section 38 will first of all work? See, it is not in our hands, we will not do anything voluntarily. So it is the portal which will be restricting the input tax credit based on GST department's instruction. So it will be kept under ITC not available. So that much amount it is kept under ITC not available, we cannot avail the ITC with respect to that. And again the supplier rectifies his mistake. As and when supplier rectifies his mistake, so then automatically it will be given under ITC available and we can enjoy that ITC. That's how it will work. Okay. And so we will not know whether the supplier is defaulter, the supplier has not filed GSTR 3B, or his liability in GSTR 1 greater than 3B. All those things are verified by the GST department. So not that as a taxpayer we will do that. Okay. Then next one. So till GSTR 3B of September month of succeeding year, recipient can enjoy ITC and then reverse ITC along with interest at 18% from utilization if supplier default in filing 3B. Yes, of course, that is what provision I said. Under section 38, the recipient cannot take ITC if the supplier is newly registered. So that is, newly registered means they are registering now only, and they have not yet filed 3B or not yet filed any like paid taxes, etc. So that's the reason why. So till like 1 or 2 months, so even though they are filing only GSTR 1, but still the time they are making payment of taxes, everything. So that's why for newly registered persons they are restricting, like you cannot take the ITC, but it does not mean fully you cannot take ITC. Right now it is kept under ITC not available. As and when it is kept back under ITC available, we can be able to take that credit. Then whether PSF and UDF will be taxable or not. It is not taxable in the hands of the airlines which is collecting, but it will be taxable in the hands of the airport. Airport has to pay GST on that, but airlines, when it is collecting and remitting it to the airport, airline is not required to pay GST on that UDF and PSF. Then T2 exempted supplies inward or outward. See, T2 is actually inward supplies which are used for exempted outward supply, that is T2. So not that it is our exempted supply means, first of all we will not pay tax. We will not pay tax means why it will be coming under T. First of all it will not come under T. So whatever is tax paid on inward supply, on those tax paid inward supply, if that inward supply is used for outward supply which is exempted, that will be kept under T2. And suppose if I don't know how much is used for exempted, how much is used for taxable, etc., it will come into common, and then that common credit we will do proportionate reversal. That is based on what turnover? Exempted turnover to total turnover. Okay. Then next, initial purchase CG3 and a later point of time CG2. So what like initial purchase CG3 means used for exempted, and a later point of time CG2 used for common. Here while reversing ITC, whether we need to pay any interest on that 18%? No. So on this 1,08,000 we don't have to pay any interest, because this reversal is not wrongly availed ITC we are reversing. So now only we know that we are using it for both taxable and exempted. This reversal do not require any interest. Then as per rule 42-43 reversal and section 18 capital asset reduction of 5%, does these needs to be reduced from ITC or added to output tax liability? Depends. So suppose if you have enough balance in ITC, it will be reduced from ITC. If you don't have balance, it will be added to output tax liability. Then, so whether GST payable on disposal of business asset, example car on which ITC not availed at the time of purchase? Yes. So anything which is supply under 7(1)(a), we need to pay GST, and GST will be payable on the transaction value. Suppose if car is purchased At the time of purchase of car, ITC not available. Now the car is sold. It will become supply under 71A. Now GST payable on the car sold. What if at the time of purchase, ITC not available on car and the car is disposed of, given freely? First of all, it is not a supply. When it is not a supply, GST payable shall not arise. That is that. Then, sir, in condition for availment of ITC, supplier should file 3B is there. Then how recipient can take ITC without filing 3B? There is nowhere it is given that supplier should file 3B, but it is given that supplier should pay the tax. So which means that it is not like only after he pays the tax we can avail the ITC, not that means. So we can still avail the ITC because there is one section 41 which now allows a person to take the credit, as the section itself clearly mentions that we can take the ITC, but we should ensure that the supplier is filing GSTR 3B within the prescribed period. That is clearly given in the law itself. I am not creating any provision here. Then, sir, treating exempted supply definition for 8 points, it's for availment of ITC, but in that SIT book it is given like non-availment or reversal of ITC. I did not understand your question here. So, non-availment or reversal of ITC. Yes, this definition is only for the purpose of non-availment or reversal of ITC, correct? Only for ITC purpose only we need to do this, because I told you now what is the meaning of non-availment or reversal of ITC. So we need to do the proportionate reversal. For that proportionate reversal, that is this E by F ratio we compute na, for that E by F ratio computation only we do that definition. That is what I mean to say. So here whatever is given here for the purpose of non-availment or reversal of ITC means for the purpose of computation of that E by F, for that purpose. Then, so for provisional reversal and in final reversal, availment or reversal of ITC time limit is whether till 30th September or due date of September 3B. See, actually the provisions given over there is, so September of the succeeding financial year. They did not give due date of 3B of September. They said September of the succeeding financial year. So due to that reason we are taking till September end, because nowhere in rule 42 they use the word due date of 3B. They use the word till September. So that's why we are taking till September only. Then the recipient cannot take ITC if the supplier is newly registered. Already explained that. Sir, one of the capital goods was initially used for taxable, later used for exempted. From what date we need to calculate interest? We don't have to calculate any interest in that case. So just now I explained that when we reverse this ITC, so this 1,08,000, we don't have to pay any interest in that case. Then when to use the total ITC divided by 60 months and that 5% or quarter part thereof. Okay. So actually this CG, CG2, CG1, CG3. What is CG1? Used for taxable. CG2 common. CG3 used for both taxable and exempted. Sorry, CG3 is used for exempted. Used for taxable, and this is common, and this is used for exempted. Now what we discussed is CG1 to CG2. CG1 to CG2, what we need to do? We need to just avail the ITC. Correct? Already availed, we will just recognize it as common credit and we will do the E by F reversal for the balance life. Okay. CG3 to CG2. CG3 to CG2, what we will do? We will avail the ITC now. For the past period we will reverse. So how we will reverse for the past period? Total GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. Okay, what if this has become CG1, common has become CG1, we will not do E by F computation for the next periods. Okay, so somewhere after 2 years, common capital goods is exclusive for taxable, means from that moment onwards we don't have anything used for exempted, so we will not do any E by F reversal. Then what if the common capital goods are becoming exempted? So then fully we will do the reversal, because from now on it is fully used for exempted. So whatever is the balance life, how we need to calculate that? Original ITC divided by 60 months into balance life. So this we will do reversal. Okay, in this place only it will come. Then CG1 to CG3. CG1 to CG3. What will be the treatment? CG1 to CG3, same thing. Original ITC divided by 60 months into balance useful life. So this original ITC divided by 60 into balance useful life, we will do only in two places. What are the two places? That is, whenever common capital goods is used only for exempted, or whenever the taxable goods are used for exempted. Whenever capital goods which are initially purchased for taxable is used for exempted outward supplies. So in the two places only, that is CG2 to CG3 or CG1 to CG3, only in those two places we will do original ITC divided by 60 into balance useful life. In all other places we will not do this way. We will reduce the ITC for every quarter or part there of 5%. Okay. Then next, again same question. Are they are listening or not here? 1,08,000 we don't have to pay interest. We don't have to pay interest. So 1,08,000 we don't have to pay interest because this is not wrongly availed ITC that we are reversing. So on this 1,08,000 we don't have to pay any interest, any interest, any interest, any interest, any interest. Please here, this is not regular batch here. I told this na pa. Doubt clarification itself, third time pa, please pa. Then next, so we are moving on to next one, section 17 subsection 4, special provision for availment of ITC by banking company, financial institution including NBFC, 17 subsection 4. That is generally for a bank, financial institution, NBFC, part of their outward supply is taxable, part of their outward supply is exempted, because for a bank, financial institution, NBFC, interest income is exempted and the other income will be taxable. So in that case, definitely they cannot enjoy the full ITC. So therefore they have two options. Option 1, regular, they can take the proportionate ITC. Proportionate ITC option means what? Rule 42, Rule 43. So whatever is the common credit that they will take as ITC. Whereas they have another option, that another option is ad hoc option. That is, out of the total ITC, 50% they will not be able to take and remaining 50% they will take as ITC. So that is about these two options. Option 1, avail proportionate ITC as per Rule 42 and 43, and option 2, avail 50% of the eligible ITC, that is ad hoc. And suppose here there are two differences here. There are two differences. First difference is what? Here how we will take ITC? Proportionate. Here 50%. But while computing this proportionate ITC and 50% of eligible ITC, the meaning of common ITC will change. Here what is the meaning of common ITC? T minus T1 minus T2 minus T3 minus T4. That is only called as common credit. Am I right? That is only called as common credit in case of option 1. So total ITC minus used for non-business, used for exempted, used for blocked credits and used for taxable. Everything should be taken out, then only we get the common credit. That common credit only we will do the proportionate reversal. But in case of option 2, you know what is a common credit? T minus T1 minus T3 is only called as common credit, which means exclusively used for exempted also treated as common, exclusively used for taxable also treated as common credit. So this point is not yet tested, so this can be tested. So that is, what is the meaning of common credit in case of option 1? So total ITC minus T1 used for non-business minus T2 exempted minus T3 blocked credit minus T4 used for taxable, then only we get common credit. Real common credit means exclusive used for taxable, exclusive used for exempted should be separated, but that exclusive used for taxable and exempted should not be separated under option 2, means that will also be treated as common. That will also be treated as common. Exclusive used for non-business and blocked credits, ITC should not be availed. 50% computed on remaining ITC including used for exempted supplies. Okay, and this 50% is not applicable in case of inward supply from a distinct person. That is the third difference. So between this option 1 and option 2, what is the first difference? Option 1 proportionate ITC, option 2 50% of the eligible ITC. Second difference is the meaning of common credit. Third difference is, in case of option 1, if we have inward supply from a distinct person, which means say HDFC Bank Tamil Nadu receives service from HDFC Bank Karnataka, then proportionately they will be able to take the ITC on that inward supply from distinct person. But in case of option 2, they will not be able to take full ITC. So they will not be able to, they will not reduce 50%, they will take full ITC with respect to inward supply from a distinct person. So that is this, restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity. Means no need to reverse 50% with respect to inward supply from distinct persons. And then which option I need to follow, I have to decide in the beginning of the financial year, and the option 1 selected, that will be applicable throughout the financial year. That is this, option 1's exercise cannot be withdrawn during remaining part of the year. Then we have blocked credits, section 17 subsection 5. So these are blocked credits divided into 3: motor vehicle related blocked credits, then construction related block credits, and other block credits. In that motor vehicle related block credits, motor vehicles are divided into 3: motor vehicles purchased and used for transportation of persons, and motor vehicles which are vessels and aircrafts, and other motor vehicles. Motor vehicles used for transportation of persons, so again divided into 2. Capacity does not exceed 13 including driver. When we take capacity, that is including driver. When I say that motor vehicles, renting of motor vehicles where the capacity to carry more than 12 passengers. 12 passengers means excluding the driver seat. But here capacity means including the driver seat, it does not exceed 13. Then in 3 cases ITC available, in other cases ITC not available. What are those 3 cases? Further supply used in the business of transportation of passengers or imparting driving skills. These 3 cases ITC available, in other cases ITC not available. What if the capacity exceeds 13? ITC available, it is not a blocked credit. So motor vehicles are divided into 3: motor vehicles used for transportation of persons, that is cars, 2-wheelers, then buses, etc. will come, and then vessels and aircrafts and others. When it comes to motor vehicles for transportation of persons, that is again divided into 2: capacity exceeds 13, capacity does not exceed 13. Capacity exceeds 13 is first of all not a block credit, ITC always available. If capacity does not exceed 13, that is only blocked credit, but in that also we have 3 exceptions, that is used for further supply, which means that I am into the business of trading of motor vehicles, I purchase and sell the motor vehicles, I can take ITC, or I am renting of motor vehicles, so I can purchase a motor vehicles and give the motor vehicles on rent. Further supply, supply does not mean only sale, supply includes renting, leasing, etc. also. Then number 2, I am into the business of transportation of passengers, or number 3, imparting driving skills, I can take ITC, and in other cases I cannot take ITC. With respect to vessels and aircraft, we have 4 exceptions, that is number 1, used for further supply, number 2, same, used in the business of transportation of passengers, number 3, imparting driving skills. Fourth point is used for transportation of goods. In those 4 cases, vessels and aircrafts ITC available, in other case ITC not available. For example, Reliance Industries Limited purchased one aircraft for transporting its director. So it is not under further supply, not used in the business of transportation of passengers, not for imparting driving skills, and not for transportation of goods, therefore ITC not available. If Indigo Airlines purchase an aircraft for transportation of passengers, then they can take ITC because it is into the business of transportation of passengers. Same way, First Flight Couriers purchases an aircraft for transporting goods, can they take ITC with respect to that? Yes. Same way, a manufacturer, car manufacturer purchases a ship for transporting the cars manufactured by them, can they take ITC with respect to that ship? Yes, used for transportation of goods. Then all other motor vehicles ITC available, so it is not restricted, not blocked credit. Other motor vehicles means lorries, dumpers, tippers, bulldozers, road rollers, etc. and all are other motor vehicles, that is other than motor vehicles for transportation of persons or vessels and aircrafts. Remaining motor vehicles ITC available. Okay. Then next, with respect to 4 services in relation to motor vehicle, that is repair and maintenance service, insurance and servicing, and authorized service station. Servicing means authorized service station services, repair and maintenance service, insurance service, authorized service station services, hiring, renting and leasing of motor vehicles. These 4 in relation to motor vehicles, vessels and aircrafts. If motor vehicles, vessels and aircrafts is eligible for ITC, these 4 services in relation to that motor vehicles also eligible for ITC. ITC. If motor vehicles, vessels or aircrafts is not eligible for ITC, then these 4 services in relation to that motor vehicle also not eligible for ITC. For example, MRF Limited purchased a bus, and that bus they have taken insurance with respect to that bus. First, whether bus is eligible for ITC? Yes. Bus capacity exceeds 13, so it is not a block credit, ITC available. As bus is eligible for ITC, for that bus if they take general insurance service, on that insurance service GST paid also can be availed as ITC. Then a chartered accountant purchased a car for use in his profession, and he received authorized service center services with respect to that. Is car eligible for ITC even though used for business? No. Capacity does not exceed 13 and not covered under exceptions, so car is not eligible for ITC. As car is not eligible for ITC, the authorized service station service in relation to that car also not eligible for ITC. Then a company purchased a car for transporting its employees. Can they take ITC with respect to that car? No, they cannot take, because car capacity does not exceed 13 and not covered under exception, so they cannot take ITC. However, instead of purchasing the car, if they take the car on rent, they can take ITC. No. If the car purchased is eligible for ITC? No. If the car purchased is not eligible for ITC, then the car taken on rent also not eligible for ITC. So that is this hiring, renting and leasing of motor vehicles. Then one Ola driver purchased one car for use in the business of transportation of passengers. Can he take ITC with respect to that car purchased? Yes. So because car capacity does not exceed 13 and it is covered under exception, so ITC available. Now with respect to that car, they received repair and maintenance service. Can they take ITC with respect to repair and maintenance service? Yes. So therefore these 4 services in relation to motor vehicles, vessels and aircrafts. If motor vehicles, vessels and aircrafts is eligible for ITC, then these 4 services also eligible for ITC. Same way, if it is not eligible for ITC, then these 4 services not eligible for ITC. Then so this courier companies like Blue Dart etc. and all is purchasing airplane. Can they take ITC with respect to that? Yes, because they are using it for transportation of goods. So definitely they can take ITC with respect to that aircraft purchased. Then next, see the key points. While determining the capacity, driver should be included. And further supply includes what? Further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting, hiring or leasing, and repair, insurance and servicing of motor vehicles received by general insurance company is always eligible for ITC. For example, we purchased one car, newly purchased car, and that particular car, so we met with an accident and it is covered under bumper to bumper insurance. So we will take it to the workshop and we will give it in the workshop. Now insurance company will pay the entire amount for that. So now bill will be raised by the workshop to the insurance company. Now insurance company can take ITC with respect to repair and maintenance etc. Yes. The restriction is only for us. Suppose if the bill is raised to us, can we take ITC? No, because as car is not eligible for ITC, repair and maintenance also not eligible for ITC, but this restriction is not applicable to the insurance company. Insurance company can take ITC with respect to that, that is this. Then hiring, renting or leasing of motor vehicle as a statutory obligation by employer to employee is also eligible for ITC. That is, say for example, a company is purchasing a car for using it in transportation of their employees. Can they take ITC? Generally no. If they take that car on rent, can they take ITC? As car purchase not eligible for ITC, renting also not eligible for ITC. However, if that rent a cab is under a statutory obligation, can they take ITC? Yes. So hiring, renting and leasing of motor vehicles, generally if the motor vehicle is not eligible for ITC, hiring, renting and leasing also not eligible for ITC. However, if that hiring, renting or leasing of motor vehicle is under a statutory obligation by employer to employee, then ITC is available. That statutory obligation can be under any law. Then ambulance and caravan are not motor vehicles for transportation of persons. Ambulance and caravan, because they are coming under other motor vehicles. Ambulance is not a motor vehicle for transportation of persons. It is to provide the first aid during transportation. That's the reason why it will come under other motor vehicles. Same way, caravan is not for the purpose of transportation of persons. It is for the purpose of short-term accommodation during the places like shooting spots etc. where they don't have proper accommodation. They use that caravan for changing the dress or sleeping etc. So therefore, this will not be treated as motor vehicle for transportation of persons. So it will be treated as other motor vehicles. So other motor vehicles eligible for ITC? Yes. Then next number 2, construction related block credit. Construction related block credits is, there are 3 inward supplies in relation to construction of an immobile properties block credit. What are they? Any service in relation to construction of immobile property, works contract service in relation to immobile property, and any goods purchased for construction of immobile property is block credit. ITC not available. However, there are 3 exceptions. In those 3 exceptional cases, ITC available. Number 1, the restriction is only to owner of the property. Suppose if a supplier, that is if a contractor is receiving some services related to construction of immobile property, can he take ITC? Yes. So therefore the restriction is only to the owner of the property and not to the supplier. Then immobile property, construction of immobile property, but immobile property, it do not include plant and machinery. So which means that suppose if these 3 are received in relation to construction of a plant and machinery, even though immobile in nature, can we take ITC with respect to that? Yes. But plant and machinery excludes telecommunication towers and pipelines laid outside the factory gate. What if it is pipelines laid inside the factory gate? It will be treated as plant and machinery and ITC is available. Then third exception is, if the construction expenditure is charged to P&L, then also ITC is available, because the construction expenditure should not be capitalized. If it is charged to P&L, we can take ITC with respect to that. So 3 exceptions. First exception is if the restriction is only to the owner of the property, not to the supplier. Second exception is construction of plant and machinery. Third exception is if the construction expenditure is charged to P&L. Then which means that when a supplier can take ITC with respect to these services which are used for construction, always can they take ITC, because in the first exception it is given that the above discussion is not applicable to supplier. That is, if a works contractor receives construction service, they can take ITC, but that is subject to the condition that the rate of GST is not 1.5% or 7.5%, because sale of building by a promoter or builder when covered under supply, when it will be covered under supply, if part consideration is before, part consideration after, or entire consideration is received before, then it will be covered under supply. There are 2 rates of GST. So GST at 1.5% or 7.5%, it is without ITC. Even though there is no restriction, no blocked credit, but they cannot take ITC. Why they cannot take ITC? Because their outward supply is taxable at what rate? 1.5% or 7.5%. ITC not available, even though such inward supplies are not blocked ITC. Whereas whenever their outward supply is taxable at 12% or 18%, can they take ITC with respect to their inward supply? Yes. So ITC available on inward supply other than block credit under 17 subsection 5. That is the connection between this. Then other blocked credits, if you see, in this other block credits, we have some inward supplies, which is membership of a club, health and fitness center. Membership of a club, health and fitness center, ITC not available, but only one exception we have. Suppose if it is under a statutory obligation, ITC is available. Then number 2, travel benefits extended to employees on vacation. So this, again we have one exception, that is if it is under a statutory obligation, ITC is available. And non-resident taxable person, NRTP, non-resident taxable person, is a person who come from outside India to India and is not having any physical place of business in India, is known as NRTP, and NRTP cannot take ITC with respect to any inward supply, and exception is only one, that is in case of import of goods they can take ITC. Then food and beverages, outdoor catering related to food. Then beauty treatment including plastic, cosmetic and hair transplantation related to beauty. Then related to insurance, life insurance and health insurance. 3 things: related to food, related to beauty, related to insurance. These 3 are blocked credits. However, we have 3 exceptions to this. Exception number 1, if inward supply, outward supply is in the same category, we can take ITC. That is, I am purchasing food and beverages, my outward supply also food and beverages, I can take ITC with respect to that. Then inward supply is part of the composite or mixed outward supply. For example, so I am into the business of transportation of passengers by airways. I am also supplying food to my passengers. I purchase the food. Can I take ITC? Yes, because inward supply is part of the composite or mixed outward supply. Then third exception is statutory obligation, employer to employee under a statutory obligation. Suppose as per Factories Act, I have to provide food to my workers who are working in the factory. For that purpose, if I purchase the food and beverages, can I take ITC with respect to that? Yes, that is statutory obligation. These are the 3 exceptions. Then the other cases, suppose if I am purchasing from a person opting for composition scheme, can I take ITC? No. And suppose if I am purchasing some goods which are used for personal consumption, can I take ITC? No, because section 16 we have one condition, inward supply should be used or intended to be used in the course or furtherance of business. Then I am making some inward supplies which are lost, stolen, destroyed or written off. So I purchase some goods which are lost, stolen, destroyed, written off or disposed of by way of gifts or free samples, ITC not available. However, if these gifts or free samples become supply under 7(1)(c), then can I take ITC with respect to the inward supply? Yes. For example, there is an employer who is purchasing a mobile worth rupees 80,000 and giving it to the employee. Whether this gift will become supply under 7(1)(c)? Yes, because as the value of the mobile exceeds 50,000, so as the value of gift exceeds 50,000, it will become supply under 7(1)(c). Now that mobile has been purchased by the employer, can the employer take ITC with respect to that? Yes, even though purchased goods distributed as gifts or free samples is blocked credit, but if that gifts or free samples become supply under 7(1)(c), then we can take ITC with respect to the inward supply, that is this. Then if GST is paid under 74, 129 or 130 or any other recovery proceedings, such GST is not a matched ITC because voluntarily I did not pay. It has been recovered from me, which means I am not reporting it in GSTR1. If I am not reporting it in GSTR1, it will not be coming in your GSTR2B. Consequently, you cannot take ITC. Even though it has been recovered from me, but did I report it in GSTR1? No. So that's the reason why recipient cannot take ITC with respect to that. So with this, section 17 is over. So section 16 is what? Conditions for availment of ITC. Section 17, apportionment of credit and block credit. Now we are discussing section 18, which deals with input tax credit in special cases. Here 18 subsection 1 deals with availment of ITC on closing stock. So total 4 situations we can avail the ITC on closing stock. What are those 4 situations? If I have 18(1)(a), a person is liable to get registered and they made application for registration within 30 days. So then in that case, whatever is the closing stock before the date they are liable to get registered, on the closing stock GST paid can be availed as ITC. Okay, what is the meaning of the closing stock? Input as such held in stock, input contained in WIP in stock and input contained in finished goods in stock. So therefore we need to see raw material, that raw material purchased, whatever is the GST paid. Then WIP, in the WIP whatever is the raw material content, so that raw material GST paid. And FG, whatever is the raw material content on that GST paid. Okay, so inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Which date closing stock we need to take? Immediately before the date on which he is liable to get registered. Whereas 18(1)(b), so treatment is same, but the situation is different. A person is voluntarily getting registered, so he can also take ITC on the closing stock, same closing stock, inputs as such held in stock, inputs in WIP, inputs in FG. Which date? Immediately before the date of registration. Why immediately before the date of registration? Because from the date of registration only he is having liability to pay GST. Then in the 18(1)(a) case, why it is immediately before the date he is liable to get registered? Because from the date he is liable to get registered, he is having liability to pay GST due to that reason. Then in case of 18(1)(a) and 1(b), whether matching is required or not required, matching is not required. Whereas 18(1)(c) and 18(1)(d), 18(1)(c) is what? You are under composition scheme. Now you are going into normal scheme. So a person under composition scheme going into normal scheme, they can take ITC on inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock, even on capital goods. On capital goods, how much they can take credit? How much they can take credit? After reducing 5% for every quarter or part thereof. In case of capital goods, how much ITC they can take? 5 GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion. Okay, so that is this. Then whether matching is required in this case? Yes. So in case of 18(1)(c) and 18(1)(d), matching is required. And which date closing stock should be taken for 18(1)(c)? Before the date of conversion from composition scheme to normal scheme. 18(1)(d) is what? Your outward supplies were taxable. Now it became your outward supplies were exempted. Now it became taxable. So now in that case also you can take ITC on closing stock, inputs as such held in stock, inputs in WIP, inputs in FG and even capital goods before the date of conversion from exempted to taxable. Okay. And in case of 18 1A 1B, what is the difference? 1A 1B, 1A versus 1B. Just the situation difference, closing stock date is difference. And what is the difference between 1C and 1D? Same, situation is the difference. Here composition scheme to normal scheme, here exempted supplies to taxable supplies. What is the difference between 1A 1B versus 1C 1D? In 1A 1B matching is not required, 1C 1D matching is required, and 1A 1B they cannot take ITC on capital goods, but 1C 1D they can take ITC on capital goods. What is the time limit within which these inputs and capital goods should have been purchased? Within 1 year prior to the closing stock date, means from the invoice date to the closing stock date it should not exceed 1 year. And some important points in this, ITC with respect to GST paid on inputs can be availed as ITC. So on inputs full GST paid can be taken as ITC, but for capital goods alone we need to reduce 5% for every quarter or part thereof from the date of purchase till the date of conversion. Here quarter should be taken as calendar quarter or 3 months as 1 quarter, calendar quarter. Calendar quarter should be taken, which means suppose if it is 6th of August, 6th of August means should we count July, August, September quarter also? Yes, because the word used is quarter or part thereof. For example, 6th August 2021 to 6th August 2022. How many quarters? If you take it as 3 months as 1 quarter, only 4 quarters will come, but we should not take that way. So we should take August. August means up to September 1 quarter, then October, November, December 1 quarter, then next year Jan, Feb, March, April, May, June, July, August, September. So it will become 5 quarters. Okay. So it should not be taken as 3 months as 1 quarter, but we should follow the calendar quarter for this purpose. Then quarter or part thereof. Then how to take this ITC? Whether we will be taking this ITC in 3B? No, we will be taking this ITC by filing a declaration in ITC 1. That ITC 1 will be certified by a chartered accountant or cost accountant if the claim of ITC exceeds 2 lakh rupees. And this particular ITC 1 should be submitted within 30 days or such extended time limit from the date of eligibility to avail the ITC under 18.1. So that is, in case of 18.1A, when are you eligible to avail the ITC? As and when you get the registration certificate. 18.1B also as and when you get the registration certificate. 18.1C 1D whenever there is a migration, that is conversion from composition scheme to normal scheme or exempted supplies to taxable supplies. From that date within 30 days we need to file this ITC 1 or such extended time by the commissioner. And suppose if you are taking ITC more than 2 lakh, CA-CMA certificate, otherwise self declaration. Then section 18 subsection 2 time limit, is it applicable even for capital goods also? Yes. For all goods it will be the same time limit, means even capital goods should also be purchased within 1 year prior to the closing stock date, then only we can take ITC with respect to that. What if it is purchased beyond 1 year? We cannot take ITC. Then 18 subsection 3 talks about transfer of ITC. So whenever there is transfer of ITC means, so transfer of business, whenever there is transfer of business with a specific provision for transfer of liabilities, whatever is the unutilized ITC in the credit ledger of the transferor will be transferred to the electronic credit ledger of the transferee. For that, transferor is required to file one form. What is that form? ITC 02. And that ITC 02 should be certified by CRCMA. Yes, it should be certified by CACMA. For what? Not that this much balance is to be transferred, but this particular transfer of business is with specific provision for transfer of liabilities. So that is an important condition. There is a change in constitution of a registered person on account of sale, merger, amalgamation, etc. with this specific provision for transfer of liabilities. So means what? Not only the assets, even assets and liabilities, everything should be transferred. So then that should be certified by CACMA that this transfer of business is with specific provision for transfer of liabilities, then only ITC can be transferred from electronic credit ledger of transferor to electronic credit ledger of the transferee. In case of demerger, how the credit can be transferred? Because in case of demerger, so there will be two entities, so then how it can be transferred? Say for example AB Limited. AB Limited is split into two, A Limited and B Limited. then in that case, so we will distribute the ITC which is there in AB Limited between A Limited and B Limited based on the total assets ratio. Assets ratio we need to take post demerger and we need to distribute that credit, that is this. In case of demerger, credit shall be transferred to new entities in the ratio of net assets. So means whether ITC is availed or not on such assets post demerger. And suppose if there is any change in ownership on account of death of sole proprietor, even then this 18 subsection 3 is applicable, yes. So whenever there is a death of sole proprietor, the successor will take over the business. So that is also called as transfer of business. So in that case, so from the death sole proprietor who is dead, from his electronic credit ledger to the successor or inherited person's electronic credit ledger, the ITC will be transferred. So this 18 subsection 3 is equally applicable in that case. And one more condition, transferor and transferee should be in the same state. So this is the restriction as placed by the GST portal. Transferor and transferee should be in the same state. Then when single registration is getting split into multiple registrations, even then from that single registration, ITC can be transferred to multiple registrations. So for example, within the state, there is no condition that I need to have a separate registration with respect to each place. Say I am having business in 4 places in Tamil Nadu, say Chennai, Madurai, Coimbatore and Salem, I have 4 businesses. So now, so this 4 businesses, I was continuing under a single registration. Now I want to go for separate registration. In that case, from that single registration to separate registrations, ITC can be transferred. For that, ITC 2A. So another form, ITC 2A. And here on what basis the this ITC will be transferred? On the basis of assets as on the date of registration. When a single registration gets converted into multiple registrations within the state, then also ITC against a single registration can be distributed to multiple registrations by filing ITC 2A. Okay, understood? So again, which ratio should be taken? Assets ratio as on the date of registration should be taken. Then 18 subsection 4 read with 29 subsection 5. This is reversal of ITC on closing stock. So in case of 18(1)(c), 1(d), this is an opposite situation. What is 18(1)(c)? 18(1)(c) is I am under composition scheme, I am going into normal scheme. What is opposite of that? Normal scheme to composition scheme. Then 18(1)(d) is what? My outward supplies which was exempted and that became taxable. Now reverse, that is my outward supply which was taxable, now it became exempted. So normal scheme to composition scheme or taxable supplies to exempted supplies. Also the same is applicable in case of 29 subsection 5, that is cancellation of registration. In these 3 cases, in case of 18(1)(c), 1(d), we avail the ITC on closing stock. But here what we need to do? We need to reverse the ITC on closing stock. So same closing stock we need to see inputs, then inputs as such held in stock, then inputs in WIP, inputs in FG. Whatever ITC avail, that I need to reverse. In case of capital goods, what I need to do? Already I discussed. Original ITC divided by 60 months into balance life. Because your outward supplies which was previously what? Taxable, used for taxable. In capital goods which was initially used for taxable year, thereafter it is used for exempted. So then what we will do? Original ITC divided by 60 into balance life, correct or not? So like that. So here whenever we are going from normal scheme to composition scheme or taxable supplies to exempted supplies, cancellation of registration. In case of capital goods, we need to reverse ITC on capital goods. How much ITC we reverse on capital goods? GST paid divided by 60 months into balance life. We will do the reversal. Then some additional points in this regard. Inputs and capital goods can be purchased any time on which ITC is availed. If ITC is not availed, then the reversal shall not arise. Correct? Because suppose if ITC I have not availed, there are some inputs with me, but on that inputs I have not at all availed ITC. Should the reversal arise? No, reversal shall not arise. If the capital goods are purchased before 5 years, then also we don't have to do the reversal, because here you see GST paid divided by 60 months into balance life. There is no balance life 5 years before. Sir, in case of 18(1)(c), 1(d), it should have been purchased within 1 year prior. But here we don't have that time limit. So which can be purchased even 3 years, 4 years before also. Then if invoice pertaining to such inputs is not available, then we need to take market value as on the date of closing stock, and that should be certified by a CA or CMA. and all details of reversal should be reported in ITZ3. So we have come across total 4 forms. ITZ1, availment of ITZ on closing stock. ITZ2, transfer of ITZ from electronic credit ledger of the transferor to transferee in case of transfer of business. ITZ2A, transfer of ITZ in case of single registration into multiple registrations. ITZ3, that is in case of reversal of ITZ on closing stock. And in that case, ITZ1 should be certified by CACMA, yes, only when the amount exceeds 2 lakhs. ITZ2 should be certified by CACMA, yes, always it should be certified by CACMA irrespective of the amount. ITZ2A should be certified by CACMA, no. ITZ3 should be certified by CACMA, yes, if we replace market value with invoice value. Suppose if you take invoice value and reverse the ITZ, we don't have to get the certification from CACMA, only when we take market value. Then if there is any balance in ITZ after reversal, say for example, ITZ with respect to closing stock is 1,50,000 and I have a balance 2 lakhs. So 2 lakhs minus 1,50,000, still 50,000 is there in balance ITZ. What will happen to that balance? That will be lapse. If there is balance in ITZ after reversal, it shall be lapse. If there is any shortfall for reversal, for example, ITZ available on capital goods, this closing stock is 1,50,000, but I have only 1,25,000. So still there is a shortfall of 25,000. That 25,000 will be added to my liability, which means I have to pay. That's what I said. If I have balance in ITZ, it will be reduced from that, and remaining amount will be lapsed. If I don't have balance in ITZ, I need to add it to the liability. If there is any shortfall for reversal, then that shortfall shall be payable using cash ledger. And we need to do this computation separately for CGST, SGST, UTGST and IGST. Then section 18 subsection 6 already we discussed. What is 18 subsection 6? Capital goods are purchased on which ITC is availed, and that capital goods are disposed of. Then we need to take ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of supply, or GST payable on value of that capital goods, whichever is higher. So this 5% point comes in different places. What are the places where we have come across this 5% so far? So first I discussed in value of supply. In value of supply, whenever the repossessed asset is being sold, then we need to take, so purchase price as, that is for margin scheme, sale price minus purchase price will be taken as original purchase price as reduced by 5% for every quarter or part thereof from the date of purchase till the date of disposal of that repossessed asset, and that 5% should be reduced from the original purchase price. Then another place where I have come across 5% is in case of capital goods initially purchased for exempted outward supply and thereafter used for both taxable and exempted outward supply. There also we need to take GST paid into 5% into number of quarters from the date of purchase till the date of conversion. And then third place where we have come across this is that, so in case of 18(1)(c) and 18(1)(d), whenever we avail the ITC on capital goods, we need to take GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion. Okay. Then again in this place 18 subsection 6, 18 subsection 6 GST payable shall be A, ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of sale, or GST on sale value, whichever is higher. Total 4 places we have come across this 5% point. Okay. Then, so if you don't mind, can you please stand and sit once? Now seeing you, sit. Seeing you, I am getting sleep here. Rocket revision batch, exam in 1 month. How you will get sleep? I don't know really. Exam in 1 month, and anyhow we did not study for this many days. So only after filing exam application the seriousness will come in the body. So we have to read like that, and in 3 days you are going to complete one subject, you know that, and you are coming here and sitting and sleeping. How you will get sleep here? So I really don't know, because keep fear always in heart, you will not get. Okay, think that if I sleep I will fail, you will not sleep. Okay, you understood? exam year, CA exam year, your life is going to change in just this bloody 1 month, and this 1 month whatever effort you are going to put, you are going to qualify as a chartered accountant. So then thereafter daily you sleep. Who will ask? No one will ask. Sleep. And so sleep for 12 hours, remaining 12 hours you work. No one will ask you. But now, no, definitely you should not get. Okay, if you are feeling sleepy, you ask the next person to slap you. It's okay. Or you yourself stand up and sit, or pour the water on your head. Do something. Don't sleep. Okay. See, online students, needless to say, I don't know what they are doing, because first day, that is yesterday session when I started, 240 students were there attending online live. I know live, no one will be sitting at home watching in YouTube, etc. Initially itself I said, Illapa, I will take class, happily I will record and I will upload. For that students and all sent message, no sir, we need live only sir, live only sir, live only sir. Full telegram, full messages, live. Then I announced, okay, fine. So 26th, 27th, 28th, for 3 days I will take YouTube live, you watch like that, okay. And 240. Now you know how many? 99, okay. So it is like, what would have happened is that, they would have thought, fine, we can anyhow, it is there in YouTube now, we can watch it later. That's what I said. I will record and upload, but no, they will not listen, okay. So what to do here? And but of course, I am not taking for the sake of live students, I am taking for you only. So that's why I am concerned about you, don't sleep. Live, if they are sleeping also, I don't know. If they are sleeping also, I am not worried also, because anyhow, they know that they can watch again in YouTube also, they will sit and happily watch, no issue, because they have ample time. They are not writing for May 23, they have time, no issue at all for them, okay. Say this. Section 19, job work provisions. Section 19 read with section 143. So, capital goods, initially and all I was worried, whether I am not taking properly or not, why students online live they are not coming, etc. and all. So I was really feeling very depressed, sad, all those things. Then, my team told, no sir, you are taking class properly only, but students in online, no, they cannot watch that much time. So they will sit and watch, automatically they will get one message and YouTube will go off, that message will come up, Instagram will come, and in that Instagram they will start seeing the news feed, and suddenly they remember, correct, live is happening, no, they will come. They will come. So that's why it will be like that. Okay. Fine. Say this. So those who are attending online live, I am not scolding you here. So I am telling about those who came initially and thereafter those who did not come. So say this. So job work provision section 19 read with section 143. So that is, whenever the capital goods or any goods which are sent to the job worker by the principal, say I am the principal, you are the job worker, I am sending the raw material to you, and I should ensure that the processed goods are brought back to my premises after completing the process within 1 year, and this 1 year time limit can be extended for a further period of 1 year. And same way, capital goods are sent to the job worker. What is the time limit within which it should be returned back to the principal's place? 3 years, and it can be extended for a further period of 2 years. And what if the goods, processed goods and capital goods, are not brought back within the time stipulated under section 143? Then in that case, it will be deemed as supply. But when it will be deemed as supply? After expiry of that 1 year or 3 years, or is it deemed as supply at the time of dispatch to the job worker? At the time of dispatch to the job worker itself, it is deemed as supply, which means after 1 year, after 3 years, you came to know that 1 year before, 3 years before, you have got the liability. Now you need to discharge that along with interest. Here we have interest, okay? Here we have interest. So say this. That is, so we have some inputs, and inputs are sent to the job work, and capital goods are sent to the job work. What is the time limit within which capital goods should be received? Within 3 years. And what is the time limit within which input should be received? Within 1 year. Within 1 year. And so whenever these inputs and capital goods are sent to the job worker, and it should be received within that time, if it is not received within that time, then it is deemed as supply. It is deemed as supply on the date it is dispatched to the job worker, correct, by the principal. And suppose if the goods are directly sent to the job worker from the raw material supplier's place. So I am not receiving, I am directly dispatching it from my raw material supplier to your place. Then in that case, this 1 year or 3 year will be counted from the date of receipt by the job worker. So deemed as supply on the date of receipt by the job worker. Is it clear or not? Then ITC, whether required to be reversed by principal when the goods are sent to the job work? No, no. And such goods should be sent under the cover of a delivery challan and e-way bill. Even if goods are directly received by the job worker, but the principal can take ITC. What is that? Bill to ship to. So whenever the goods are received by the job worker, the principal can take ITC with respect to that. Then some additional points in this regard. So you are using the inputs for making the process. Can you take ITC with respect to that your job worker? You are using some inputs for processing. Can you take ITC with respect to the inputs that you have purchased? Yes, there is no restriction. And if processed goods or capital goods are returned by job worker after 1 year or 3 years as the case may be, now whatever we paid as GST we can avail as ITC. Whatever principal has paid as GST they can avail as ITC, or it will be treated as new supply by the job worker. It will be treated as new supply by the job worker. So therefore what happens here? First of all, I am principal. I am sending the goods to you. I should ensure that I am bringing back the goods within 1 year or 3 years as the case may be. Processed goods should be brought back within 1 year. Capital goods should be brought back within 3 years. If it is not coming within 1 year or 3 years, on expiry of 1 year or 3 years, for me principal it will be treated as supply, and I need to pay the GST along with interest, because the time of supply will be taken as date of dispatch to the job worker or the date of receipt by the job worker as the case may be. When date of dispatch to the job worker? Whenever principal is sending it to the job worker. When it is date of receipt by the job worker? Whenever the goods are directly sent to the job worker's place by the supplier of the principal, Then with that it is over. Now after 1 year or 3 years, the job worker is returning those goods. Now in that case, what is the treatment? It should be treated as new supply of goods made by the job worker to the principal. That is this. And this period of 1 year and 3 years can be extended for a further period of 1 year and 2 years. Means for processed goods, what is the time limit? 1 year plus 1 year. For capital goods, what is the time limit? 3 years plus 2 years. And suppose if the job worker is not registered, the principal should show job worker's place as additional place of business of the principal. What if the job worker is registered? No need to show that as additional place of business. Then jurisdictional officer must be intimated about the job work contract. And processed goods, that is, I am sending the raw material to you. You are processing. So from there, either it can be brought back to my place, or it can be sold to a buyer from your place, or it can be exported from your place. Any three things should have been done within that 1 year. Okay, what is that? Either it should be brought back to principal's place, or it should be sold to a buyer, or it should be exported. So maybe brought back to principal's place, or can be sold directly from job worker's place. And one statement needs to be furnished by the principal with respect to goods sent on job work and received from job work. What is that statement? ITZ 4. And that ITZ 4, what is the time limit? If aggregate turnover during the previous year exceeds 5 crores, then it is a half yearly statement. Means, so by 25th of the month following every half year, so we need to submit this ITZ 4. That is for the first half year, April to September, it is by 25th October. For the second half year, from October to March, it is by 25th of April. Whereas in case if the aggregate turnover during the previous year does not exceed 5 crores, then it is an annual statement. That annual statement needs to be submitted by 25th April of the succeeding financial year. Okay. So then here input service distributor is given under section 20 and section 21. So who is a input service distributor? There is a head office, and that head office is having branch officers under the same permanent account number. Now this head office will receive the input services, and with respect to that input service they can take ITC and distribute that ITC to these branches, and this particular head office should be registered separately as a input service distributor. And here one important point is that CGST and SGST credit will be distributed as CGST, SGST with respect to the branch in the same state, whereas with respect to branches in the other state it will be distributed as IGST credit, whereas IGST credit will always be distributed as IGST credit. So CGST and SGST distributed as CGST, SGST for unit in the same state, and distributed as IGST if the unit is in different state. Now suppose if this inward supply is used only by one unit, then entire credit will be distributed to that unit. If the inward supply is used by 2 units, then the credit will be distributed to these 2 units on what basis? Turnover ratio, on the basis of turnover ratio. Suppose if the inward supplies are used by all the units commonly, then it will be distributed to all the units based on its turnover ratio. But to which units it will be distributed? To units which are operational during the month. All units which are operational based on turnover ratio. Which turnover will be taken? Either previous year turnover will be taken or the last quarter turnover will be taken based on the availability. And whether this ITC will be distributed on a quarterly basis or monthly basis or a yearly basis? Monthly basis. Monthly basis. And they need to file one return. So this ISD is required to file one return. What is that return? GSTR 6 by 13th of the month following every month. Then excess distributed ITC can be recovered by issuing ISD credit note. Say for example, they have to distribute 20,000 and 20,000 and 30,000 to these 3 units. But what they did is that they have distributed 10,000, 30,000 and 30,000 to these 3 units. This is the first thing is what they should have distributed, and the second is what they have distributed. So now to which unit they have excess distributed? Unit 2. So for that unit 2 they will be giving a ISD credit note to recover this 10,000 rupees, and again ISD invoice for giving back the 10,000 rupees to unit 1. Okay. So this has to be done by ISD. What if this is not done by ISD? Then as per section 21, wrongly distributed credit will be recovered from the unit. So 10,000 will be recovered from the unit 2, and for unit 1 they will not give 10,000 rupees as credit. That is the disadvantage in section 21. If the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest. Okay. And distributed credit should not exceed the credit available for distribution. For example, they have 1 lakh credit for distribution, means the total of this should be 1 lakh, not more than that. Then ISD should get a compulsory registration in irrespective of aggregate turnover. So therefore, how many registrations they will have? These 3 anyhow will have 3 registrations, plus this head office also should get a separate registration as ISD. So which means total 4 registrations. Then last one point is there, that is while computing this turnover, we have computed turnover in 3 places. Number 1, rule 42. Rule 42, common credit into exempted turnover divided by total turnover. Then again rule 43. Rule 43, monthly ITC, that is common ITC divided by 60 months, monthly ITC into exempted turnover divided by total turnover. Again in case of input service distributor, we are taking turnover for distribution. In these 3 places, while computing the turnover, don't include old indirect taxes. Generally old indirect taxes should be included as per 15(2)(a), because as per 15(2)(a) all taxes, duties and cess by whatever name call other than GST should be included. But in these 3 places for computing the turnover, old indirect taxes should not be included, should be excluded. This is exception to section 15(2)(a), clear or not? So while computing turnover under rule 42 or 43 or section 20, old indirect taxes, that is excise duty and central sales tax and value added tax, should be excluded. Okay, that is with respect to this, clear? Then next, so interest related provisions we will see in input tax credit, what all we have come across. Section 16, anywhere interest provision is there? Section 16, yes, 180 days. If the payment is not made to supplier within 180 days from the date of invoice, so much of the ITC avail needs to be reversed along with interest at 18% per annum from the date of utilization till the date of reversal. Then one more interest also is there in section 16 read with section 41, that is if supplier has not filed 3B within the prescribed period, then whatever ITC that is availed by the recipient based on 2B needs to be reversed along with interest at 18% per annum. Then next, in case of section 17 we have interest, yes, 17 read with rule 42. Rule 42 we have interest na, what is that? Provisional D1 D2 versus final D1 D2. So interest at the rate of 18% on the differential amount from April 1st of the succeeding financial year till the date of payment. Then in rule 43 also we have interest, yes. Rule 43, what is that? Monthly ITC reversal along with interest at 18% from the date of availment till the date of reversal. Okay. Then section 18, we don't have any interest in section 18. Section 19, job work, yes. So what is that? If the goods are not brought back within the time stipulated under section 143, then it is deemed as supply and GST payable along with interest. Okay. So then section 20, ISD. So if not 20, 21 it is there. Wrongly distributed credit, so it will be recovered from the recipient. So excess distributed credit along with interest. Okay. So we completed input tax credits and exemptions also over. Now look into the next area, composition scheme. Segment 8, page number 89. Composition scheme. See, what you need to do is that after completion of this rocket revision, so you need to solve the problems, as many problems as you can. So now that is like not necessary that dedicatedly you need to sit and solve the problems. So this 3 days is over, okay, like revision is over, which means that you learned the subject. So now what you need to do, daily basis, say just 1 hour or 2 hours whenever you are feeling, like afternoon onwards. So because morning times and all you will be preparing for other subjects, afternoon you feel little drowsy, etc. So take some indirect tax problems and solutions and you start solving the problems and solutions. At the time when you are solving problems and solutions, you may not be able to recollect the provisions. At that time you see that's it book. So that's how it should be used. You understood what I am telling? And say one concept you did not understand, and you can just again watch in the YouTube that particular concept alone again, so that you can try to solve the problem. So that is the objective. So actually if anyone asks me, the best combination will be that's it book plus problems and solutions. So any problems and solutions, but it should be updated. I am not telling that you have to follow my book only, but any problems and solutions, but that should be updated. So if you have that, definitely application. See, ultimately how much we have learnt is not important, but to how much extent we are applying it is only important. So that when you do know immediately, so you should not delay it. Again, don't give 15 days gap and then open any problems and solutions. No. So daily just 2 hours or 1 hour is also okay. So just randomly some problems you start doing it. So you will be in touch with the subject, that is enough. Then composition scheme under section 10. So we have two types of composition scheme, section 10 subsection 1 and 10 subsection 2a. First of all, composition scheme is what? A simplified scheme for payment of GST. And what is the advantage of composition scheme? Rather than paying GST at the normal rate, we will pay GST at the reduced rate. And what is the disadvantage because of that? We cannot take ITC on our inward supplies, and that 1% or 5% or 6% whatever we pay under composition scheme should be paid out of our profit, and we cannot recover from our recipient. So now these two composition schemes, first composition scheme under 10 subsection 1. So when will it be applicable? If aggregate turnover during the previous year does not exceed 1.5 crores, or for 8 special category states if it does not exceed 75 lakhs, then during the current year they can opt for composition scheme. What are those 8 special category states? Not MMTN ASAM, it is MMTN USAM, that is Manipur, Mizoram, Tripura, Nagaland, Uttarakhand, Sikkim, Arunachal Pradesh and Meghalaya. Okay. So for these 7 states, for these 8 states, the limit will be 75 lakhs. For other states, what is the limit? 1.5 crores. If aggregate turnover during previous year does not exceed 1.5 crores or 75 lakhs, then current year they can opt for composition scheme. And who can opt for this composition scheme under 10.1? Manufacturer, trader or supply of food service provider. Other service providers cannot opt for composition scheme. And what is the benefit of reduced rates? If they are manufacturer, they need to pay GST at 0.5% CGST, 0.5% SGST on total turnover. Whereas if they are a trader, then they need to pay GST at 0.5% CGST, 0.5% SGST on taxable turnover. If they are food service provider, they need to pay CGST 2.5%, SGST 2.5% on total turnover. And a person who is opting for composition scheme under 10 subsection 1 can render any other services up to 10% of turnover during previous year or 5 lakhs, whichever is higher. So to that extent they can provide service. First of all, 10.1 is applicable to whom? Manufacturer, trader or supply of food service provider. But they can also render any other services. But to what extent they can render? Up to 10% of turnover during previous year or 5 lakhs, whichever is higher. Now with respect to those services, what will be the rate that they need to take? The rate applicable to a trader, that is 0.5% CGST, 0.5% SGST on taxable turnover. So rates we need to remember. For a manufacturer, so 0.5 CGST, 0.5 SGST on total turnover. For a supply of food service provider, 2.5 CGST, 2.5 SGST on total turnover. For trader, so 0.5 CGST, 0.5 SGST on taxable turnover. And for the services up to 10% limit or 5 lakhs, whichever is higher, 0.5% CGST, 0.5% SGST on taxable turnover. Understood? Then next, what is the current year limit for the reduced rates? So current year limit for the reduced rates is 1.5 crores or 75 lakhs, which means that what? So current year up to this 1.5 crores or 75 lakhs, they will be into composition scheme. And after crossing that, they will be going into normal scheme. And next year they cannot go for composition scheme. Why next year they cannot go for composition scheme? Because current year it crossed 1.5 crores. And who cannot opt for composition scheme under 10 subsection 1? So you have to remember that with a keyword, yes, 9 RCM. Section 9 is RCM. Yes, 9 RCM. Yes, for service providers other than supply of food and beyond the 10% limit. Okay. So they cannot opt for composition scheme under 10.1. Service providers other than supply of food or beyond the 10% limit, they cannot be into 10.1. And all these conditions we need to see for the current year or previous year. Current year, not for the previous year. Whichever year you are opting for composition scheme, that year you need to see. So current year you should not. Previous year you can make anything. Previous year you can be anything, irrelevant. So current year only you are opting for composition scheme. Now current year you should not be providing any service other than supply of food or beyond 10% limit. Plus you should not be a non-resident taxable person. Who is a NRTP? Who come from outside the country to India and is not having any physical place of business in India is called as a NRTP. They will be supplying goods or services in India. So example, cricketers who come from outside India to India for playing the tournaments, or actors who come from outside India to act in the movies, so will be called as NRTP. Then interstate supplier of goods or services, whether taxable or exempted. So if you are making interstate supplies of goods or service, you cannot opt for composition scheme. That's the reason why rates and all we discussed, 0.5 CGST, 0.5 SGST, like that. Then non-taxable supplies, that is a restaurant having license to sell liquor, selling liquor. Can they opt for composition scheme? Being restaurant can opt for composition scheme, but as they sell liquor, which means they are making non-taxable supplies, so they cannot opt for composition scheme. Then supply of goods or services through e-commerce operator. So for example, I am selling goods through Amazon or Flipkart. So, but my turnover does not exceed 150 lakh. Can I opt for composition scheme? No, because supplier of goods or services through e-commerce operator cannot opt for composition scheme. Same way restaurant. Restaurant is selling food through Swiggy or Zomato. Can they opt for composition scheme? No. So because of this restriction. Then RCM under section 9 subsection 4 on which GST is not paid. RCM under 9 subsection 4 is what? Promoter or builder, on which GST is not paid. So this condition is practically irrelevant now. At present it is irrelevant because promoter or builder's outward supply will be what? Easily crossing 1.5 crores, correct or not? So therefore definitely they will not be into composition scheme. So practically this condition is irrelevant. Then C for casual taxable person. Who is a casual taxable person? A person come from other state to this state, just like NRTP from outside India to India. CTP will come from other state to this state and is not having any physical place of business in this state. Then manufacture of certain notified goods. What are those notified goods? Ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters, bricks and roofing tiles. Remember, only manufacturer of these goods cannot opt for composition scheme. What about a trader? What about a trader? Can a trader of these goods opt for composition scheme? Yes. So you need to remember who cannot opt for composition scheme. Yes, 9 RCM. Yes for supplier of service other than supply of food or beyond 10% limit. Then N for non-resident taxable person. I, interstate supply of goods or services. Another N, non-taxable supplies. E, e-commerce operator, supply of goods or services through e-commerce operator. R, RCM under 9 subsection 4. C, casual taxable person. M, manufacturer of notified goods. What are those notified goods? Ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters, bricks and roofing tiles. So these cases, composition scheme is not possible under 10 subsection 1. Okay. Now, in case of 10(2)(a), what is the differences? So 10(2)(a) is applicable, composition scheme under 10(2)(a) is applicable if aggregate turnover during the previous year does not exceed 50 lakhs. And who can go for 10(2)(a)? Any manufacturer, trader or any service provider. But for manufacturer, 10(1) is only beneficial because limit is also high and rate is also less. But if you see in case of 10(2)(a), the rate is 3% CGST, 3% SGST on total turnover. So manufacturer and trader definitely will go for 10(1). Even supply of food service provider also will go for 10(1). Then 10(2)(a) is preferable to whom? A person to whom 10(1) is not applicable. That is service provider other than supply of food, or to whom 10(1) is applicable but the services, other services exceeds 10% limit. So because being in 10(1) they can provide other services up to 10% of turnover during previous year or 5 lakhs, whichever is higher. If they want to cross that limit, then 10(2)(a) will be beneficial for them. And in case of 10(2)(a), what should be the aggregate turnover during previous year? It should not exceed 50 lakhs. And what is the rates? 3% CGST, 3% SGST. And current year also up to what turnover they will be into composition scheme? 50 lakhs. And what is the difference in condition? Here it is S9 RCM, here it is 9 RCM. Because yes, services, any services they can provide due to that reason. And next, What is the meaning of aggregate turnover for determining the eligibility to opt for composition scheme? Generally, what is the meaning of aggregate turnover? Generally, for normal cases, we discuss taxable supply, non-taxable supply, exempted supplies, zero rated supplies, excludes inward supplies under RCM and taxes. Correct? Now, extra 2 points you need to remember. It will become aggregate turnover for determining the eligibility to opt for composition scheme. That is, excludes interest on loans, advances, deposits, and it will include pre-registration turnover. Okay, what are the 2 points you need to remember? So, aggregate turnover, general meaning of aggregate turnover, it excludes interest on loans, advances, deposits, and it includes pre-registration turnover. What does that pre-registration turnover means? Say for example, in the previous year 2021-22, I commenced the business. I commenced the business in the previous year 2021-22, and so up to 40 lakhs, I have not got registered, no registration. After crossing 40 lakhs, I have registered, and my turnover post registration, so this is pre-registration turnover, 40 lakhs, and post registration my turnover is 120 lakhs, and current year 2022-23, can I opt for composition scheme? So we should take only the post registration turnover, or should we add pre-registration turnover also? We should add pre-registration turnover also. So total will be how much? 160 lakhs, which exceeds 150 lakhs. So current year, can we opt for composition scheme? No. So what is the meaning of aggregate turnover for determining the eligibility to opt for composition scheme, which is common between 10.1 and 10.2a. So whatever points that we are going to discuss now will be common between 10.1 and 10.2a. So because we have seen what are all the differences between 10.1 and 10.2a, remaining and all will be common. You understood? So what is the meaning of aggregate turnover? Come on. Taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies, excludes inward supplies under RCM, excludes taxes, excludes interest on loans, advances, deposits, and excludes pre-registration turnover. Interest income will not be considered for calculating aggregate turnover as well as turnover in a state or union territory. Now, what is the meaning of turnover in a state or union territory? Turnover in a state or union territory is same as aggregate turnover, except that turnover in a state or union territory is computed state-wise, and aggregate turnover will be computed on all India basis. But both definitions are same. Okay. Aggregate turnover, turnover in a state or union territory. Where we use turnover in a state or union territory, while computing this 10% limit, we use the word turnover in a state or union territory. A person who opts to pay tax under 10.1 may supply services other than supply of food not exceeding 10% of turnover in a state or union territory in the preceding year, or 5 lakhs, whichever is higher. And while computing this 10% limit also, we should not take interest on loans, advances, deposits. So what does it mean? Say, for example, previous year 2021-22, I am having business in 3 states, Tamil Nadu, Andhra Pradesh and Karnataka, and my turnover in Tamil Nadu is 30 lakhs, and turnover in Andhra Pradesh is 40 lakhs, and turnover in Karnataka is 60 lakhs. Okay. So total turnover is 130 lakhs. So it does not exceed 150 lakhs. So current year 2022-23, can I opt for composition scheme? Yes, you can opt for composition scheme. But to what extent we can provide the services during the current year? To what extent we can provide the services during current year? Total 130 into 10%, 13 lakhs or 5 lakhs, whichever is higher. Is it correct? No. So we should never do it on aggregate turnover basis. State wise we need to see. So therefore services during the current year, 30 lakhs into 10%, 3 lakhs or 5 lakhs, whichever is higher, 5 lakhs. And again for Andhra Pradesh it will be 5 lakhs. And for Karnataka it is 6 lakhs. So we can provide the services during the current year to the extent of 5 lakhs in Tamil Nadu, 5 lakhs in Andhra Pradesh and 6 lakhs in Karnataka. And suppose if you are crossing 5 lakhs in Tamil Nadu, but overall it is within limit of 16 lakhs, because total we can provide services how much? 16 lakhs. But in Tamil Nadu alone we crossed 5 lakhs, but overall it is within 16 lakhs. Are we eligible for composition scheme? No. So once we are disqualified under composition scheme in Tamil Nadu, we are automatically disqualified in composition scheme from other states also, because composition scheme will be all in or all out. Means if you are ineligible for composition scheme in one registration, all the other registrations also composition scheme will be ineligible. Is it clear? And next one, while computing this 10% limit, so services by way of interest etc. should not be considered. For example, previous year 2021-22, so my turnover is 120 lakhs. Current year 2022-23, so I am providing some goods and services, okay, both supply of goods and supply of services. So goods and services, and these services we have, interest income 8 lakhs and other services 10 lakhs. Okay. Now 120 lakhs. To what extent I can provide services during the current year? 12 lakhs. 120 into 10%, 12 lakhs or 5 lakhs, whichever is higher, 12 lakhs. But here if you see, the services is 18 lakhs. So does it mean we breach the condition? No. So while counting this 12 lakhs, don't take interest income, which means other services other than interest. So which means 10 lakhs. It is within the limit of 12 lakhs. So we can continue in the composition scheme. So while computing this 10% limit of services, so we will not consider supply of food etc. Why supply of food? Because supply of food no restriction. So because it is covered under 10.1, and interest on loans, advances, deposits also no restriction, how much ever it can be there. So therefore we will see services other than supply of food and other than interest should not exceed 10% of the limit during the previous year, turnover limit during the previous year, or 5 lakhs, whichever is higher. That is this point. And what is the tax rate applicable for these services? The tax rate applicable to a trader, that is 0.5% CGST, 0.5% SGST on taxable turnover. Then, sir, I have purchase of commodities from agricultural commodity exchange. Will it be supply under GST? So why? I don't know. Supply means supply. Supply is there, but taxable or exempted, we don't know what type of agricultural commodity it is. Okay. So therefore, whenever you purchase agricultural commodities, so from commodity exchange where there is physical delivery. Usually commodity exchanges and all, there is no physical delivery and all. So it is only the settlement, difference in the prices. So futures and options kind of commodity exchanges, how it will operate is that, so it will be settlement, mark to market settlement. So mark to market settlement means physical delivery and all will not arise with respect to that. So first of all, in that case, there is no supply, okay, and futures and options are treated as securities. Securities are not goods nor services, okay, unrelated question this is. And then, sir, interstate, I also read that maybe they were asking about interstate purchases, can I have sir like that. So interstate purchases you can have, interstate purchases no restriction, interstate sales only you should not have, you can have interstate purchases. Now in that case, whenever I need to pay GST under RCM, I need to pay at what rate? For example, I am under composition scheme, trader. I need to pay 0.5% CGST, 0.5% SGST on total taxable turnover. Now I have some inward supplies on which I need to pay GST under RCM. For that also I can pay 0.5% CGST, 0.5 SGST. No, on that I need to pay at the regular rates. Okay. Now see other procedural provisions. If you are already registered, how to opt for composition scheme? You need to file one form, that is CMP2, when before commencement of the financial year. Suppose if you are already not registered, now only you are going into registration, you need to file one form, that is REG1, and you need to select the composition scheme. And so that is during during the financial year, anytime you can enter into the composition scheme if you are not a registered person, because in the registration application you will select the option as composition scheme. But if you are already a registered person, you need to wait till the commencement of the financial year. Once the financial year commences, then only you can go into the composition scheme. Display of composition taxable person in every notice, signboard displayed at the principal place of business and additional place of business. And a person opting for composition scheme is required to file a quarterly return. That quarterly return is in CMP 8 by 18th of the month following every quarter. Then whether GST is payable on advances in case of goods by a person under composition scheme, yes. Yesterday I did not mention this point while discussing time of supply section 14, that section 14 is applicable for composition scheme, goods also. I said section 14 is applicable only in case of supply of services normally, because this notification 66/2017 is not applicable for a person opting for composition scheme. So which means section 14 is applicable even in case of goods for a person opting for composition scheme, yes. And normal provisions of time of supply will be applicable in case of person opting for composition scheme, which means they need to pay GST on advances. So then how to compute the GST payable? First they need to take whatever is the bill of supply during the quarter, value as per bill of supply during the quarter, because a person opting for composition scheme will be giving bill of supply, and add advances received during the quarter pertaining to the next quarter. Advances, because for which bill is not raised during the quarter, add advances received during the quarter for which bill of supply is raised in the next quarter, minus advances received in the previous quarter for which bill of supply is raised in the current quarter, because that advance is already taxed. That advance is already taxed. So minus advances received during previous quarter pertaining to current quarter. So this should be taken as the value for payment of GST under composition scheme. And they need to file an annual return in GSTR4 by 30th April of the succeeding financial year. Then validity of composition scheme, if all the conditions are valid, the option remains, if all the conditions are satisfied, the option remains valid, which means that every time they don't have to make application for composition scheme, which means first year they opted for composition scheme. So second year also can they continue in the composition scheme? Yes, if all the conditions are satisfied, and no need to again file a intimation. Okay, then if conditions are not satisfied, what they need to do? They need to come out of the composition scheme by filing a intimation in CMP4, entry into the composition scheme CMP2, exit from the composition scheme CMP4. And what is the time limit within which they need to exit from the composition scheme? Within 7 days they need to file form CMP4 as intimation, and self withdraw voluntarily also they can come out even though they satisfied the conditions. So why? Because composition scheme will not be feasible if there is no increase in the volume, because the disadvantage in composition scheme is that they cannot take ITC on inward supply and they cannot charge GST from the recipient, which means the profitability will be less. Then the only way to increase their profit is by increasing the volume. Suppose if the volume is not increasing, they will come out of the composition scheme. Anytime voluntarily they can come out of the composition scheme. Whenever they come out of the composition scheme and go into normal scheme, 18(1)(c) gets attracted. So they can take ITC on the closing stock, inputs as such held in stock, inputs in WIP, inputs in FG, even capital goods. For that they need to file one form ITC1, ITC1, statement in form ITC1. Within 30 days of intimation, they need to file for the purpose of coming out of the composition scheme and going into normal scheme. And when proper officer is of the opinion that a person has breached the conditions of composition scheme but still continuing in the composition scheme, so they will be giving a notice in CMP5. And once they give the notice, within 15 days we need to give reply to the notice in CMP6. And after giving reply in CMP6, within 30 days they need to pass an order in CMP7, either allowing us to continue in the composition scheme or denying the composition scheme. This denial of composition scheme will be prospective or retrospective? Depends. It can be either prospective or it can be retrospective, but not before the date when we committed the breach. For example, we committed the breach on 18 September 2022 and we continued in the composition scheme for the entire financial year 22-23, and 2024 they identified that we made a breach and they are denying the composition scheme retrospectively. They can retrospectively deny it, but not before 18 September 2022, because on that date only we committed the breach. Is it clear or not? So therefore, denial of composition scheme can be prospective or retrospective. However, such effective date shall not be prior to the date of contravention of the provisions of Act or rules. Now, this is the overview of various forms. CMP2. CMP2 is for what? Entry into composition scheme. Whenever you enter into composition scheme, 18 subsection 4 gets attracted. Normal scheme to composition scheme. So you need to reverse the ITZ on closing stock. So for that you need to file one form ITZ3. So therefore CMP2 and ITZ3 is one combination. Is it clear or not? And CMP4, whenever you are coming out of the composition scheme, you can avail the ITZ on closing stock. Therefore CMP4 and ITZ1 is one combination. Then CMP5 show cause notice, 6 reply to notice, 7 issue of order, and 8 is a return to be filed. So what is the time limit for filing CMP8? 18th of the month following every quarter. Notice, no time limit. Reply to notice, 15 days. And order, 30 days. What is the time limit within which CMP2 should be filed? Before commencement of the financial year. What is the time limit within which ITZ3 should be filed? 60 days. 60 days from the commencement of the financial year. And what is the time limit within which ITZ1 should be filed? Within 30 days from the date of conversion. Conversion from composition scheme to normal scheme. And what is the time limit for intimation for withdrawal from the composition scheme? 7 days. Then, when is it advisable to opt for composition scheme under 10(2)(a)? So, a registered person who is exclusively engaged in supply of services other than restaurant services, or who is engaged in supply of service other than restaurant service along with supply of goods of value exceeding 5 lakhs in the current financial year. Why? Previous year aggregate turnover should not exceed 50 lakhs. Okay, 50 lakhs into 10% or 5 lakhs, whichever is higher, 5 lakhs. Correct? So means if I cross the services beyond 5 lakhs, I can come into the composition scheme 10(2)(a). Correct or not? For example, previous year my turnover is 60 lakhs pa. I cannot come into 10(2)(a) na. So therefore, previous year my aggregate turnover should not exceed 50 lakhs. And I have rendered services more than 10%. So then I can come into 10(2)(a). Okay, more than 10% of 50 lakhs means what? 5 lakhs. So I will come into composition scheme under 10(2)(a). Then meaning of various turnovers. So we have total 3 turnovers under composition scheme. Aggregate turnover for determining the eligibility to opt for composition scheme, and turnover for determining 10% limit of services, and turnover for payment of GST under composition scheme. So this aggregate turnover should be determined for current year or previous year? Previous year. Turnover for computing 10% limit also previous year. But turnover for payment of GST under composition scheme current year. And aggregate turnover should be computed on what basis? All India. Turnover for determining 10% limit state-wise. Turnover for payment of GST under composition scheme state-wise. What is the meaning of aggregate turnover for determining eligibility to opt for composition scheme? Taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies. Whether interest on loans advances will be coming? No, it will not be coming. Okay. Whether inward supplies will be coming under RCM? No. And whether interstate supplies will be taken? Yes. Non-taxable supplies also taken? Yes. But sir, interstate supplies, non-taxable supplies, they cannot be into composition scheme. That is for the current year. Previous year you can have non-taxable supply, previous year you can have interstate supplies, etc. Then taxes also will not come and pre-registration turnover will be included. Now the same meaning of aggregate turnover for determining eligibility to opt for composition scheme is the meaning of turnover. Everything same except that this aggregate turnover is on all India basis. This will be computed state or union territory wise. Even for computing 10% limit, limit of services, pre-registration turnover will be included. Then turnover for payment of GST under composition scheme. So this should be computed for the previous year or current year, and state wise. So here taxable supplies, exempted supplies and interest will not be included. So therefore in all these three turnovers, what is common? Interest on loans, advances, deposits will not be included, it will be excluded. And why non-taxable supplies it is given as not applicable? Because if you are having non-taxable supplies, how you will be into composition scheme? Same way export of goods or service or interstate supplies, because interstate supply of goods or service also are ineligible for composition scheme. So these three things should not be there. And inward supply under RCM excluded, taxes also excluded, pre-registration turnover, this is extra point to be excluded. So what does it mean? See this, say during the current year 2022-23, you are under composition scheme 10 subsection 1, composition scheme 10 subsection 1, and current year 2022-23 only you commence the business, and your aggregate turnover is total 240 lakhs. Your aggregate turnover is 240 lakhs. Okay, your aggregate turnover is how much? 240 lakhs. Now in this 240 lakhs, what is your pre-registration turnover? Pre-registration turnover, how 150 lakhs? Here only 40 lakhs, because only after crossing 40 lakhs you need to register na. So pre-registration turnover is 40 lakhs. On that, whether you need to pay any GST? No, you are not required to pay any GST. And thereafter on the next 150 110 110. Why 110 lakhs? Why 110 lakhs? Sir, overall 150, in that first 40 under pre-registration, no GST. Thereafter 110 lakhs, we need to pay GST under composition scheme. GST under composition scheme. Then what is the balance turnover? 90 lakhs. On that 90 lakhs, we need to pay GST under normal scheme. Is it clear? GST under normal scheme. Sir, this I am finding it difficult, sir. Okay, I will give you a super way. One section 10 subsection 1, up to what limit you will be in composition scheme? 150, correct? Correct, 150. 150 lakhs, exclude pre-registration turnover, minus 40. So remaining 110 lakhs. On that you pay GST under composition scheme, and remaining 90 lakhs you pay GST under normal scheme. Is that okay? Total turnover you take pa. What is the turnover under composition scheme? 150. What is the turnover under normal scheme? 90. So 90 normal rate, correct? And 150. In that 150, pre-registration turnover should be excluded. So in that 150, what is the pre-registration turnover? 40. So remaining 110. What if the pre-registration turnover is 20 lakhs? Because in some states 20 lakhs is the applicable threshold limit. Then 130. Suppose if it is 50 lakhs case, 10 to A, 50 lakhs, 10 to A, 50 lakhs will be under composition scheme. Okay. So for that 50 lakhs, minus pre-registration turnover 20 lakhs. So remaining 30 lakhs only you pay GST under composition scheme. Is it clear or not? So that is what I mean to say, pre-registration turnover will be excluded while determining the GST payable under composition scheme. Not applicable means what? These supplies cannot be made during the current year, and if made, the person is disqualified from the composition scheme. Okay. Clear here? So with this we completed composition scheme, and we'll take a break, and thereafter we will continue with registration. Okay, registration and then returns, payment process, etc. And so some students were asking ITZ question and answer. So this is a rocket revision batch, darling. So this clearly I said I will be taking from the That's It book, and nowhere I committed that I will do problems and solutions and all. That problems and solutions will be uploaded. Mighty 50 questions will be uploaded. Why not ask fast track batch, regular batch also? Na? I will upload that also in YouTube. Also ask my property details. I will sign. I will give. Take. Okay, sale of flats, then only the rate of GST is 1.5%, 7.5%. Whenever there is 18% or 28%, it is not on account of flats. It is on account of laying down roads, bridges, etc. or constructing some commercial complexes. Those case only 12% or 18%. So then in that case, so this 1/3 reduction is not applicable, because 1/3 reduction is applicable only in case of sale of flats. Sale of flats, wherever it comes, so 7.5 or 1.5 is the rate. So therefore this point is irrelevant, in the sense like not connected. Sir, that interest provision section 16 read with section 41, is it applicable for May 23 or not? See, for May 23 that section is applicable, but what is not applicable is the time limit. So what is the time limit within which supplier has to file 3B? The time limit is not applicable, but the section provisions, everything is applicable. Then we are starting with segment 9, that is registration under GST. So from now onwards, that is segment 9 to end. So mostly this will be for MCQ or theory questions, and third priority only practical. So first will be for MCQ purpose, second will be theory type questions, that is case study type questions, and third priority only practical questions. And so far up to segment number 8 what we have discussed, so we will get lot of practical questions on that. And registration, we have section 22 to section 30, and section up to section 21 we have completed in input tax credit, and thereafter 22, 23, 24 talks about the legality of registration. 22 says that when a person is required to get registered, and 23 is when a person is exempted from registration, and 24 is compulsory registration, and section 25 procedure for registration, section 26 deemed registration, and 27 special provision for CTP and NRTP. Then last 3 sections is special cases, that is 28 amendment in registration, 29 cancellation of registration, and 30 revocation of cancellation of registration. And now, so first we are discussing section 22, when a person is required to get registered. So we need to check their threshold limit. If they cross the threshold limit, if their aggregate turnover cross the threshold limit, then they need to register. So what is the threshold limit for registration? So if they are doing business in 4 states, that is M, M, T, N, and if they are doing business in a single state and that single state is in MMTN, then the limit will be 10 lakhs, let it be goods or services. They are doing business in single state and that single state is in use stamp, then the limit will be 20 lakhs, let it be goods or services. And if they are doing business in other states, then the limit will be 40 lakhs if they are exclusively engaged in supply of goods, and if they are engaged in supply of both goods and services or services, it will be 20 lakhs. What is MMTN? Manipur, Mizoram, Tripura, Nagaland. And use stamp is Uttarakhand, Sikkim, Arunachal Pradesh, okay, Telangana, Arunachal Pradesh, Meghalaya and Puducherry, 6 states. So I am doing business. First I need to check in the question whether I am doing business in single state or multiple states. I am doing business in single state. That single state is in MMTN. Then the limit will be 10 lakhs. And then that single state is in the list of use stamp. Then the limit will be 20 lakhs. If it is in other state, for example, Tamil Nadu, so not in this list. So and I am exclusively engaged in supply of goods. So the limit will be 40 lakhs. I am in Telangana, exclusively engaged in supply of goods, 20 lakhs because use stamp. I am in Nagaland, exclusively engaged in supply of goods, 10 lakhs because MMTN. I am in Karnataka, engaged in supply both goods and services, then the limit will be 20 lakhs. And I am in say Andhra Pradesh, I am rendering only services, then the limit will be 20 lakhs. If I am rendering only goods in Andhra Pradesh, 40 lakhs. But in Telangana, it will become 20 lakhs. Is it clear? Now, so that is this 3 points. For 4 states, MMTN, 10 lakhs limit. For use stamp, 20 lakhs. For all other state, 20 lakhs limit for service and 40 lakhs limit for goods. And this aggregate turnover will be computed on all India basis or state wise on all India basis. and the limit of 40 lakhs is applicable only in case of exclusive supply of goods. If a person is engaged in supply of goods and services or supply of services, then the limit will be 20 lakhs or 10 lakhs. And if the supplies are made from multiple states, then what we need to do? So in case of multiple states, I am doing business in multiple states. Here also 3 points I need to remember. Number 1, that is, out of these multiple states, one state is in MMTN and taxable supplies are made from that state, then the limit will be 10 lakhs. What is that? Out of these multiple states, one state is in Manipur, Mizoram, Tripura, Nagaland, and I am making taxable supplies from that state. So then the limit will be 10 lakhs. And if I am doing business in multiple states and none of these states is in MMTN use stamp, I am doing business in multiple states, none of the state is in MMTN use stamp and I am exclusively engaged in supply of goods, and the limit will be 40 lakhs. In all other cases, the limit will be 20 lakhs. So, supplies are made from multiple states, and if taxable supplies are made from special category state, then 10 lakhs. If supplies are made from multiple states and in those states if use stamp is also one of the states, then the limit will be 20 lakhs. Suppose if none of the state is in MMTN use stamp and you are exclusively engaged in supply of goods, then the limit will be 40 lakhs. And the limit of 40 lakhs is not applicable in the following cases. Voluntarily when you get registered, the threshold limit is not applicable. And suppose if you are compulsorily required to get registered also, threshold limit is not applicable. And person making supply of ice cream, edible ice, pan masala, tobacco and tobacco products, but aerated waters is not here. That is only for composition scheme. But bricks and roofing tiles. And there in composition scheme, manufacturer of those notified goods cannot opt for composition scheme. But here supplier means he can be manufacturer or trader. He cannot opt for, like he cannot go for 40 lakhs limit. So now what does it mean? Should I be engaged in supply of these goods alone? 40 lakhs limit not applicable. Or for example, I have a supermarket. In that supermarket, I am selling lot of goods. Along with that goods, I am also selling ice cream. Then what will be the limit applicable to me? 40 lakhs or 20 lakhs? 40 lakhs. If I am exclusively engaged in supply of ice cream, edible ice, pan masala, tobacco products, bricks and roofing tiles, then the limit of 40 lakhs will not be applicable, it will be 20 lakhs. I am supplying other goods also, these goods also, 40 lakhs limit is applicable. If I am exclusively supplying these goods, then only 40 lakhs limit is not applicable. Then this is given in section 22 subsection 1, as and when aggregate turnover exceeds in a financial year exceeds threshold limit as discussed above, then they are liable for registration. Section 23, we have some exemption from registration. When a person is exclusively making exempted supplies or non-taxable supplies or exclusively making supplies covered under RCM, or an agriculturist engaged only out of supply, out of cultivation of land. So these 4 cases, they are exempted from registration. What are the 4 cases here? Exclusively making exempted supplies or agriculturist, but that agriculturist should be engaged only in supply out of cultivation of land. For example, a groundnut farmer engaged in sale of groundnut. So whatever may be the turnover, not required to register. They are selling groundnut. Also they are processing groundnut oil and they are selling. Now in that case, are they engaged only in supply out of cultivation of land? No. So in that case, this exemption will not be applicable. Then if my outward supply is fully covered under RCM, so whether I am exempted from registration? Yes. So for example, advocate's outward supply is fully covered under RCM, so they are exempted from registration. Suppose if a person is making both exempted and taxable supply, then the above exemption is available or not available? Not available. And compulsory registration is there in 2 places. 22 also compulsory registration is there, 24 also compulsory registration is there. But the difference in 22 compulsory registration versus 24 compulsory registration is that in 22 compulsory registration, so we have to register, then we can make application for cancellation of registration. But in 24 compulsory registration, we need to register and we can never make application for cancellation if the turnover falls below the threshold limit. But that advantage we have in 22. So that's what I have given note. They can make application for cancellation of registration if their aggregate turnover falls below threshold limit. But is that possible in case of 24? No. So 22 compulsory registration is in 3 cases. That is, I am already registered under earlier indirect tax law, and then in that case, so I am required to get registered compulsorily under GST law also. But suppose if my turnover falls below limit, I can make application for cancellation. Same way, whenever there is a transfer of business, if the transferor is registered, transferee also should definitely get registered. And suppose if the transferee's turnover is below threshold limit, they can make application for cancellation of registration. Then transfer pursuant to a scheme of amalgamation or demerger. So there is a resulting company coming into existence. That resulting company is a new company. Aggregate turnover is 0. Even then the resulting company has to compulsorily get registered. But whenever their turnover falls below threshold limit, they can make application for cancellation. What are the 3 compulsory registrations under section 22? So registered under earlier law, transfer of business, or transfer pursuant to a scheme of amalgamation, merger or demerger. Then compulsory registration under section 24 is in case of I creations. I creations, you need to remember, I for interstate supply of goods. The 2 what goods? Taxable goods. Interstate supply of taxable goods. Whether interstate supply of services is compulsorily required to get registered? No. And interstate supply of taxable goods other than handicrafts. Suppose if a person is making interstate supply of handicrafts, are they compulsorily required to register? No. So I refers to interstate supply of taxable goods other than handicrafts. C for casual taxable person other than handicrafts. Then R for recipient liable to pay GST under RCM 9 subsection 3 compulsorily required to get registered. Then E for e-commerce operator. Which e-commerce operator? 2 e-commerce operator. E-commerce operator liable to pay GST under 9 subsection 5 HATE, or e-commerce operator liable to deduct TCS under section 52. Then A for agent. Agent making supply on behalf of principal. And TDS deductor. Then I, input service distributor, who distribute the credit to the branches. And then I, OIDR supplier located outside India, making supply to non-taxable online recipient in India. Then N, NRTP, non-resident taxable person. And S, supplier of goods through e-commerce operator. So these people are compulsorily required to get registered irrespective of threshold limit. Then suppose if a person is covered under section 24, also covered under section 23, then section 23 will override every section. So section 23 overrides 22 as well as 24, and section 24 will override only one section. What is that? Section 22 subsection 1. So which means if a person is exempted from registration, they are exempted from registration, they are not at all required to get registered. And then we need to check, are they compulsorily required to get registered? Yes, then they are required to get registered. Otherwise, then they need to register only when their aggregate turnover exceeds threshold limit. Then we have section 25. So 22, 23, 24 we completed. 25 is procedure for registration. For this procedure for registration, we need to remember 6 forms. REG1, application for registration. REG2, acknowledgement. REG3, notice. And REG4, reply to the notice. REG5, cancellation, that is rejection of application. REG6, certificate of registration. Now, what is the time limit within which we need to make application for registration? Generally within 30 days. From the date we are liable to get registered, we need to make application for registration. However, in case of CTP and NRTP, when they need to make application for registration, at least 5 days before commencement of business. CTP and NRTP will get a permanent registration or a temporary registration. Temporary registration. So for them, they have to make application at least 5 days before commencement of business, and all others they need to make application within 30 days from the date they are liable to get registered. And this time limit from REG1 to REG2, acknowledgement will be generated immediately. And once we file application, within 7 working days, either we need to get notice or we need to get registration certificate. So please check, REG3 or REG6 should be within 7 working days. And same way, from the time when we give the reply to the notice in REG4, from REG4, REG5 or REG6, that is rejection of application or certificate of registration, should be within 7 working days. And what is the time limit for reply to the notice? 7 working days. So in procedure for registration, everywhere the time limit is 7 working days. Then next, so we have to furnish the bank details. What is the time limit within which the bank details needs to be furnished? Bank details can be furnished at the time of making application for registration, or we can submit the bank details at a later point of time also. But that later point of time is within 45 days from the date of registration or due date of filing 3B, whichever is earlier. Okay, so 45 days from the date of registration certificate or due date of filing 3B, whichever is earlier. That is submission of bank details after registration. And Aadhaar authentication, at the time when we make application for registration, we can either select Aadhaar authentication or make application without Aadhaar authentication. Suppose if you are selecting Aadhaar authentication, then the authentication should be completed within 15 days from the date of submission of Part B. And what if within 15 days we are not completing the authentication? On expiry of 15 days, it is deemed that the application is filed without Aadhaar authentication. And within this 15 days, whenever we complete the authentication, that date only will be taken as the date of submission of application. So say this, Aadhaar authentication after submission of Part B of REG1, one authentication link will be sent and we need to successfully complete the Aadhaar authentication. And once we complete the authentication, that is the date of application. So within 7 working days from authentication, we will get the registration certificate. Suppose if the authentication is not completed within 15 days, on expiry of 15 days, it is deemed that you submitted the application without Aadhaar authentication. Then suppose if the application is submitted without Aadhaar authentication or submitted with authentication and not completed authentication within 15 days, thereafter within 30 days, so the physical verification will be conducted and thereafter only they will be giving the registration certificate. So therefore, if you submit the application without authentication, 30 days from the date of submission of application, so they have to complete physical verification and issue registration certificate. Suppose you submitted with authentication, 15 days over, then the 30 days will be counted after expiry of 15 days. After expiry of 15 days, that 30 days will be counted. Okay, understood or not? Now, here we have something called as deemed registration. What are the cases where we have deemed registration? So total 4 places. Number 1, that is you made an application, concentrate, please concentrate. You made an application for registration and within 7 working days, you neither got a notice nor got a registration certificate, then it is deemed registration. So you made an application means what? You completed authentication. Within 7 working days, you neither got notice nor got certificate of registration, deemed registration, first point. Second point, you completed authentication and you got a notice. You gave a reply to the notice. After reply to the notice, within 7 working days, you did not get registration certificate or they did not reject the application, then also deemed registration. Number 3, you submitted application without authentication and within 30 days they have not given the registration certificate after physical verification, then also deemed registration. Fourth deemed registration, last point, that is you submitted application with authentication, not completed authentication within 15 days and thereafter within 30 days they have not granted the registration certificate, then also deemed registration. So this can be asked as short note question, deemed registration, 4 points. These 4 points only I have discussed now. So this can be tested for short note question. So deemed registration. Okay, clear here? Then next one. So what will be taken as the date of submission of application, date of authentication or 15 days of submission of Part B, whichever is earlier. And so what is the non-applicability of Aadhaar authentication? You see this. This can also be asked for a short note question. That is, for individual or sole proprietor, when authentication is applicable if they are citizen of India. What if they are not a citizen of India, they don't have Aadhaar number, so Aadhaar authentication not applicable. For a HUF, when Aadhaar authentication not applicable other than Karta. members other than Karta, other authentication not applicable. Then for firm LLP, when other authentication not applicable, other than authorized or managing partner. Is it clear? So what you need to remember is when other authentication is not applicable. So for that we are discussing first individual. Individual everywhere authentication applicable, but when it is not applicable, not a citizen of India. HUF, Karta needs to undergo authentication, so other members not required to undergo authentication. Then in case of firm or LLP, only authorized or managing partner required to undergo authentication. So the other partners not required to undergo authentication. In case of any other person, authorized signatory is required to undergo authentication and others are not required to undergo authentication. Whereas in case of government and its family members, authentication not required. Who is that? Central government, state government department, local authority, public sector undertaking and statutory body. These four people, authentication is not at all required. And thereafter UIN holder. So UIN holder also authentication not required. So total 9 points you need to remember. So what are those 9 points? First step, in not a citizen of India, members other than Karta and partners other than managing or authorized partner, or members other than authorized signatory, central or state government department, local authority, PSU, statutory body, UIN holder. So total 9. They are not required to undergo authentication, and even if they are already registered also, because suppose if authentication is not done initially at the time of application, every registered person is required to undergo authentication at a later point of time, but that is not applicable for these 9 people. Okay, for these 9 cases authentication is not at all applicable even at the time of making application or even if they are already registered. Then time limit for making application for registration, CTP NRTP at least 5 days before commencement of business, all others 30 days. Suppose if it is section 24, 30 days should be counted from when? 30 days from the date of commencement of business. And suppose if it is registered under earlier law, 30 days should be counted from 1/7/2017. In case of transfer of business, 30 days should be counted from the date of transfer. In case of amalgamation, merger, etc., 30 days should be counted from the date on which ROC gives certificate of incorporation to the new entity. And in case of any other person, 30 days should be counted from the date when aggregate turnover exceeds threshold limit. Then section 26, 25 we completed procedure for registration. Section 26, one deemed registration is there, which says that if a person is registered under CGST Act, they are deemed to be registered under SGST Act and IGST Act. Same way, if there is a cancellation of registration under one act, deemed to be cancellation under other act, or rejection of application under one act, deemed to be rejection of application under other acts. That is that fiction, deeming fiction. Then section 27 talks about special provision for CTP NRTP. Whether they get a permanent registration or a temporary registration. Temporary registration. What is the period for which registration will be granted to them? For a period of 90 days, and it can be extended for a further period of 90 days. So means, so up to 90 days. It is not flat 90 days, which means number of days that they are asking or 90 days, whichever is less, lower. For example, they are asking for 10 days, then 10 days only it will be given. Suppose if they are asking for 120 days, 90 days, and thereafter again on expiry of 90 days they need to make further application for extension. It can be extended for a further period not exceeding 90 days. And then for the period for which they are making application for registration as a CTP NRTP, they need to deposit advance tax, and that advance tax will be deposited into electronic cash ledger that will be utilized for payment of their liability. If there is any excess balance in the cash ledger, they can get it as a refund, and if there is any shortfall with respect to that, they need to make the payment. Okay, and that is this advance tax point. At the time of submission of application, they need to make advance deposit of tax. What should be paid as advance tax? Net tax liability, that is estimated gross tax liability minus estimated input tax credit, that is estimated net tax liability they need to pay as advance tax. Suppose if they are asking for any extension, for that extended period also again they need to pay the advance tax, and that advance tax will be created in electronic cash ledger, which will be adjusted against final liability. Then These are the distinguishing points. CTP means a person who come from other state to this state and is not having any fixed place of business in this state. Whereas NRTP will come from outside India to India and is not having any physical place of business or residence in India. And CTP undertakes a transaction in the course or furtherance of business, but NRTP no such requirement. CTP will be having a permanent account number, but NRTP will not have a permanent account number, and he can take registration using his passport. And CTP will make application for registration in REG 1 and NRTP in REG 10. And CTP will file a regular return, that is GSTR 1 and GSTR 3B, but NRTP will file a return in GSTR 5. So this also can be tested. Distinguish between CTP and NRTP, you need to prepare this table. Then next one, last three sections we have: section 28 amendment in registration, section 29 cancellation of registration, and section 30 revocation of cancellation of registration. Section 28 amendment in registration is, at the time when we make application for registration, we would have given some details. If there is any change in those details submitted at the time of application, for that we need to make an amendment application, and this changes is divided into two: core fields and non-core fields. What are the three core fields? Change in name, change in address, and change in top management, that is change in like managing director or partners or karta, etc. change in top management. These three changes is subject to approval by the proper officer. But apart from these three changes, any other change, the portal will automatically take care of that change, and this is non-core field. And suppose if we need any retrospective amendment, is it possible? No. Retrospective amendment is possible only with the order of commissioner. And what is the procedure for this amendment in registration? We need to make an application in REG 14, and that application we need to make within 15 days of that change, and thereafter so they will give a notice asking for any clarification. That notice is usual REG 3, and notice will be given within 15 working days. So from the date of submission of REG 14, when we make application for amendment, it is 15 days, but when they give notice, it will be 15 working days. And after this we need to give reply to the notice. The reply to the notice will be within 7 working days in REG 4, and thereafter if they are satisfied, they will pass an order, otherwise they will reject the application within 7 working days. Here also we have deemed acceptance or deemed amendment in registration, that is, say this, just write down, within 15 working days, within 15 working days, within 15 working days after application, within 15 working days after application, neither notice in REG 3 nor order for amendment, within 15 working days after application, neither notice in REG 3 nor order for amendment in REG 15, okay. Application is in REG 14, order is in REG 15, okay. Neither notice in REG 3 nor order in for amendment in REG 15 within 15 working days. Then amendment deemed to have taken place, amendment deemed to be accepted, amendment deemed to be accepted. Clear here? Same way, we got a notice, we gave a reply to the notice. After reply to the notice, what is the time limit within which we need to get the order? 7 working days. So that is another point. Within 7 working days, within 7 working days, neither rejection of application, within 7 working days after reply to notice, sorry, within 7 working days after reply to notice, after reply to notice, neither rejection of application, in REG 5, nor order for amendment, in REG 15. Okay, that is within 7 working days after reply to notice, we did not get rejection in application nor order for amendment. So then amendment deemed to be accepted. Clear here? Then next one is cancellation of registration. So cancellation of registration, there are some amendments in this case. So cancellation of registration is divided into 2. So in 3 cases, either registered person can make application for cancellation or proper officer can initiate cancellation. What are those 3 cases? So whenever there is transfer of business or discontinuance of business, or a person is no longer liable to be registered, or change in constitution of business, that is firm to company or company like individual to firm, etc., change in constitution. So 3 cases, that is transfer or discontinuance of business or change in constitution of business, a person no longer liable to be registered, they can make application for cancellation of registration, or proper officer suo motu can initiate cancellation of registration. And the application for cancellation of registration is in REG 16. And whenever the application for cancellation of registration is to be made, here also other authentication is necessary. And other authentication is mandatory here. It is not optional. Other authentication is mandatory for a registered person filing application for cancellation of registration. And there are 5 cases where suo motu proper officer will initiate cancellation by giving a show cause notice in REG 17. What are those cases? Number 1, contravention of the provisions of the act or rules, or a person who is under composition scheme and they are required to file an annual return and they did not file annual return within 3 months after the due date. What is the due date of filing annual return? It is 30th April of the succeeding financial year. So within 3 months after the 30th April means May, June, July. So by July, if the annual return is not filed, so then there can be cancellation of registration. So person opting for composition scheme not filed annual return of a financial year within 3 months from the due date. Suppose if a person is under other than composition scheme and they have not filed normal returns for consecutive 6 months or 2 quarters, then also their registration can be cancelled. So first is contravention of the provisions of act or rules. Second and third is what? Related to non-filing of returns. Composition scheme is what? Annual return. Not file annual return within 3 months after due date. And normal scheme is what? Not file regular returns consecutive 6 months or consecutive 2 quarters. And point number 4, registration obtained by fraud. And point number 5, obtained voluntary registration and not commence business within 6 months. These are the 5 cases where officer will initiate cancellation of registration by giving notice. So total 8 situations. Suppose if we get a question, what are the situations that leads to cancellation of registration? We need to write this 8 points. Okay. Then what are the contravention of provisions that leads to cancellation of registration? There we need to write this 7 points. Understood or not? What are the contravention of provisions that leads to cancellation of registration? 7 points. What are those 7 points? First, 3 wrong things. That is wrong invoice, wrong address, wrong ITC. Okay. Wrong invoice, wrong address, wrong ITC. Means what? You are not doing business from the place where you are required to do the business. So then wrong address. Then wrong ITC. So that is avails ITC in contravention of the provisions of section 16. First one, you are not doing business from your declared place, wrong address. Then wrong ITC, you are availing ITC in contravention of provisions of section 16. Then wrong invoice, that is you are invoicing or giving invoice in contravention of the provisions of rules. Then 3 violations. So violation number 1, violating the provisions of anti-profiteering, violating the provision of anti-profiteering, and violating the provision of furnishing the bank details within the stipulated time. What is the time limit within which we need to give bank details? 45 days from the date on which we get the registration certificate, or so the due date of filing first return, whichever is earlier. So by that time, suppose if we are not furnishing the bank details, so then also that leads to cancellation of registration or violation of rule 86B. So rule 86B is what? That is not paying 1% of your gross liability through electronic cash ledger. So that is violation of rule 86B. In these 3 cases, violation of the provisions of anti-profiteering, not furnishing bank details within the stipulated time, or not paying 1% of gross liability through electronic cash ledger, these 3 violations also there will be cancellation of registration. So total 6 points you have studied so far. What are they? Wrong ITC, wrong address, wrong invoice, violation of anti-profiteering, violation of not furnishing bank violation of furnishing bank details, violation of payment of 1% through electronic cash ledger. Then next one more point, 7th point, that is liability in GSTR 1 is greater than liability in 3B. Means you added more invoices in GSTR 1 but you have not discharged that liability in 3B, or you have availed more ITC in 3B than in 2B for 1 or more tax periods. That is also reason for cancellation of registration. So these 7 cases, that is what contravention of provisions. This first point is there na, contravention of provisions. So what are the contravention of provisions that leads to cancellation of registration is this 7 points. Now in exam, when they are asking what are the situations that leads to cancellation of registration, you need to write 8 points. What are the contravention of provisions that leads to cancellation of registration? These 7 points we need to write. Okay. Then suspension of registration. Whenever there is a cancellation of registration, whenever there is a cancellation of registration, so the notice will be given first, and thereafter the registration of a person will be suspended, or application will be made. Thereafter the registration of a person will be suspended till the conclusion of cancellation proceedings. So for example, a registered person makes an application for registration. So from that date till the conclusion of cancellation proceedings, what will happen on conclusion of cancellation proceedings? Either that person's registration will be cancelled or his application will be rejected. So till conclusion of cancellation proceedings, his registration will be suspended. So starting date is what? From the date he makes the application for cancellation, or the date selected by him in the application, whichever is later. So what is the period of suspension? You can see the registration shall be deemed to be suspended from the date of submission of application or the date on which cancellation is sought, whichever is later. Till when it will be suspended? Till the date of conclusion of cancellation proceedings. Suppose if officer is giving show cause notice, so he will specify one particular date from when your registration will be cancelled. From the date till the conclusion of cancellation proceedings, our registration will be suspended with effect from the date to be determined by him pending the completion of proceedings for cancellation of registration. Now, during the period of suspension, so what is the consequences? With respect to our outward supplies, we cannot collect GST, means we cannot give tax invoice. With respect to our inward supplies, we cannot avail ITC, means we cannot file GSTR 3B return for availment of ITC. Okay. So a registered person whose registration has been suspended as above shall not make any taxable supply, means can make taxable supply but cannot issue tax invoice, and shall not be required to furnish any return. And this suspension will be deemed to be revoked whenever the cancellation proceedings are concluded. Upon conclusion of cancellation proceedings, the suspension is deemed to have been revoked. Okay. Then there is one amendment in this case. What is that? That is, during the suspension period, whatever returns we have not filed up to the date of suspension, if you are filing those returns, then suspension will be automatically revoked. Is it clear? Say for example, first you got a show cause notice for cancellation of registration. On what reason? You have not filed returns, and thereafter your registration is suspended. Now during the period of suspension, so during the period of suspension still can I file returns? Yes, not for the suspended period, but for the period up to the date of suspension you can file those returns, and once you file those returns, so automatic revocation of suspension. And suppose after conclusion of cancellation proceedings, what will happen? Either cancellation order will be given or notice will be dropped. If they pass a cancellation order, still you can get the revocation of cancellation by filing an application for revocation of cancellation, that is section 30. That is, within the suspended period you file the return so that registration will be continued, suspension is revoked. Or they passed a cancellation order. After passing cancellation order, you want to continue in the registration. For that, what you need to do? You need to make an application for revocation of cancellation in REG 21. What is the time limit within which you need to make application for revocation? Within 30 days from the date you got the cancellation order. From the date you got the cancellation order within 30 days, it can be extended for a further period of 30 days by additional or joint commissioner, and it can be extended for a further period of 30 days by commissioner. So 330 days, section 30, revocation of cancellation, 330 days, okay. So 30 days from the date of order plus 30 days by additional or joint commissioner plus 30 days by commissioner. So proper officer is satisfied. And one more thing, before making application for revocation, all the pending returns should be filed. And if the proper officer is satisfied, yes, immediately they will revoke the cancellation order in REG 22. If not satisfied, they will give an opportunity of being heard, in that is notice will be given, and thereafter you need to give a reply to the notice within 7 working days. So here opportunity of being heard in REG 3, notice in REG 3 here, notice in REG 3, and thereafter within 7 working days you need to furnish the reply in REG 23, that is correct only, and then within 30 days if the proper officer is satisfied, they will give a revoke the cancellation order, or if they are not satisfied, so they will reject the application. Clear? So therefore first what will happen? Order. From that order within 30 days we have to make application for revocation. It can be extended for a further period of 30 days by additional or joint, thereafter further 30 days by commissioner, and after that within 7 days either we need to get the order or we need to get the notice. Correct? No. So that is not given. We will get either the revocation order or the notice, but thereafter within 7 working days we need to give reply. You understood or not? The 7 working days is not for giving notice or passing the order, that is not there. But once they give notice, within 7 working days we need to give reply, and thereafter within 30 days if the proper officer is satisfied, they will revoke the cancellation order or they will reject the application. Now even for making application for revocation of cancellation also Aadhaar authentication is mandatory. So there are 3 places we come across Aadhaar authentication. One is application for registration, second application for cancellation of registration, third application for revocation of cancellation. So that is about registration that we have completed, okay. The mistake, that is actually 2 consecutive quarters, 2 consecutive quarters, 6 months or 2 consecutive quarters. It is 6 months or 2 consecutive quarters, that should be taken, okay. Then so we are moving on to the next area, that is segment 10, payment process. So give me 5 minutes. I'll be back. Take a small break for 5 minutes. Okay, we'll continue. Can we take two registrations in one permanent account number in the same state for the same nature of business? Two registrations in one permanent account number in the same state? Yes. But it should be different place of business. Then registered person have not filed for 2 months cancellation of registration. See, it's not 2 months here, it is 2 quarters. That's what I rectified. So it is like 6 consecutive months or 2 consecutive quarters. 2 consecutive quarters. Okay. Then, so look into this segment 103, page number, say segment 10, page number 103, payment process. So section 49 and section 50, only 2 sections are there in this. Section 49 talks about what are the various ledgers, electronic ledgers which are to be maintained by a registered person, maintained by GST network on behalf of the registered person, and section 50 is about interest on account of delay in payment of tax or wrong availment and utilization. So section 49 says that on behalf of every registered person, GST portal will be maintaining 3 ledgers, that is electronic liability ledger, electronic credit ledger and electronic cash ledger. And whatever balance that is there in electronic cash ledger can be used for payment of tax, interest, penalty, fee and others, tax dues and other dues. But whatever balance that is there in credit ledger can be used only for payment of tax dues and cannot be used for payment of other dues. And how the money will come into the electronic credit ledger? Either whenever we take ITC through GSTR 3B or ITC 1, that is availment of ITC on closing stock, or ITC 2, that is transfer of business, or ITC 2A, single registration getting separated into multiple registration. All those ITCs will come into electronic credit ledger, and the outflow of the credit ledger is for payment of liability ledger. Then how money will come into cash ledger? Maybe deposit through GST PMT 6 challan and TDS TCS deducted by recipient and the e-commerce operator. So that will also be given into electronic cash ledger, and any refunds that are to be given, for example excess payment of tax etc., that refund will come into the cash ledger. And whatever money that is coming into the cash ledger, the outflow of the cash ledger is for payment of liability ledger. Whatever is the outflow of liability ledger, that will be inflow into the whatever is the outflow of credit ledger and cash ledger will be inflow into the liability ledger, and liability ledger is used for payment of tax dues and other dues. So electronic liability ledger is in PMT 1 and credit ledger is in PMT 2 and cash ledger is in PMT 5. And whatever balance that is there in the electronic credit ledger or cash ledger, after payment of interest, penalty, fee or any other amount can be refunded. But there is no restriction with respect to refund of balance in the cash ledger. But the refund of balance in the credit ledger is possible only in 2 cases. What are those 2 cases? Inverted tax structure and zero rated supplies. Only in those 2 cases. What is the meaning of inverted tax structure? The tax rate on outward supply is less than the tax rate on inward supply. Now we have some special points on electronic cash ledger. What are the various modes of deposit into the electronic cash ledger? So internet banking, debit card, credit card, NEFT, RTGS, over the counter cash deposit. But that over the counter cash deposit is up to how much? 10,000 per tax period. And now we have an amendment, UPI and IMPS is also allowed. So total 6 modes of deposit of money into the electronic cash ledger through PMT 6 challan. What are they? Internet banking, debit card or credit card, NEFT, RTGS, over the counter cash deposit up to 10,000, UPI and IMPS. Okay. Then when payment is debited in the bank account and not credited into electronic cash ledger, then communication to the payment gateway shall be made through PMT 7. That is, whenever the money gets debited in our bank account but not credited into electronic cash ledger, we will communicate to the payment gateway through the portal. So that communication will be in PMT 7. Then for transfer of balances between the major heads and minor heads in the electronic cash ledger, so one form is notified, that is PMT 9. That is, in the cash ledger we have total 4 major heads and 5 minor heads. What are the 4 major heads? CGST, SGST, then SGST or UTGST, and then IGST and compensation cess. These are the four major heads, and the five minor heads are tax, interest, penalty, fee, and others. So now between one cell to another cell in the cash ledger, we can transfer the balances, that is in this 20 cell matrix. From any cell to any cell we can transfer the balances in the cash ledger. For transferring the balances, we will be using one form, that is PMT9. Also, balance available in the electronic cash ledger can be transferred between distinct persons. What does it mean? Say for example, so if we have two distinct persons for A Limited in Tamil Nadu and Andhra Pradesh. Now, from Tamil Nadu to Andhra Pradesh, from electronic cash ledger, the balance can be transferred. Now, that is an amendment. Previously, this was not there. Previously, the balances can be transferred between these cells, from one cell to another cell. But now, the balance can be transferred between the distinct persons, from electronic cash ledger of one distinct person to electronic cash ledger of another distinct person. For transferring these balances, so we have one new form, that is PMT9A. So just write down what is the form? Form GST PMT9A. Form GST PMT9A is the form for transfer of balances between the distinct persons. But one condition is that here there should not be any liability, pending liability. Means we have utilized all the liabilities, but still there is some balance in the cash ledger that can be transferred to the cash ledger of a distinct person in the another state, and any cell to any cell it can be transferred. Okay. So for that, what is the form? PMT9A. Then special points on electronic credit ledger. So whatever balance in the credit ledger, we can get refund only in two cases. What are those two cases? Inverted tax structure and zero rated supplies. So inverted tax structure means tax rate on output is less than the tax rate on inputs. Then whenever we have made excess payment of tax wrongly paid or paid in excess, the refund will be given to the original source. So for example, in a particular month, say July 2022, so we have got total liability in electronic liability ledger is 10 lakhs. So how this 10 lakhs is discharged? Through electronic credit ledger, we have paid 4 lakhs, and through electronic cash ledger, we have paid 6 lakhs. Okay. Now, out of this 10 lakhs, there is some excess tax paid. Excess tax paid is 75,000. How this 75,000 will be refunded? This 75,000 will be refunded into the source ledger. So what ratio the tax has been paid? Credit ledger and cash ledger 2:3 ratio, which means 75,000 into 2/3 will be given into credit ledger. Same way 75,000 into 2/5 and 3/5 will be given into the cash ledger. So 75,000 into 2/5 is what? 30,000 will be given into credit ledger, and so balance 45,000 will be given into cash ledger. So refund to the original source. So that is this. So when a registered person has claimed refund of any amount paid as tax, wrongfully paid or paid in excess for which debit has been made from credit ledger, then the said amount, if found admissible, proportionate amount debited from credit ledger shall be recredited to the electronic credit ledger. And for this refund, this 45,000 will be coming into our bank account. This 45,000 will be coming into our bank account because the payment is made through cash ledger. Whereas this 30,000 rupees will be credited back to electronic credit ledger. For giving this refund into bank account, they will be passing one order RFD6. RFD6 is refund order. But to give it as recredit into our electronic credit ledger, so that order will be passed in PMT3. PMT3. So what is the purpose of PMT3? Whenever we have tax paid wrongly and that tax is paid partly using credit ledger and partly using cash ledger, to give the refund into the credit ledger, so recredit into the credit ledger, they will be passing an order in form PMT3. And there is one more form, that is PMT3A. That PMT3A is an amendment now. So what is that PMT3A? First, we have some balance in the electronic credit ledger. Please concentrate. We have some balance in the electronic credit ledger, opening balance. So that balance in the electronic credit ledger is 4 lakhs, and we claimed a refund, ITC refund we claimed. So ITC refund we claimed 3 lakhs. When we claim refund 3 lakhs out of ITC, means that 3 lakhs will get debited. So what will be the closing balance? 1 lakh. The closing balance is 1 lakh. Now what has happened? This ITC refund whatever you have claimed is erroneous. Means wrongly you have claimed the refund. So therefore erroneous refund, either you have paid or it has been recovered from you. You understood? Either you voluntarily paid out of your identification you paid, or department has recovered along with interest. Now in that case my question is, whenever you are paying back this, because it is erroneous refund, so first you got a refund 3 lakhs into your bank account, and because it is erroneous refund you paid back that 3 lakh rupees, which means that 3 lakh rupees should again come into the credit ledger na. Sir, credit ledger there was 4 lakhs. You claimed 3 lakhs as refund. So that much amount credit ledger has come down. Now it came into your bank account. From your bank account you are again paying back to the government because it is erroneous refund. Now again it should be credited back to the credit ledger na. From where you took that money, you took money from somewhere, means when you are returning it should come back to that particular ledger only na. So this you are thinking this much time. So this 3 lakh should come back into this particular place for giving back into this credit. So they will be passing one form, that is PMT3A. So say this. When a registered person claims erroneous refund of ITC, upon payment of such refund along with interest and penalty, returning that refund along with interest and penalty, proper officer shall pass an order in form GST PMT3A for recredit into electronic credit ledger. Okay. Then balance in electronic credit ledger can be used for payment of only tax, but cannot be used for payment of interest, penalty, fee and others. Even for payment of GST under RCM, can we use the balance in electronic credit ledger? No. We cannot use balance in electronic credit ledger for payment of GST under RCM. So therefore balance in electronic credit ledger can be used only for payment of GST, that too under FCM. Can be used only for payment of GST under FCM, but not for payment of GST under RCM. And balance available in the electronic credit ledger may be restricted for utilization by the proper officer. Accordingly, we have rule 86A and 86B. First they gave 86A, 86B, then in the section they are making the amendment that balance available in credit ledger may be restricted for utilization by proper officer. Okay. And what is that restriction? As per rule 86A, suppose if we have availed some ITC and that ITC is there in our electronic credit ledger, this ITC can be suspended up to a period of 1 year if supplier is not in existence or not doing business from the place where they have obtained registration. Okay, again our supplier is not in existence or not doing business from the place where they have obtained registration, or recipient is not in existence or not doing business from the place where they have obtained registration, or invoice is missing, okay, the document is missing, or you have not at all received the goods and you availed the ITC. See this. So ITC availed against an invoice by a supplier who is not in existence. What is the meaning of not in existence? Means department cannot identify him. That is the meaning. Not in existence means not that he is not there. So he is not in existence means department could not identify him, or not doing business from the place where they have obtained registration, or ITC availed by a recipient who is not in existence. So above point is supplier not in existence, Here recipient not in existence or not doing business from the place where they have obtained registration. ITC availed without receipt of goods. ITC availed against invoice for which supplier has not paid tax to government, or invoice or debit note is not in existence. These are the 5 cases. In these 5 cases, whatever ITC that we have already availed in our GSTR 3B and comes in our credit ledger will be suspended. Then what is the difference between this and that section 38 which we discussed? Section 38 is, first of all, we cannot avail it, it is restricted in 2B itself. If you have already taken, then it can be restricted in the electronic credit ledger, that is this rule 86A. Understood the difference? Then for what period it will be suspended? It will be suspended for a maximum period of 1 year. What happens after 1 year? After 1 year, so the person will be able to take this input tax credit back. You understood? Upon expiry of 1 year from the date of restriction, the registered person shall be able to debit input tax credit so disallowed, subject to any other action that may be taken against such person. Means this 1 year, it is like a temporary suspension. Means in that 1 year period, they will identify the supplier, or they will check whether it is a genuine credit or not, and thereafter it will be allowed back. Means you can enjoy that credit for payment of your liability. Clear? Then rule 86B. Rule 86B is restriction of utilization of amount with respect to electronic credit ledger. That is, we have to pay 1% of our liability through cash ledger, even though we have sufficient balance in our electronic credit ledger. So, for a person whose turnover in a month exceeds 50 lakhs, a person whose turnover in a month exceed 50 lakhs. What turnover? To whom this 86B is applicable? Any registered person whose turnover in a month exceeds 50 lakhs. Month, okay, month turnover exceed 50 lakhs. That to which turnover? Actually taxable turnover. Because while computing this turnover, we should take out exempted supplies, zero rated supplies, and exempted supplies includes non-taxable supplies. Directly they could have given taxable supplies, because we have only 4 supplies: taxable supply, exempted supply, non-taxable, zero rated. Exempted take out, zero rated take out, non-taxable take out. Then what is left? Taxable supplies. So taxable supplies in a month exceeds 50 lakhs. And they have to pay 1% of the gross liability through electronic cash ledger. And even if there is sufficient balance in the credit ledger for payment of the liability. And to whom this 86B is not applicable? It is not applicable to government and their family members. That is, government department, public sector undertaking, local authority and statutory body. And also, if they have deposited more than 1 lakh of income tax in each of the last 2 years. So why? Because already they paid income tax more than 1 lakh. Again, no need to ask from them to pay 1% through the cash ledger. That's why. And received a refund of unutilized ITC greater than 1 lakh in the preceding financial year. So therefore, whatever refund is eligible to be given to them. Okay. And that to what refund? Refund of unutilized ITC, and that not yet sanctioned, which in the sense like sanctioned but not yet released. So means that refund is with them more than 1 lakh. And now in that case, again already their money is with them, again asking them to pay 1% will not be correct. So that's why rule 86B is not applicable there. Or cumulatively in the current financial year, up to that month you already paid more than 1%, then for that month you don't have to pay anything through cash ledger. Is it clear? So the total 6 cases, not 6 cases. So 7 cases. So this 86B is not applicable. What are those 7 cases? Government department or local authority or PSU or public sector undertaking, that is statutory body, or paid income tax more than 1 lakh in each of the preceding 2 years, or received a refund of unutilized ITC greater than 1 lakh in the preceding year, or paid more than 1% cumulatively up to that month during the current financial year. In these cases, so they are not required to comply with rule 86B provisions. Understood? Then, sir, RCM anyhow we have to pay using cash ledger. Will that be counted for this 1%? No, this is FCM liability. RCM liability anyhow you have to pay through cash ledger. and you pay that, and don't say, sir, 1% I already paid through cash ledger. No, it is FCM liability which you have to pay, because anyhow credit ledger we cannot use for RCM na. So therefore RCM always you have to pay by cash. So while computing that 1% cumulatively, you should not take RCM liability, only FCM liability, how much you discharge so far using the cash ledger. Then section 50, interest on account of delay in payment of tax. So we have to pay interest at the rate of 18% per annum to government, and on account of two reasons: delay in payment of tax or on account of wrong availment and utilization of ITC. Suppose if there is delay in filing 3B, then interest is computed on gross liability or net liability? On net liability, that is that amount which is paid through cash ledger. Suppose if you filed 3B for a particular month, but you have to pay some tax for that month. That tax you paid in a subsequent month, okay? For a particular month, you have to file 3B, you filed it late. Then interest is computed on net liability. Clear that? Then for a particular month, you filed 3B, but you have to pay tax for that month. You have not paid. That you are paying in the subsequent month. Then interest will be computed on gross liability or net liability? Gross liability. If tax is paid subsequent to payment of self-assessed tax in 3B, interest is applicable on gross liability, that is paid through cash ledger and credit ledger. Then wrongly availed ITC. If ITC is wrongly availed and utilized, we need to compute interest only on the wrongly utilized portion. So how to identify wrongly utilized portion? When the balance in electronic credit ledger falls below ITC wrongly availed, to that extent we have utilized the ITC, on that only interest will be computed. Is it clear? That's what today we discussed, that is January month we have availed some ITC, and whichever month the wrongly availed ITC, so balance in ITC falls below the wrongly availed ITC, in that month we have utilized the wrongly availed ITC to that extent, okay? And next month 20th onwards we need to compute the interest. Then we have segment 11. Before that, few queries. What if there was no ITC and entire payment by cash? Then excess wrongly paid will be entirely refunded? Yes, it will be entirely refunded into the cash ledger only. So suppose if we pay fully through credit ledger, fully it will come into credit ledger. If we pay fully through cash ledger, it will be fully coming into cash ledger. When we proportionately pay through credit ledger, cash ledger, it will proportionately come into credit and cash ledger, okay? How to pay 1% cash, even sufficient balance in credit ledger? How to pay means? So we have to pay, means you cannot utilize the credit ledger balance. So while filing 3B, so maybe in your filing 3B, so if you file 3B, you might be knowing it. At the time of filing 3B, we will be first utilizing the credit ledger balance. We need to enter that number. How much credit of IGST, CGST, SGST we use. But consciously we should ensure that we are not utilizing fully. So 1%, 99% only we can use. Then 1% we have to pay through cash ledger. Means 1% will be shown as liability, and it will show you don't have balance in cash ledger for payment of liability. Then we have to deposit that money and we need to make the payment. So we have to pay. Sir, what if I am not paying 1% of liability through cash ledger? We have na contravention of provisions. So violation of rule 86B, that leads to cancellation of registration, okay? So therefore we have to comply with that provisions. You have some doubt? Okay. So returns under GST, segment 11. In this returns under GST, so we have QRMP scheme. So QRMP scheme refers to quarterly return monthly payment scheme, and a person is required to go for QRMP, that is a person can opt for QRMP if their aggregate turnover during previous year does not exceed 5 crores, and also that in the current year they should ensure that their aggregate turnover during any quarter is not crossing 5 crores. If they cross 5 crores of aggregate turnover in any quarter, from that next quarter onwards, they will not be eligible for QRMP. Is it clear? So it is like, even though the words given there are, but actually it is like and. So but and means it will become a literal interpretation. So that's the reason why there are should be understood as and, which means two conditions. Condition number 1, previous year aggregate turnover should not exceed 5 crores, plus current year also any quarter, up to any quarter aggregate turnover should not exceed 5 crores. Then QRMP is available, and QRMP is GSTIN wise, not like composition scheme, all in or all out. So which means if I have 4 registrations, for few registrations I can go for QRMP, for few registrations I can go for normal, okay. And then if they go for QRMP, what is the time limit by which they need to file GSTR1? So 20th GSTR1 by 13th of the month following every quarter, GSTR3B by 22nd or 24th of the month following every quarter. Which case 22nd, which case 24th? So you need to remember, in India map, G, M, C, A and states below that. G for Gujarat, M for not Maharashtra, Madhya Pradesh, and then Chhattisgarh, and then Andhra Pradesh. So GMCA and states below that. So below that we have Maharashtra and Telangana, all those states. So then it will be 22nd of the month following every quarter. For the states above the GMCA, it will be 24th of the month following every quarter. That is the time limit for filing GSTR1 and 3B. Then monthly payment of tax. What is the time period by which they need to pay tax? 25th of the month following every month for the first and second month of the quarter. So first month, say for example, July to September quarter, they are going for QRMP. For July, they need to pay by 25th of August. For August, they need to pay by 25th of September. And what about third month? Third month, anyhow for all these 3 months put together, they will be filing 3B by 22nd or 24th of October, in that they will be paying. And what are the two methods of making payment of tax? So they have fixed sum method and self-assessment method. And whenever they are filing GSTR1 and 3B on a quarterly basis, which means the recipient will be able to take ITC also on a quarterly basis. To avoid the discomfort to the recipient, supplier is having an option to file IFF, that is invoice furnishing facility, on a monthly basis for the first and second month of the quarter by 13th of the month following every month. What about third month? Anyhow for all these 3 months put together, they will be filing one GSTR1 by 13th of the month following every quarter. So first and second month only IFF is required, but this details furnished in IFF is only with respect to B2B supplies, and the recipient will be able to take this ITC in GSTR2B, okay. And what is the time limit to opt in into QRMP? So remember, A for after, B for before. 1 month after commencement of quarter and 2 months before commencement of quarter, they need to opt for QRMP, which means, for example, July to September quarter, I want to go for QRMP. What is the time limit? 1 month after commencement of quarter means July end, and 2 months before commencement of the quarter, that is May 1st. So May 1st onwards until July end, I can go into QRMP anytime. But I should ensure one thing, that the last return has been filed before exercising the option, which means all monthly returns I should complete filing, and then only I should go for quarterly return. And GSTR1 or availing IFF facility, is IFF facility optional or mandatory? This will be optional, and this is only for the first 2 months of the quarter, and they need to file the details of outward supply by 13th of the month following every month. And whatever details that is furnished in IFF for the first and second month need not be again furnished in GSTR1, it will automatically coming in GSTR1, only the third month details they need to enter in GSTR1. And exception, that is the details of outward supply shall not exceed 50 lakhs in each month. I don't know why that point is given, but in every month how much outward supply data they can enter, only to the extent of 50 lakhs. And suppose if this option they are not opting, then what will happen? That is this IFF option. If they are not going for this IFF option, what will happen? All 3 months data they need to enter in GSTR1. Then payment method, there are two methods, fixed sum method and self-assessment method. Under fixed sum method, what will happen? We need to take the previous quarter. So fixed sum method, we need to take the previous quarter or previous month 3B. Okay. So for example, we are into the QRMP for the quarter July to September. Now we need to take the previous 3B. Is previous 3B quarterly 3B or monthly 3B? When it will be quarterly 3B, for previous quarter also, if you have opted for QRMP, then it will be quarterly 3B. Otherwise, it will be monthly 3B. So take the previous quarterly 3B into 35%. You need to pay as fixed sum method amount in the first and second month. Logic simple. So quarterly 3B means what? 3 months. So 3 months means divided by 3, we will get 1 month, 33.33, rounded off to 35%. So like that. So net liability, how much you paid in 3B in the previous quarter into 35%. 35% of tax liability in cash paid in the preceding quarter. Suppose previous 3B is monthly, then 100% of the tax liability in cash paid in the last month of the preceding quarter. So this is under fixed sum method. Under self-assessment method, we will compute how much is the actual liability. So how much we need to pay as liability minus how much ITC we have, that differential amount we pay under self-assessment method. Then any change in the manner of filing 3B? No, there is no change in manner of filing 3B. And so whether we give all the details of invoices in GSTR1 quarterly or monthly only, even though you are under QRMP, but GSTR1 data you will upload monthly only. 3B alone you will prepare on a quarterly basis. Is it clear? GSTR1 will be data uploaded on a monthly basis. 3B alone you will be filing on a quarterly basis. Then compulsory opt-out. When you will be compulsorily coming out of this QRMP, whenever your aggregate turnover exceeds 5 crores. And any late fee, yes, there is late fee for delay in filing GSTR1 and GSTR3B, but for IFF there is no late fee because IFF is optional. And interest, this is important. Interest on account of short payment or non-payment under QRMP. Now listen, you are under fixed sum method. You are under fixed sum method. You have to pay by 25th of the month following every month. So you have to pay under fixed sum method some amount. Say you did not pay by 25th. Then for delay, you have to pay interest at 18% per annum. Is it clear or not? For example, July month, you have to pay 35,000 rupees. Say previous quarter 3B liability is 1 lakh. So 1 lakh into 35%, 35,000 you have to pay by July. For July month, you have to pay by 25th of August. Now you paid it on 31st August. So how many days delay? 6 days delay. For that 6 days delay, interest needs to be computed at 18% per annum on what amount? On that 35,000 rupees. So 35,000 rupees into 18% into 6 divided by 365. Clear? Then same way, second month also we need to compute if there is a delay in payment of second month tax liability. Understood? Then suppose if there is any differential liability, say 35,000 rupees we paid under fixed sum method, but the actual liability is 40,000 rupees. On the differential amount, whether we need to pay any interest? No, we are not required to pay any interest. See this, tax with respect to first month or second month of the quarter not paid by 25th of next month. Interest we need to compute at 18% per annum from 26th of next month till the date of payment. And differential tax, what is differential tax? Actual tax paid, actual tax minus tax paid. So with respect to first month and second month of the quarter, whether any interest arises? No, because you are under fixed sum method. Suppose if you go to self-assessment method, you have to pay. So people, to discourage the people to go into self-assessment method only, they brought this interest actually. So that is, you paid under self-assessment method 35,000, but the actual liability is 40,000. Now that 5,000 rupees you have to pay interest because you are under self-assessment method. Had it been fixed sum method, you don't have to pay that interest. So interest at 18% per annum from 26th of the next month till the date of payment. This is on what? Differential amount. You understood the difference? Clear? So in fixed sum method that interest is not there, but on self-assessment method interest is there. Then suppose 3B is filed late. If GSTR 3B is filed late, then from 22nd or 24th afterwards, that is 23rd or 25th, till the date of filing 3B, you need to pay the interest. That is common. So in fixed sum method and self-assessment method, first interest and the last interest is common, but the second interest alone, so we will not be having in fixed sum method, but it will be there in self-assessment method. Next, we have time limits for various returns. So GSTR1 is a return which is to be filed by every registered person giving the details of their outward supplies. And what is the time limit for filing GSTR1? 11th of the month following every month. And if it is QRMP, 13th of the month following every quarter. And in case of IFF, 13th of the month following every month for the first and second month. GSTR 3B is a summary return, and that summary return is to be filed by 20th of the month following every month if QRMP not opted. If QRMP opted, 22nd or 24th. What are the notified states? I told you now to remember: Gujarat, Madhya Pradesh, Chhattisgarh and Andhra Pradesh, GMCA and states below that. GMCA and states below that 22nd, other states it is 24th. Then CMP8, who will be filing CMP8? Composition scheme. What is the time limit? 18th of the month following every quarter. GSTR4 is an annual return filed by a person opting for composition scheme. Time limit is 30th April of the succeeding financial year. GSTR5 is a return to be filed by NRTP, non-resident taxable person. Now there is an amendment. Previously it was 20th of the month following every month or 7 days from expiry of registration, whichever is earlier. That is amended to 13th of the month following every month or 7 days from expiry of registration, whichever is earlier. And GSTR 5A is a return to be filed by OIDR supplier located outside India, and regular like 3B only, 20th of the month following every month. GSTR 6 by input service distributor by 13th of the month following every month. GSTR 7 and GSTR 8 is TDS and TCS by 10th of the month following every month. GSTR 9, 9B, 9C, so annual return needs to be filed by 31st December of the succeeding financial year. GSTR 9C was previously audit report, but now it is a reconciliation statement, self-certified reconciliation statement. And when this GSTR 9C will be applicable? If aggregate turnover during the year, during a previous year means completed year. So for the completed year only now we file annual return. So for the previous year exceeds 5 crores, means aggregate turnover for the year for which we are filing GSTR 9C exceeds 5 crores. So then only 9C will be required, which is a self-certified reconciliation statement. And 9B, who will be filing? E-commerce operator. And GSTR 10 is an annual return, so final return, which is required to be filed after cancellation of registration. What is the time limit for filing this final return? 3 months from the date of cancellation or order of cancellation, whichever is later, not whichever is earlier, whichever is later. Whether this 3 months should be taken for date of cancellation or order of cancellation or both? Only for date of cancellation. This is one point. Then order of cancellation is another point, whichever is later. And GSTR 11, details of inward supplies of UIN holder. Who is a UIN holder? Unique identification number holder. That is UN agencies, embassies or consulates. So they will be filing GSTR 11 at the time of claiming refund with respect to whatever purchases they have made. So that details they need to submit. But there is no time limit for GSTR 11. As and when they make refund claim, at that time they will be submitting GSTR 11. And some special points on returns, we have sequential filing of returns. Sequential filing of returns means without filing GSTR 1 of that month, you cannot file the 3B of that month. And without filing 3B of the previous month, you cannot file the GSTR 1 of the second month. And without filing GSTR 1 of second month, 3B of that month. Like that, there is a sequential filing of returns. And government on the recommendations of GST Council may allow a person to file GSTR 1 even if GSTR 1 is not filed for prior periods. So mainly, lot of taxpayers were asking for this ITC. So for that reason only, so even if the GSTR 1 is not filed for any prior period, so as a stopgap arrangement or as a transition arrangement, so the point is given, means even if the GSTR1 is not filed for the last year, we can file the GSTR1 now, like that they are giving this, okay. And who are not required to file GSTR1 or 3B, remember tonic. So tonic not required to file GSTR1 or 3B. In the tonic T is 2 times, TDS, TCS. Why they are not required? Because they are filing GSTR7, GSTR8. O is OIDR supplier. Why? Because they are filing 5A. And N, NRTP, because they are filing GSTR5. I, input service distributor, because they are filing GSTR6. Then composition scheme dealer, because they are filing CMP8. Same way, who are not required to file annual return. Remember CAG tonic, CAG Comptroller and Auditor General, that is those books of accounts, those entities whose books of accounts are subject to audit by CAG. So there also annual return not required. And tonic, T for TDS, not TCS, because TCS is e-commerce operator, they are required to file GSTR 9B. O for OIDR supplier, and N for non-resident taxable person. I is input service distributor. C is not composition scheme, because composition scheme is required to file annual return GSTR 4. It is casual taxable person. Then late fee for delay in filing return. So this late fee for GSTR 1 and GSTR 3B, if it is nil return, 10 rupees per day subject to maximum 250 rupees. If it is other than nil return, 25 rupees per day, but subject to maximum will change. If the aggregate turnover during previous year exceeds 5 crores, then the maximum will be 5,000. If the aggregate turnover during previous year exceeds 1.5 crores, but does not exceed 5 crores, then 2,500. If the aggregate turnover during the previous year does not exceed 1.5 crores, then it will be 1,000. Okay. So maximum will be 5,000, 2,500 and 1,000. When 5,000, if aggregate turnover during previous year exceeds 5 crores, 5,000. Does not exceed 5, but exceeds 1.5, then it will be 2,500. Does not exceed 1.5 crores, then it will be 1,000. So then, in case of GSTR 5, 5A and 6, it will be, maximum will be same. Maximum will be 5,000. Maximum will be 5,000. But per day late fee will change. That is, if it is nil return, 10 rupees per day, other than nil return, 25 rupees per day, but the maximum is always 5,000. Then in case of GSTR 7 and 8, long back we discussed. GSTR 7, 25 rupees per day subject to maximum 1,000. GSTR 8, 100 rupees per day subject to maximum 5,000. And GSTR 4 is annual return to be filed by a person opting for composition scheme. Who can opt for composition scheme? Whose aggregate turnover during previous year does not exceed 1.5 crores. Generally, if aggregate turnover does not exceed 1.5 crores, what is the maximum late fee? 1,000 rupees. So therefore, you remember that provision. Nil return 10 rupees per day subject to maximum 250. Other than nil return 100 rupees per day subject to maximum 1,000. 25 rupees per day subject to maximum 1,000. And GSTR 9, 9B, 9C annual return 100 rupees per day subject to maximum 0.25% of the turnover. Maximum will change. And all this late fee is under CGST Act. Means the same amount of late fee will be payable under SGST Act also. Then filing nil return through SMS. There are 3 returns which can be filed through SMS, but all the data, all the entries in the return should be nil. That is GSTR 1, GSTR 3B and CMP 8. So these 3 returns, all the entries, means input tax credit also should not be there. Everything is 0, then we can file the return through SMS. Then first return, section 40, that is whenever post registration we are filing our first return GSTR 1 and GSTR 3B, not only the details of that month for which we are filing return, but also details of the period before that, that is from the date we are liable to get registered, everything should be included in the first return. Then notice to return defaulter. Suppose if a person has not filed returns, then notice will be given in GSTR 3A, and once notice is given in GSTR 3A, within 15 days from the date of notice the returns should be filed. If the returns are not filed within 15 days from the date of notice, then it will lead to best judgment assessment. Okay. Then rectification of returns. Which returns can be rectified? GSTR 1 and GSTR 3B. What is the time limit for rectification now? 30th November of the succeeding financial year or actual date of filing annual return, whichever is earlier. Then how the details of outward taxable supplies should be entered in GSTR 1. If it is B2B supplies, always it should be entered invoice wise. If it is B2C supplies, divide it into two, interstate, intrastate. Intrastate we can consolidate, and interstate what we need to do? So we should check whether the invoice value is more than 2,50,000 or does not exceed 2,50,000 per invoice. If the invoice value exceeds 2,50,000 per invoice, then we need to do invoice wise. Suppose if the invoice value does not exceed 2,50,000, all those invoices we can do state wise consolidation. Okay. So that is with respect to this returns. Okay. One small topic is there, accounts and records, that we will complete. Okay. And then we will leave for today. Remaining we can see tomorrow. So look into segment 12, accounts and records. What are the various accounts and records to be maintained by a registered person? As per section 35, only two sections are there. Section 35, what are the accounts and records to be maintained? 36, what is the period for which accounts and records to be maintained? So remember I formats, I for inward supplies, F for foreign trade, import and export, and then O for outward supplies, or RCM supplies. Out of that inward supplies, what are all covered under RCM should be separated, because on that we need to pay GST under RCM, that's why. And then, so I for mats, M for manufacturer production related, A for advances received, adjusted and paid, and then T for tax details, S for stock details. These are the various records to be maintained by a registered person, but don't write I formats. You write by explaining this. Okay, all records pertaining to inward supply, all records pertaining to outward supplies, like that. And a person opting for composition scheme is not required to maintain the last two, that is TS. So it is only I pharma. So T and S, tax details and stock of goods, is not required for a person opting for composition scheme. And where these records should be maintained? These records should be maintained in principal place of business pertaining to all the place of business. We need to maintain in principal place of business, and records pertaining to additional place of business we need to maintain in additional place of business. For example, I have three places of business: Chennai, Coimbatore and Pondicherry. Okay. So, sorry, Chennai, Coimbatore and Madurai, because Pondicherry means UTGST, that's a separate registration. So, Chennai, Coimbatore and Madurai. So, three places I have. Now, in Chennai, I have to maintain the books of accounts and records of all three places. And in Madurai, I have to maintain books of accounts related to Madurai. And in Coimbatore, I have to maintain books of accounts related to Coimbatore. You understood or not? So, as per section 35, the above records to be maintained by every registered person in principal place of business, and records pertaining to additional place of business in each additional place of business. And as per section 36, for what period we need to maintain the accounts and records? We need to maintain the accounts and records for a period of 72 months from the due date of filing annual return. And so 6 years, you need to remember it as 6 years. Suppose if for a particular financial year you went on an appeal, then in that case 6 years from the due date of filing annual return, or 1 year from the date of disposal of appeal, whichever is later, not whichever is earlier, whichever is later. 6 years from the due date of furnishing annual return, or 1 year from the outcome of the appeal, whichever is later. And also every transporter and warehouse keeper, even though their aggregate turnover does not exceed threshold limit, but they need to definitely get a unique enrollment number. So means they need to give their details and maintain necessary records, and they need to obtain the unique enrollment number. So these are the points that we have in accounts and records. Then from this segment 13 onwards, we can see in tomorrow's session. Okay. So any queries? Here we have few queries. Let's answer that. Can anyone tell how this 3 days rocket revision possible to do before exam in 1.5 days? So which means you are asking me to do in 1.5 days or no, yeah, simple. Because actually, actually you can complete in 1 day itself. Simple logic. In a day I am taking effectively not 8 hours and all, 6 hours only. Break and all if you take out 6 hours. 6 into 3, 18 hours. This is how I planned actually. So 18 hours is what rocket revision I do after excluding the breaks. So 18 hours and 1.5 divided by 1.5. 1.5x speed if you see. So it requires 12 hours. Morning 7 o'clock you start. By evening 5 o'clock, 6 o'clock you will complete. So certain things, no, you can do that. Because you don't have to read everything. Nah. Introduction to GST and all you will not read. And thereafter, so lot of things you know that. If you are preparing for the first time, definitely it will not be sufficient. But wherever core areas and all if you want to revise, it is possible because many students are doing it. So I also planned such a way only. Morning 7 o'clock if you start, by evening 5 o'clock they are completing all core chapters and all they are completing. But some small accounts and records, you tell me what is there to listen there. There is nothing. You can remember that. Like that, these topics and all you can skip and you can do that. It is possible. Then next. Fine. Thank you. Thank you all. Take care. We will meet tomorrow.